Ladies and gentlemen, please take your seats. The event will begin very shortly. Ladies and gentlemen, please take your seats. The event will begin momentarily. Please take your seats. Thank you. Ladies and gentlemen, please take your seats. We will begin in just a few seconds. Please take your seats. Ladies and gentlemen, please welcome to the stage Jennifer Lasseter, Executive Director of the Digital Dollar Project, and Josh Lipsky, Senior Director of the Geoeconomic Center at the Atlantic Council.
Thank you. Good morning. Good morning to those joining here in person and to those joining online. A warm welcome from Virginia for the Exploring Central Bank Digital Currency, Evaluating Challenges and Developing International Standards convening. It's a first-in-kind global convening discussing and workshopping interoperability standards with representatives from both public and private sectors. We are thrilled to have each of you here representing a diverse tapestry of global knowledge, experiences, and expertise. To introduce myself further, I'm Jennifer Lasseter, Executive Director of the Digital Dollar Project. Digital Dollar Project is a neutral, nonprofit forum focused on exploring digital innovation in money and future-proofing the US dollar in a world of decentralized and centralized, sovereign and non-sovereign digital currency networks. You might be asking, how do we do that? We do this by fostering real-world exploration, testing new technologies that will underpin the future of money, and informing the public discussion regarding opportunities, challenges, standards, and policy implications through convenings like this one. The Digital Dollar Project believes that central bank digital currency should only be deployed once key design elements relating to privacy, security, distribution, and economic stability are properly understood and democratically resolved. We also believe dollar-based stablecoins can play an important part in ensuring the role of the US dollar. As we have seen since the beginning of recorded history, money evolves. Today, that evolution will have consequences for the future of the US dollar and other leading global currencies. It is clear the future will be one where the world will embrace a wide range of central bank digital currencies, private stablecoins, decentralized systems of values, and other forms of money. Accordingly, it is imperative that the United States and other transparent and open societies play a lead role in shaping the standards, design, and underpinnings of these developing systems, embedding key free society values, legal norms, and protections in the process. Many of these conversations and experiments have started around the world, indeed here in the US as well with Digital Dollar Project pilots. We are honored to have you here today to talk about the progress that has been made and the challenges that remain ahead to ensure a globally connected, welfare-improving financial system of the future. Over the next 2 days, we have a lineup of thought-provoking keynotes, insightful panels, and hands-on workshops and technical experiences that I promise will push the boundaries of our collective knowledge. Day one will define the business case for and the process of developing interoperability standards. while day 2 will provide opportunities to engage in hands-on technical and practical application of our day 1 topics. Across both days, all discussions will anchor to the 5 convening themes of privacy, inclusion, security, cross-border interoperability, and competition and innovation. And for those joining in person, you can experience solutions addressing these themes live in the FinTech Hub. We encourage you to actively participate, ask questions, and engage in meaningful conversations with your fellow attendees. This conference is not just about what happens on this stage, it's about the connections you make and the ideas you take back with you. So before I turn to Josh Lipsky, my convening co-host, colleague, and friend, a special note of gratitude to our supporters, speakers, and organizers who have worked tirelessly to make this event possible. Their commitment to excellence has truly set the stage for an exceptional learning and networking experience. So ladies and gentlemen, please help me welcome Josh Lipsky of the Atlantic Council's Geoeconomics Center.
Well, good morning, and Jen, thank you. And I want to echo your thanks to everyone who has made what's about to happen over the next 2 days possible. And a special thanks to Christian Carlo and everyone at the Digital Dollar Project for such a fantastic collaboration. I want to ask everyone who is here today and everyone watching online and everyone who will be with us over the next 48 hours to try and take a step back for a moment. I firmly believe that too often at these convenings, and many of us have been at many of these, but this is going to be different, I promise, each of us comes in with a preconceived notion about CBDCs or stable coins and what a specific piece of technology can or cannot achieve. I am as guilty of this as anyone. And all of us forget or we skip over why so many in both the public and private sector are trying to innovate in the first place. It is because our global financial system is falling so far short of its potential. We know the financial system could be made faster, more inclusive, more cost-effective, and much safer. We know that. We see the technology makes it possible. We see it happening around the world. You'll hear today and tomorrow from central banks and finance ministries in the private sector who are doing it. The goal should not be to choose any one kind of tool. The shared goal should be to build a better system. And if we remember that, then exploring central bank digital currency, the title of this conference, is a natural question for all public officials to ask, because they have a responsibility to plan for the future of money just as much as the private sector does. Now, when we started working on CBDCs and stablecoins at the Atlantic Council 3 years ago, a lot of people gave us pretty funny looks. What was a foreign policy think tank doing with digital currency? And I think what many people forgot, but they've since remembered, is that money is one of the most geopolitical things that exist in the world. Today, our flagship CBDC tracker is the most viewed piece of research across the entire Atlantic Council. Our cryptocurrency regulatory tracker is a one-of-its-kind database. Our research on SWIFT and the role of the dollar has galvanized policymakers and financial institutions. I am so proud of my Atlantic Council colleagues, in particular Ananya Kumar, who leads our Future of Money work, for creating these public resources which have shown so many around the world just how quickly the nature of money is changing. You can read her new research with the Digital Dollar Project that's just published today. Scan the QR codes and you'll find it. Now, we at the Atlantic Council have never been satisfied to just show what is happening with CBDCs and stablecoins and other innovations. We have always, since we started the Geoeconomics Center, wanted to shift the trajectory in a positive direction, knowing that the decisions made today will impact the global economy for a generation to come. We believe that if the US is more involved in these decisions, as you said, Jen, if it brings real answers and models and solutions to the table, the US can help set standards that protect privacy, deliver cybersecurity, and foster innovation. But let us be honest. The best answers in this field have not come from the Federal Reserve, at least not yet. They've come from central banks around the world, many represented here, finance ministries, and the private sector. Those innovations have spurred public officials to think about fiat in a way they have not done in decades, and I think that's a good thing. And so this conference is not about public officials getting together and talking about standards. And it is not about the private sector meeting and saying there are only private sector solutions. It is about recognizing the reality that the future of money will, of course, be both public and private, and finding ways to work together to deliver that future safely and effectively should be and has to be our shared mission. If we don't, the system we will pass on is a system that has more friction, not less. So I hope we all remember the stakes throughout these 2 days. I could not be more excited to jump in. So let's get started. It is my pleasure to introduce Hatice Karahan, Deputy Governor of the Central Bank of Turkey. She has served in that role since July. She previously served as Senior Advisor to the President and an advisor to the Technological and Scientific Research Council of Turkey. She was also a visiting scholar of economics, both at Harvard and Columbia. Moderating this conversation will be the Deputy Director of the Geoeconomics Center and Seaboard and Gray Senior Fellow, Charles Litchford. Deputy Governor, Charles, the stage is yours.
Well, thank you everyone for coming, and thank you especially to you, Deputy Governor Karahan, for joining us. I know you have quite a busy week in DC. In fact, I think we'll be meeting again in a few days. But today our conversation obviously focuses on the CBDC projects that have been taken on by your institution. So I thought as a first question we could simply talk about where you are with your CBDC project, your pilots, and what your plans are for the next few years.
Of course. First of all, I thank the Atlantic Council and the Digital Dollar Project for organizing this exciting event. I'm sure we'll learn a lot from each other during these 2 days. And as for Turkey, we initiated our research and development activities on CBDC in 2020 with the proof of concept studies. And these involve testing the applicability of various distributed ledger technologies into CBDC. And following the successful completion of the proof of concept studies, we officially launched the Central Bank Digital Turkish Lira Research and Development Project the same year. So the project necessitated significant and diversified technological capacity, and for that purpose we began the first phase of the project with the contribution of the active involvement of leading national technology stakeholders, and that really facilitated the development process. And we completed the first phase of our CBDC project this year in 2023, and it involved the initial testing of strategic and critical technologies along with limited closed-circuit pilot tests. And based on the results of these tests, we will continue with advanced phases. Phase 2 will be initiated soon, this year or in the beginning of the next year. And I can say that exploring CBDCs has been a significant undertaking for us, but we assumed an iterative yet flexible approach in our quest for CBDC studies.
And obviously, many things are yet to be discovered on the uses of CBDC, what you devoted to. But one question that comes up a lot in our work on CBDC, and I think over this conference, will be whether you see in your imagination about it at this point, it mainly being used domestically to facilitate transactions within Turkey, or whether you can see a cross-border function for it.
Right. I think this is a very critical question, not for only Turkey, but for many countries studying CBDCs. And obviously the interest in CBDCs vary significantly based on the motivations and needs of individual jurisdictions. But I'm sure all of us have significant questions to address, and I'm sure we'll discuss all of these during this event. But when I think of the potential benefits of a CBDC, I examine them from a very simple economic perspective, demand versus supply. And yes, some central banks might be willing to provide or supply central bank digital currencies, but where is the demand for them? What is in it for users? And in other words, where and how do supply interact with demand? So I think this is the main question that we should answer. And to be able to answer this question, we can focus on two fundamental issues related to the functions of money. The first one is obviously using CBDCs as a store of value. So the question is, can CBDCs effectively substitute cash or commercial money? Is there genuine interest in them or demand for them? But for the sake of your question, I will be focusing on the second function of money here, which is using CBDCs as a means of payment. So again, the question is, can CBDCs effectively serve as payment systems, or can they substitute existing fast payment systems? Yes, in countries with less advanced digital infrastructures, digital banking systems, CBDCs can play the role of bridging the gap. But for others, with a well-developed system, CBDCs must offer something extra. And from the perspective of users, this could be lower transaction costs or anonymity, and these are the issues that central banks should work on. And right in this context, one potential benefit that stands out to me is the use of CBDCs in cross-border payments. And as countries explore the implementation of CBDCs, facilitating cross-borders through CBDCs becomes a compelling factor. And I think this might be where the future of CBDCs lies. And as for Turkey, yes, we have had some preliminary studies on retail CBDC, but I also believe that the real business case for CBDC could be the cross-borders, in the cross-border setting, considering that Turkey has an advanced digital banking infrastructure.
Mm-hmm. Thank you. So if I could just take you back maybe to what we broached upon in the first question, which is some of the challenges. You are considerably more advanced than many central banks in your pilot project. You've already discovered some of the challenges that arise when trying to create a CBDC. Mm-hmm. Without wanting to push you too much on sensitive detail, we're just curious what challenges you've run into, and perhaps some advice you might have for central banks that haven't advanced as much as you have. And it can be about cross-border, but just in general as well.
I think the main and general lesson that I can share, or challenge that I can share, and I'm sure everyone here would agree on this, would be that exploring CBDCs involves a complex decision-making process in a rapidly changing digital landscape. So pursuing an iterative approach, as I said before, and a flexible approach really matters. But on the technical front, I can also say that starting early does have its own advantages. Conducting multiple pilot studies with diverse technologies is essential here, considering the area of distributed ledger technologies available. And central banks need to develop some in-house digital technology. And in this context, I think collaborating with some technology-related institutions is quite helpful. We have established a platform where, as I implied before, where leading national technology stakeholders can contribute to our work on CBDC, and this definitely expedites the development process. And lastly, another takeaway that I can highlight would be working simultaneously on the technological front and the other aspects, regulatory and economic aspects. This is efficient because these processes complement and feed each other. But most fundamentally, figuring out the main use or benefit of a CBDC is a key issue here. Some might think that it will be all right on the night, but I think the key issue here is planning ahead.
Mm-hmm. And I think you hinted at some sort of skepticism of whether it was useful or not. Is that what you feel when you're trying to push this agenda within Turkey? Is that simply within your own institution? Can it also be with public opinion, those you've engaged with through pilot projects? I think quite often when people come to see us and talk about CBDC at the Atlantic Council Geoeconomic Center, we have people who are very enthusiastic and people who are slightly less enthusiastic. So what arguments do you use to
I think CBDCs, they sound exciting to our people in Turkey as well. But again, my question is where demand and supply will interact. Once you have this product, will it really work? Will it really be demanded? That's why all countries have to take into consideration their needs, their real needs in designing CBDCs. It could be retail versus wholesale, or cross-border versus domestic. So there are many issues to discuss.
Picking up on something you said just a few moments ago on the technical question, the ledger, what kind of technology is used. This will be discussed in many workshops today and tomorrow. Blockchain.
Yeah.
Is it necessary for a CBDC? Are there alternatives? What would your view be?
Yeah, of course. So obviously another challenging question has been on the decentralization or centralization of CBDCs. And in this sense, so the question is whether CBDCs should rely on distributed ledger technology or opt for other centralized technologies. And the central banks find themselves tasked with determining the optimal level of centralization or decentralization. And I think this is a decision crucial for ensuring stability and security, and also the realization of policy objectives. However, the adoption of blockchain technology is still controversial. I'm sure we'll discuss this today due to the numerous challenges associated with its technology. Let's think about it together. Okay, what kind of benefits and challenges does the blockchain technology offer? Number one, blockchain-based CBDC can help increase efficiency in payments. There's no question about that. However, scalability and security issues provide a challenge in this sense, because when considering a retail CBDC, for example, if you consider it as a cash alternative to cash on a population scale, then blockchain might have some problems, satisfying those scalability needs. Number two, one of the reasons why some people might think that blockchain technology is necessary in the design of CBDC is because of the potential for, programmable money through smart contracts. But again, although I agree that being programmable is an appealing characteristic of a retail CBDC, let's remember that this could also be achieved through a set of well-defined APIs, through a layer instead of smart contracts. So I'm going to make my third and last point in this sense, and we all know that blockchain also offers to establish trust among parties when there is a lack of central authority. But if a central bank is integral to the design of a CBDC and the trust in that central authority is implicit, then the need for a domestic for blockchain in a domestic retail CBDC might seem not so apparent. And therefore, this brings me to the realm of cross-border CBDCs. Because for cross-border CBDCs, you have multiple central banks and there is no single authority. And in that case, in such a scenario, trust needs to be built. And therefore, I believe that blockchain technology would be more suitable in those scenarios.
Understood. Onto a topic which already in your answers you've touched upon, which is retail versus wholesale.
Okay.
Our understanding is that Turkey has done more research on the retail side, whereas the US, for now, the Fed is more focused on the wholesale side.
Okay.
I think we'd be curious to know whether your institution, plan on doing more work on the wholesale side, and what would justify for now your motivation for sticking to retail.
I see. So in terms of technology, in either case, there is some significant overlap in the underlying technologies. And they're both forms of digital central bank money, and this should be agnostic to the technology on which they are built. So I can say that we are effectively, as the Central Bank of Turkey, we work effectively on both types simultaneously in terms of technology. However, we are also aware of the fact that the practical implementation of these two different types differ on many fronts. And this includes variations in the parties involved, the design or the operational issues, and the list goes on. For instance, as I mentioned before, the distributed ledger technology might be more promising for wholesale cross-border payments, and because decentralizing trust is a priority there. And certain technological challenges that blockchain has, like scalability and performance, become less critical in those settings. So these are the main issues that we consider, and in that sense, yes, every country has different needs, different perspectives on CBDCs. As for Turkey, I believe the adoption of a digital Turkish lira would be more meaningful within the context of a wholesale CBDC if it will be used in cross-border payments, because we have a well-established digital banking infrastructure.
Mm-hmm. Thank you very much. We'll move on to the regional context, your neighborhood. The ECB will be speaking tomorrow at our conference.
Yeah.
The links between the Turkish economy and the Eurozone are well known. So we're curious as well how you see interoperability with specifically the digital euro. So how does their work potentially impact yours and vice versa?
Well, of course, countries in the Eurozone are primary trading partners for Turkey, and therefore we are closely watching the developments regarding the digital euro project. Although there has been no decision yet to initiate the digital euro in the near future, we know that the potential benefits to emerge in the long run, central banks should work together to for the CBDC standards and regulations to align. That's one important issue to achieve interoperability, as you mentioned, and streamlined cross-border payments. Of course, it depends on if the Eurozone will be interested in cross-border transactions. Fully grasping the potential consequences of the digital euro project will take some time as the project advances, I mean, based on the restrictions that they will impose. As such, we believe that, cooperation and coordination across parties will be beneficial to have safe and good results in the future.
Hopefully this conference helps you in that direction. Another point about this conference that was made by Josh and Jennifer earlier, we're proud that it isn't just the CBDC crowd that's represented here, but other people who are interested in digital currencies, the private side. And so I think for those people, but also for everyone in the room, we'd be curious on your a quick description of how you see the landscape of cryptocurrencies and stable coins in Turkey.
Right. First of all, I can say that there is a huge interest in crypto assets in Turkey. It holds significant potential, primarily driven by the growing interest of people in those assets for investment purposes. But as a Central Bank of Turkey, we have always had a cautious approach against crypto assets. So when we look at the short but pretty active history of cryptocurrencies, it wouldn't be wrong to label those assets as at least a huge majority of them as risky and unsafe products. That's our approach. So our stance is very similar to many other cautious regulators across the world. We recommend investors to approach them with caution and also set regulations in that regard. So in 2021, as the sole authority in Turkey's payments domain, the Central Bank of Turkey proactively issued a regulation on the disuse of crypto assets in payments. And number two, crypto asset service providers are now obligated parties for AML and SFT. They are subject to regulatory requirements and under the purview of the Financial Crimes Investigation Board in Turkey. And lastly, there is a new law on the regulation of crypto assets in the drafting process, coordinated under the Minister of Treasury and Finance. And it involves relevant financial authorities, including our central bank. So this forthcoming law is expected to provide an umbrella regulation outlining and strengthening the framework on crypto assets. And when it comes to stable coins, we are working on further structured regulations on them.
And do any of these laws, regulations impact your work on CBDC?
No.
So separate.
Yeah, separate.
Understood. Back to the conversation about international standards, given that your institution has done quite a lot of work and serves as an example. At the Atlantic Council, we're very interested in fora. Through which channel, at which discussion point does this sort of influence take place? How can you serve as an example? So where do you think international standards can be established for CBDCs? Would it be through the G20 working group on payments? Somewhere else?
Yeah, actually we are involved in various groups. Of course, one of them is the G20, the working groups within the G20, and FSB. We are a member of the BIS, so we do our best to contribute to all the related groups on payment systems and CBDCs. And also another approach that we have is, being open to dialogues with other central banks in conducting collaborative CBDC studies to establish international standards together. In a sense, we have also recently participated in the Bridge project as an observing member. So this also shows our interest in further international collaboration, because we really care about the importance of a global, harmonized approach, and these are the best places to work on these issues together.
Well, thank you, Deputy Governor. Please join me in thanking the Deputy Governor for her time. And before we leave the stage, it's my duty and pleasure to welcome the moderator of the next session, who is Yesha Yadav. Thank you.
Okay.
Okay, good morning, everyone. Good morning. How's everyone doing today? What an incredible event, what an incredible convening. It is such a pleasure and a privilege to get to moderate this incredible panel. Thank you most of all to the incredible Atlantic Council, to the Digital Dollar Project, Chris, right here for bringing us together in this really, really important and very timely conversation surrounding the future of money and digital currencies. One thing to say is that, we've all spent this past week enjoying naps and Netflix and food. A bunch of people who have done none of that are the folks that have organized this truly special convening today. Gabby, Jen, all of the fabulous staff that have made this happen. So thank you all so much to them for bringing us together and for making this panel a reality. So Gabby has given me the hardest and the best job in this whole conference. The best because I get to moderate this all-important superstar panel of experts on the topic of the future of money. And of course, the hardest because I have to download their brains on this teeny tiny topic over the next 40 minutes or so. So if you guys are good to go, shall we start?
Let's do it.
All right, so I'm gonna get very professorial and start cold calling on all of them. We're not gonna do intros, as you'll see. The superstars will make themselves very apparent here. So we're just gonna kick things off and get started. All good, guys?
Yes.
Yep. Let's do it.
All right, so let's do it. So the task that we have today is to talk about the future of money and what money is gonna look like in the 2030s. But as we're thinking ahead, as we're thinking forward, I wanted to take a minute just to think about what's happened over this last decade, right? This last decade has felt so incredibly powerful, has felt so incredibly kinetic in terms of how money's evolved. So let's sort of take a minute to think about what we have learned from this last decade. So Carmel, maybe we could start with you. You are the CEO of MTech. You're working enormously and widely in areas around the world, including obviously in Africa. Do you want to sort of kick things off and tell us a little bit about what your experience has been, what your takeaway has been about what is happening with this last decade of innovation around money? What are you seeing that is changing?
Sure. So interestingly enough, one of the reasons I started in Africa was because of the opportunity around financial inclusion, but what that also highlighted are the solutions that have been born out of need of financial services. M-Pesa is a use case that a lot of people are familiar with when it comes to Kenya and how a telecom company ending up not wanting to have its staff travel 8 hours a day to go bring money back home and said, let's top up your wallet and then tell your family to go to an agent in a rural area and we can convert the minutes to cash for them. That's how mobile money was essentially born, out of a need. And what has happened over the years is just not only the adoption, but is also the education of how to adopt new forms of technologies, new forms of money, and what that essentially means to have a telecommunication company become your financial service provider. So we've seen changes in the ecosystem as well. But one thing that is clear is that what is happening now is an evolution and the continuance of looking for better financial services, better financial products. And the question that we're having now is how do we continue to use modern technologies to make that more efficient, to address some of the gaps and some of the problems that maybe the first generation, the second or third generation did not particularly address, or capabilities did not exist then. And as research and development has continued, finding new ways of addressing pain points and challenges and making money move in a more efficient way, in a faster way, and now, of course, in a cost-effective way, is what we're seeing, especially in emerging markets. So that has been the work. And going into CBDC, interestingly enough, Nigeria, for example, on any given month is the highest country as far as Bitcoin usage. Yeah. And you've seen a lot of crypto use cases emerge from the emerging markets as well. I think it's clear that there's a need and there's a demand for new financial products.
Based on what Carmel said, Olivia, if I could sort of get your perspective from this transition from the bank to the venture scene that you are now inhabiting and leading. So you started at Nomura in the digital assets division. Now you're working at Laser Digital as a major player there in the context of venture funding in crypto. What has been your takeaway from that perspective, seeing the traditional finance, the banking perspective, bank products, bank-driven payments, to now this world in which you're working, which is investing within digital assets markets where there's a lot of non-bank payment providers as well?
Thanks. So I actually spent the last decade primarily in Hong Kong. And in Asia, the pace of transformation when it comes to payment and money has been incredible. And we've moved from an era where your relationship with your bank was account-based to a completely decoupled era where you have multiple relationships when it comes to payment and money. And for me, there were three takeaways. One is that cash has nearly disappeared from most of the Asian countries, except maybe Japan. Second is that banks are being displaced. Your relationship with money is through various applications, fintech companies, and other intermediaries. And three is I think we are really at the tipping point of tokenization. And tokenization will drive a lot of new interesting use cases when it comes to adoption of stablecoins, CBDCs, or other form of currency. And to go through some of them step by step, I think the biggest transformation has been in mainland China. And I think it's very relevant to discuss that here because to a certain extent, I think maybe the US is lagging a bit behind when it comes to this. When I was going to Shanghai or Beijing in 2012, process was always the same. You change your Hong Kong dollar at the airport, you get RMB, and when you're in China, you pay with your bills, and sometime in hotels, you can use your credit card. And last time I went to China, just before the COVID lockdown in 2019, it was almost impossible to use cash. You were using your super app, so Alipay, WeChat Pay, paying with QR codes. even with your face in some cases, which is a bit scary in itself. And your credit card was, almost never accepted anywhere, only in maybe the most international places. And back in 2019 as well, the Chinese government was rolling out actively the digital yuan. And now they have 120 million wallets in use for the eCNY. They're starting to pay civil servants using the eCNY. With limited adoption, and what they're pushing through is this partnership between private sector and public sector, where you can use the eCNY with your Alipay or WeChat application, which are widely used throughout China. So that's point number one. Cash has disappeared, and point number two is that your relationship with your banks barely exists anymore. You pay with your app. It can be your Uber app, your Grab application when you are ordering a taxi, when you're ordering food. But your bank is not present anymore, and it's very hard to see a world where you go back to using fiat and go to a branch and withdraw some money from your ATM. And third point maybe I was going to make is that especially in Asia back in 2017-18, crypto was moving extremely fast, and you had a lot of adoption of course, Bitcoin to allow with modest uptakes on payments, but definitely stable coins. And stablecoins were widely used to buy, various virtual assets, but even payments. There were a few Bitcoin ATM popping up here and there in Hong Kong. And as we are seeing more and more traditional finance companies moving into tokenization, various forms of tokenization from funds, securities, but also virtual assets, you're going to have a need for stablecoins or CBDC to go on ramp and be able to transact there. So for me, we're really at this tipping point of, complete change of how we're going to interact with money in the next decade.
So it's very interesting that you should say that. From the legal economic standpoint, we have two sort of very broad distinctions with respect to money, as we know, which is public money and private money claims, right? So public money being central bank issued money that's backed by the state, the safest form of money. And then you have private money claims, which are issued by, banks, non-banks, and others, wallet providers, app providers, and so forth. So, in the context of us normal people, our interaction with public money has been in the form of fiat, in the form of cash, in the form of, just normal, just notes and coins. And for the most part, central banks have stuck to that. Now, obviously, Olivier, you talked about the Central Bank of China with the People's Bank of China, with the eCNY. But, in general, it's felt like central banks have not been moving forward from the cash-based form of private money, notes and coins. Why do you see this century or this decade to come as being different? Why do you think that central banks now are likely to move away from that simple model of paper and coin-based fiat money, public money, and perhaps to a more digitized version in the form of CBDC? So why do you think this time is different in the form of central bank innovation? So Carmel, you're working a lot with central banks in Africa. Do you have any thoughts on why regulators are reacting differently in this decade to come than before?
So this is a very fascinating question, and this is something that we don't speak enough about because the average person wakes up every day and doesn't think about central banks. Mm-hmm. I know I didn't before starting up tech. But the idea of central bank money plays a very unique role, and I think there is an elephant in the room between central banks and private institutions. Private institutions see themselves competing with public money. Mm-hmm. Every time you go to an ATM machine, you convert your deposit into cash. Yeah. You take it away from the bank's balance sheet, yeah. And now you have it, and it converts. You don't see it, but it converts back to the central bank's balance sheet.
Right.
The question is now, should central banks continue to play a role in the economy by providing a digital version of central bank money, mm-hmm. or should they move away and let private money be the main form of money and circulation? Mm-hmm. I think if you look at history, there is a risk, whether it's concentration risk, counterparty risk, liquidity risk, and so on, that the private sector can fail in a way that a central bank might not. Right? So it's really a risk management, and whether private sector app providers, e-money issuers, banks, want to think of it this way, yes, it does impact their business and their bottom line that central bank money continues to exist. And if people want to continue to use central bank money, that they can have a diversified portfolio, but whatever money that you have in cash is not sitting on the bank's balance sheet. That's the bottom line. Yep. And they would want more of it to sit on their balance sheet. But I think for the purpose of risk management, I think you're going to continue to see central bank money exist. And what we're really talking about is an infrastructure upgrade of that money. Today we have trucks and vaults and distribution and a lot of that happens. Tomorrow you have digital vault and a click, whether to issue or remove central bank money from the supply of money.
And you know, I wanted to follow up with you, Ben, based on what Carmel said. You're coming at it as the GC of Paxos, General Counsel of Paxos, before you were at Square. Are you seeing regulators shift their postures? Carmel is saying, you know, the infrastructure upgrade is a push here, the desire to create some kind of financial stability buffer with respect to sort of large amounts of private claims, having central bank innovation too start to play a role, for example, in relation to programmable central bank money. Are you seeing regulators respond differently in your conversations around the world as you kind of bring payments innovations to the fore?
I think there really is a change. You know, I think, you know, historically, central banks, there's a tremendous amount of risk associated with innovation, because you think about the power that these banks have to maintain monetary policy, you know, the way it's been for hundreds of years. And if you start innovating, you start tinkering with that, you lose some of the levers that you have to pull on that. And so there's been an understandable conservatism around innovating there. But I think what everyone is realizing is money has become so deeply personal for people that the expectation is that you can manipulate it on a 24/7 basis, you can invest it, you can use it as a form of expression. You mentioned Square. I used to work at Cash App. I don't know if people are familiar. Cash App is now issuing clothing. They have a record label. You would never have thought of a financial services company doing these kinds of things. What they're doing is they're capitalizing on the fact that people see value and money as something that's deeply personal, that they own. So there's been this recognition by central banks and regulators that they need to think about this differently. But I think that the point that was made around risk management is a really important one, which is the underlying assets need to be protected with prudential oversight. And we at Paxos have understood that. We're a 10-year-old company, and we issue stablecoins, but they're prudentially regulated, meaning every single asset that underlies that is held in trust with regulatory oversight. And so there's a world where both of these things can operate in parallel with one another, where you have private money innovation happening in the sort of retail-facing layer, but then you still have central banks in the background providing the stability that everyone knows needs to be there. I think that's the trend that you're seeing. And even the US, which has been kind of the most conservative when it comes to innovating around the US dollar, which is not surprising because it's the most popular financial product in the world, and the risk of innovating there is the highest of any. Right. Even they are kind of coming around to say, okay, we need to figure out how to create an electronic version of these assets so that they can work in parallel with the private money.
So, Mina, I wanted to, you know, based on what Ben said and central banks innovating, I wanted to bring you in here. You are the financial attaché for the Japanese government here in New York. You're working extensively on this US-Japanese conversation around money and innovation. In terms of specifics, what is the Central Bank of Japan doing in terms of CBDC innovation? What kind of developments are you seeing here? Can you speak a little bit to the Japanese experience and the work that you're doing in this context?
Thank you, Isha. And first of all, thank you for having me this fantastic conference. I'd like to introduce the efforts of the CBDC at the Bank of Japan, as well as the Ministry of Finance in Japan. Let me start with the Bank of Japan. The BOJ published its basic approach to CBDC in 2020. According to this, the Bank of Japan currently has no plan to issue CBDC. But from the viewpoint of ensuring stable and efficient payment and settlement system as a whole, it's important to prepare thoroughly to respond to changes. So based on this approach, the BOJ had implemented the proof of concept since 2021. And then, based on the results of the POCs, the pilot experiment began this year with participation of private sector businesses. And let me shift to the Ministry of Finance. And Ministry of Finance, the MOF is holding a meeting of experts to organize the discussions about the general framework of the CBDC system starting in April this year. I'd like to outline a couple of discussion points at the experts meeting, but please note that the discussions are ongoing and going to be finalized by the end of this year. No conclusion have been reached at this time. The first point is the role division between the Bank of Japan and a private intermediary operator within the CBDC system. So it will be appropriate to have two-tier structures, which means private intermediary institutions will stand between BOJ and users and mediate the transfer of the CBDC. There are also discussions about the additional services in CBDC system, let's say household accounting services or conditional payment services. To encourage the innovation in the private sector, it would be appropriate to consider allowing not only intermediary institutions, but also other private sector businesses to participate in the CBDC. And the second point is the role division between CBDC itself and other payment instruments. Even if the CBDC is introduced in the future, as long as there is a demand for cash, the supply of cash should continue responsibly, which means the CBDC could be mutually complementary with cash. We may also need to consider safeguard measure to deter adverse economic and financial impacts potentially caused by the shift of funds from banking deposit to the CBDC. The last one is security and handling users' information as well as other important issues. Of course, the cybersecurity measures and information security measures will be inevitable, but at the same time, it's necessary to harmonize the need to ensure privacy with AML, CFT, and other anti-abuse requirements. Yep. As a next step, based on the conclusion of the experts meeting, the Ministry of Finance will conduct further studies to identify basic concepts and possible options for general framework of the CBDC in cooperation with BOJ and other related ministries. I'll stop here. Thank you.
So that's super interesting what Mino just spoke about. And I think what struck me from Mino's answer is this collaboration between the public and the private here, right? Between having the central bank, but also having solutions which are private sector solutions to enhance the potential usability of the CBDC and other payment forms within the economy and payments choice within the economy. So Ben, Olivier, Carmel, feel free to join in here. You're working extensively in the private sector, obviously, Ben, and Olivier, you're in the crypto space, and Olivier, you came from the banking side as well. What do you see as being the innovations of the future from the private claim side, from the private market side, that you see as being most likely to get networks just flourishing across the globe? The usability, the acceptability, the solving that last mile problem, which has really impacted the ability of payment innovations to get the inclusion focus realized. So what do you all think as being that private solution that's likely to win here, to win networks and acceptance and so forth? Do you have any thoughts on that? And this is really for all of you guys in a different capacity that you're working here.
Right. Go ahead.
Well, I would say without a doubt it's stablecoin and tokenization. I think if you look at the value proposition that comes from a stablecoin, it's pretty undeniable. It allows you to take, or tokenization more broadly, it allows you to take a real world asset, put it on the blockchain, and then move it at the speed of the internet, which is basically exactly what consumers are asking for today, and also the issue that we have today, moving assets around the globe, is intermediaries, it's slowness, it's non-instantaneousness. So stablecoin really hits on the problem statements that exist in financial services today. The trick is, how do you do that in a safe and sound way? How do you make sure that the assets that underlie those stablecoins are going to be there, or they're bankruptcy remote, they're subject to regulatory oversight. But the reason that stablecoins are so exciting is they're starting to show the real world use cases that people were always struggle to kind of put into concrete terms when you thought about cryptocurrency. I'll give an example that Paxos is pretty excited and proud about. We issued PYUSD recently, which many people are aware of, which is a partnership with PayPal, one of the biggest established payment networks in the world, for a regulated stablecoin. And although PYUSD is kind of early in its stages, we had a really interesting use case recently where we had a user who took PYUSD from their Venmo wallet, which is a US financial services app, transferred it to Yellow Card, which is an African fintech platform, and then put it side by side with transferring that same amount of value through traditional financial institutions. And the recipient received 40% more through stablecoin transfer than through the traditional financial institutions, which is staggering. 40% is like, it's not I mean, I don't need to say, it's such a material amount.
And the speed?
And the speed was 15 minutes versus 5 days. So right there you see this incredible use case for cross-border remittances, which I think everyone recognizes is an area that's really, really tremendously kind of under-innovated in and really challenging for consumers. So that's really, really exciting. You also see opportunities for tokenization around settlement. Right now, you think about payment acceptance, the only real innovation that you've seen in payment acceptance is the card networks. You think about it, people pay with cash, they paid, probably not anymore, with checks, and then with cards. The reason cards have been able to get to the level of scale that they have is because of the acceptance. The network has been able to proliferate Visa and MasterCard globally in a way where people know, oh, if I pull out my Visa card, I can go to any country in the world and I'm going to be able to pay there. But you think about stable coins, and all of a sudden you're in a world where acceptance can be solved like that, because you don't need an intermediary network to build the payment acceptance. Anyone who has the ability to accept stable coins, which is basically anyone, can all of a sudden accept payment from anyone, anywhere in the world. And so all of the settlement layer that happens between card networks, which many people don't see because it's all sort of disintermediated for the consumer, but there's actually 4 parties in every one of those transactions. It's the buyer, the issuing bank for the card, the acquiring bank, and the merchant. And all of a sudden, you just disaggregate all of those parties, and you've just got 2 people engaged in a commerce transaction and settling instantly. That's tremendously important and also compelling. And so I think stablecoins and tokenizations are going to be the tokenization of all real-world asset is going to be the place that you see really incredible uptake in the next couple of years.
I'll piggyback on that. In the context of tokenization, there are, I think, still questions whether CBDC should use blockchain technology or not. I think what we're seeing are use cases validating the value of that particular technological definition when it comes to tokenization. Being able to take a real asset represented virtually in a way that can be trusted, in a way that can be audited, in a way that can be traced even for the purpose of trust and reconciliation, you can also see how not doing that would be obsolete in 10 years. By the time you roll out a solution, a CBDC that is not tokenized, I think there's a big question around what will that look like? Will that be interoperable with what we know is already coming? And what I like to say is that the reason we're even talking about CBDC is really because of Bitcoin, right? Showcasing what blockchain can do, but also a bit of fear when it comes to Libra coming in, right? We can be honest about that. So if the fear is tokenization and the unique value and properties that blockchain brings, I think it would be a waste of time to say, let's do CBDC, but let's not use blockchain. Then what problem are you really addressing? And some questions come up on, is there really a need for CBDC? We have cash already, or the money is digital already. I think tokenization is very important, but it's going to take time, because what tokenization also means is that the same way we had to build the infrastructure for cards and for ATM and the broad ecosystem to adopt QR code, for example, I think you're going to see some integration into legacy channels, but the infrastructure and the interoperability still needs to be built, right? And that's the journey that we're on now. Yeah. 1, tokenization. 2, being honest about what it takes to provide and support that, with a clear understanding of the benefits and the risks of that. There is a risk of having a 24/7 financial system, guys. There is a real risk. We go to sleep at night and not thinking that anything is going to happen. And then you wake up and the balance that you went to sleep with is still there in the morning. There's a really good chance now that it's going to change.
We don't need any more drama.
So let's get ready. I think it's part of it.
Olivia, do you have anything to add?
Just to add a bit, and echo remittance is definitely a very clear use cases when it comes to stablecoin. It's a no-brainer almost. And tokenization is really picking up. We at Laser Digital in a relatively fortunate position in that we are a subsidiary of Nomura, a global financially regulated institution, but we act as the crypto native arm for the bank. And so we face counterparties very active in the crypto world, but we talk also to traditional financial institutions and regulators. And the demand for tokenization is real, especially when it comes to, interestingly enough, traditional financial assets, for which maybe distribution is more challenging, instant settlement is not possible, transparency is not there. And so we are active, and some of the clients and parties we work with also very active in moving that goal. And that's the demand. I think that's what's really going to drive demand for stablecoin or CBDC. I'm not sure actually which one is more relevant here. Regulated stablecoin does the job as well as a CBDC, I believe, but you need to go on-chain somehow, because if you're not on-chain, it's not possible to transact. And the way you transact in capital market for those kind of real-world asset and tokenized securities is extremely interesting. You then bring Web3 use cases to this world. You provide ability to offer liquidity through automated market maker. And so you can provide a lot more asset for which you can offer a price. And then if you add AI on top of it, you have the ability to create new assets, digital native asset using artificial intelligence, but also importantly use AI to make sure that you reduce your risk when it comes to cybersecurity, you improve the auditing of a smart contract using technology. So I think the confluence of those two trends is going to be extremely important and is going to drive a lot more, again, either stablecoin, regulated stablecoin, or CBDC. I think it's interesting maybe to have a debate around which one offers the most value for financial institution. For us today, there's no CBDC, so there's nothing to transact on, but we need a way to go on-chain in a safe and compliant way. So the likes of Paxos and Circle here are playing a key role. But if you're not able to do that, a lot of the efficiency that you'll get from Web3 models will be difficult to achieve.
So it's interesting, the conversation that we've had so far, which focused a lot on CBDC, we focused on stable coins, primarily from the crypto space. What about crypto more broadly outside of that context of just stable coins? The question that everyone is asking with everything that's been going on over this last year, does crypto have a future in payments? Carmel, you mentioned Bitcoin as being this animating idea, even behind CBDC. What do you think is the future of crypto more broadly? What kind of contribution does that have to make? And Mina, I want to get you in, as that conversation progresses on the regulator's perspective here, in terms of what role the regulatory system can play, to flourish or otherwise to guide the development of crypto. So, Ben, perhaps, in the space that you occupy, what do you see as being the future of crypto? Is there a future for crypto in 2030? What will it look like?
It's a hard question. I think that that Bitcoin really set a standard for transferring value, which I think continues to endure today. And then you saw sort of an evolution of that with Ethereum, where you had an efficient tracking and transfer of value, but then you had the ability to then add programmable smart contracts so that you could do so in a very specific context. And there's a real value proposition that's been shown by, I'll say, those two assets in particular. But then what you're starting to see is that there are other blockchains that have other value add propositions like Stellar, Solana, things that have higher throughput, are allowed to sort of, I would say, evolve those original use cases into something more effective. So I still think that there's value there, but if you zoom out a little bit, I think what crypto has shown is that people want control of their assets on a 24/7 basis. They want to remove intermediaries from that value transfer, and they don't want sort of financial services to exist within a walled garden. And so I think that's a movement that absolutely is going to continue. Whether or not specific assets are going to endure, or whether or not, kind of what form they take, I think is hard to say at this point. I think Bitcoin has shown that it's quite resilient over time. I think Ethereum certainly has entered the mainstream in many ways and is now regulated directly by the NYDFS and others. So I think the regulators need to play a big role in kind of overseeing these assets, making sure that when they do get adopted by traditional financial institutions, that they're done so with oversight. But I think the kind of ethos of crypto and the shift of control and ownership of money away from a system of kind of very few intermediaries to a more democratized version of finance is going to be what endures going forward.
And so, what do you think about that? Ben spoke of this world without intermediaries or fewer intermediaries, very global. What's the role of the regulatory system here as from your standpoint, as someone that works in that, from that standpoint?
Thank you, Isha. Let me introduce regulatory initiatives to crypto assets and stablecoin in Japan. So last November, the major crypto asset exchange FTX collapsed, and this shook the confidence in the crypto asset industry. And I think it highlights once again the importance of the regulation to protect customers. And I think internationally there is much interest in strengthening the regulatory framework, but Japan already had a regulation in place, including strict segregation of customers' assets. Therefore, even after the bankruptcy of the FTX, it's Japan's subsidiary, FTX Japan, successfully protected customers' assets. And the customer have had access to their funds since February of this year. I think currently we are in a difficult situation, also known as the crypto winter. And it's also difficult to predict future trends. But I personally believe that in Japan, sound regulation has created an environment conducive to challenging Web 3.0 innovation. In Japan, a law of stablecoin was also introduced in June of this year, allowing banks and other financial institutions to issue stablecoin. One of the purposes of the law is to protect customers, enabling institutions to meet redemption requests from their customers through preservation of underlying assets and segregation of customers' assets. It is reported that some regional banks are planning to issue stablecoin. One of their background is to create a cutting-edge cashless payment region. And another financial institution is considering to use stablecoin for business-to-business payments. And from more broad perspective, improving the efficiency of Japan's society is quite important for us because we are facing aging society and Japan's population is declining. And the Japanese government want to be open to innovation with emphasis on dialogue with their industry. For example, when there are questions about regulations in Japan, Financial Services Agency in Japan has support system in place, including help desk, which provide free regulatory guideline to clarify the regulations. There is also a sandbox system where firms can test their innovative idea. Thank you.
Japan's making the rest of us feel really bad. So, so we have 3.5 minutes. We've got 4 of you. Let's kind of end on this note of the, futurizing. Let's look to the future. Let's, be futurists for 3 minutes. What are you guys most excited about for this next decade? What big development, regulatory policy, innovation, what are you most jazzed about for this decade to come in payments, and why? How do you see our world changing through payments? Your 1 minute hot take.
I'll start. So I think by 2030, we'll be in a world where you'll access your online account using a digital identity that could be represented by a non-fungible token or something similar like this. On your wallet there, you'll receive maybe your, depending on countries, your UBI, your universal basic income from the government directly in the form of some kind of CBDC. And then you'll change that for crypto asset and transact in the metaverse and buy, sell stuff there. And I think that's potentially a world where by 2030 we'll see maybe different trends happening there.
Awesome.
I mean, I think it's not as impossible as we might think. I personally believe that everyone deserves access to an inclusive and sound financial market. Money impacts everything in our lives, and everyone deserves access to that. How do you make it inclusive? Being able to use, like we say, tokenization and building infrastructure that makes that possible, where someone, even without a bank account, can access good financial products. Yep. That's definitely one goal for me. The second is it needs to be sound, and what that means is regulatory environments that not only protect consumers, but also understands that there is a need for innovation for finance to be inclusive. So that combination is really a space that I'm spending a lot of time on and working with regulators on. How do you develop, how do you leverage technology to enable you to be a better regulator and balancing innovation and regulation?
Yep.
I think for me, it's platform and asset interoperability. So like a world where I can send you money from a Paxos account to your JP Morgan account, and that all happens seamlessly because blockchain underlies the technology. And then when we want to engage in some kind of a transaction, I send you a token for gold in exchange for a token for a share of Apple that you have. That, I think, is a very exciting world. Right now, that's completely impossible because of the way that the intermediary system is set up. But when you have asset and platform interoperability, you give people just a tremendous amount of freedom. And I think you open the markets, to your point, about sort of giving people the ability to really build wealth and transact in the way that they want to, not on the terms of the institutions, but on the terms of individuals. That, I think, is an incredible future.
Mino, you have the last word.
Yeah, that's right. And digitalization has advanced at home and abroad, of course, in various areas, including the field of the payments. In particular, I think the expansion of the cashless payment is remarkable. I think this trend will accelerate rather than reverse in post-COVID-19 era. And in Japan as well, more devices such as smartphone and IC cards are available for the payment, as well as many fintech firms have become involved in providing cashless payment services. I personally think that the cashless and digitalization of the payment are going to be more and more penetrating into the lives of the Japanese public. Thank you.
Incredible. I told you guys these guys were awesome. Thank you guys for this incredible conversation that we had. Thank you all for listening, and I'm going to hand it over to our next fabulous panel. So thank you guys so much.
Our next panel is on how can technology transform money for the better. Our moderator is Daniel Gorfine, founder and CEO of Gattaca Horizons and co-founder of the Digital Dollar Project.
It is so difficult to follow Yeisha. I mean, my energy levels are going to need to be like 3 shots of espresso higher here, but I'll do the best that I can. So I'm Daniel Gorfine. I'm a co-founder of the Digital Dollar Project. And as such, I'm so thrilled to see all of you here for this conference. And I do want to specifically thank the Digital Dollar Project team under the leadership of Jen Lassiter and our partners at the Atlantic Council for all of the work that went into convening this conference. So what I'm going to do is give a little bit of a quick historical context as to why we created the Digital Dollar Project to help introduce the panel. And it's really set in a deep belief that new technologies can and will improve global payment systems. And these same technologies are going to impact how we transact in all types of financial assets and instruments, including money itself. So for that reason, our panel here is titled, How Can Technology Transform Money for the Better? And this is a question that we've posed, and I have an excellent set of panelists to help answer that question. So what I'm going to do is as I pose questions to each of you, please introduce yourself briefly. And what I want to do is talk first about the pace of technological change and how that is impacting payment systems. So Tim, I might start with you. You've been involved with both banks and central banks. How do you view this moment in time in terms of technological impact on payment systems?
Well, thanks, Daniel. Tim Davis, I lead the advisory blockchain digital asset practice at Deloitte. There's a tremendous amount of technology innovation happening right in the background. So as we're talking about CBDCs and payments innovation, it's not divorced from all the other innovation that's happening in the world. And one area of innovation that you mentioned in particular that's having probably the most transformative impact is AI. And I think we need to make sure that we're appreciating the impact of AI on the decisions that we're thinking about relative to digital currency, because these two are not divorced. And the reason I say that is in terms of AI innovation, the last 6 months have been absolutely unprecedented in terms of improvement. And take what you will from some of the quoted metrics, but it's a technology that learns about 1,000 times faster than humans can learn. Its capability doubles every 90 days. And so so we're very close to being at what's being referred to as commercial agency. So AI right now does not have the ability to do much for you in terms of commercial transactions, but we're very close. So think of a situation in which you accept a meeting for a dinner in New York, and your AI says to you, Daniel, I see you accepted a dinner in New York 2 days from now. Would you like me to make those travel arrangements? And you say, yes, I would. It'll say, are you going to stay over in the city? Yes, I will. What's your budget? I'd like it to cost no more than, say, $700 for the travel. AI goes away and makes those arrangements, books the flight, if need be, has a car waiting for you at the airport, depending on travel, to make sure you get to the restaurant in time for your 7 o'clock dinner appointment. Books you in a hotel that's walking distance from the restaurant. So it makes all those arrangements for you. That level of sort of commercial agency we haven't seen yet, but I think we will see very shortly. And obviously, as you think about what that means relative to digital money, AI can do things with regular fiat. So it can fill out the web form and actually make those arrangements in the traditional sense. But it really becomes a superpower in the sense of digital money and Web3 money, where money travels across the internet. Now that comes with great danger and great power as well, but it's happening. And so I think we just need to recognize that AI is going to have a fundamental impact on how we use and think about digital money going into the future. And I would say you shouldn't have a CBDC strategy without also having an AI strategy that goes hand in hand, because AI is going to have an impact both for the good and innovation, but it's also going to represent some of the threats that have to be managed relative to the security and integrity of AI systems, of digital money systems. And so I think we have to understand that because AI is improving its innovation at such a pace, digital currencies have been on a slow arc of innovation and has been very sort of managed and slowly considered. It's getting so outpaced by the pace of AI innovation that I believe it's quite possible that AI will actually drag forward digital currency adoption as we see more AI use cases. So that's why I see the two being intersected.
Yeah, it's this world of open and kind of interoperable networks that I think we'll get into a little bit further. So Noah, let me turn to you. You come from Israel, where they've been at kind of the forefront of digital asset innovation Where is your research taking you? What are you guys bullish about when you look at this technology?
Okay, so I'm here representing a country. I think it's different than other people, so I'll try to be careful with my words. But Israel is a very unique place, I think. We lead the technology side of fintech, as well as other technologies. But if you take a look at the use of digital money in Israel, it's almost non-existent. I don't know if you know it, almost nobody is investing in it. I'm talking about maybe a couple of thousand people with the states of millions. Almost no businesses use these kinds of currencies. And there's a reason for it, in our opinion. I'm Noah Hacker, I'm the Minister of Economic Affairs and the Israeli Embassy here in DC. I represent the Ministry of Finance in Israel, from Israel in the United States. And we see the problem very clear. And the problem is the existing financial system in Israel. We have maybe a handful of banks that control all the market. We're talking about more than 70% of credit, all the bank accounts, of course. So that gives them a very big competitive advantage. And we've been trying to create competition in that sector in Israel for years. Some successes, but not significant. And I think we see this technology as our chance to change our system and create what we have been trying to create for many, many years. I'm talking decades. Stable, healthy competition in our financial system. And we really see that as a chance. And that's why we're not waiting for any other technologies or any other regulation to evolve. We have to work fast. And I think in the last year, you can see in Israel a very big change. First of all, we decided on a framework. We decided how we're going to approach regulating this field, which will be, first of all, the first regulation that's going to come out is favorable ones, trying to help this market evolve in Israel. And of course, it will affect our companies around the world. Lowering barriers for these kinds of companies, these kinds of assets. I think that's what we're focused on. Of course, we see the great risks also, but we understand that there are risks and we have to address them. We have to help this market evolve. And so we created our model on a base of our estimate of the risk. So for the beginning part, will be more competitive regulation, and it will be run by the Ministry of Finance, not the central bank. And then when we see some company or some platform reach a higher level of risk, then the regulator will change. But we haven't established the specific details of that. But that's the framework, and we're working towards that. We really see this as an opportunity to change our market for the better.
Saima, let me come to you. You know, one of the use cases we hear about a lot with CBDC or digital assets is the cross-border payments and remittance space. You come from Remitly, a leading global provider of remittances. Talk to us about how that space has evolved based on technology over the last decade or so, and what are you doing with technology to already solve kind of real-world problems that you hear from your consumer or from your customers?
Yeah, happy to. I'm the Executive Vice President for Legal and Risk at Remitly. And when we founded the company in 2011, our founder was really inspired by the inefficiencies in the cross-border remittance space. And to touch on a few, one, it was not particularly inclusive of the full range of people that were trying to send money. And as many of you may know, the vast majority of global remittances are sent through informal gray economy networks that are terrible for everyone, along a variety of axes, including terrorist financing, lost money, fees, all of that. And so that was one area that was terrible. Another area is, in general, it was very expensive, even in the formal economy. The average take rate or cost of a remittance in 2011 was 9%. So if you were sending $100, your recipient was getting a yield of $91, as well as speed, right? So it took about 3 to 5 days for a remittance from like a Western Union type player to reach its recipient in 2011. So those were some of the problems that we set out to address. And there has been a proliferation of digital remittance players, and Remitly is proud to be one of the leading ones among them in the last 10 years plus. And the global take rate now has come down to around 6%, and Remitly's is in the range of 3%, and we're on track to meet the UNDP development goal of 3% by 2030. And so that's the overall landscape. Where we set out in the early days to focus was on a few things. Number one, there were options to take money in digitally. And most of the players were taking only cash in, but most people were already in the banking system or had a credit card, and that allowed us to get rid of the agent network and bring down costs. So you don't need to have a storefront, and that's the story of a lot of technology players in the last 20 years or so. The second thing we did was really take a look at our KYC and identity verification systems and say, where can we apply technologies, digital searches, and things like national identity databases that are starting to exist outside the United States and developing markets in particular, to make this process faster and easier for our customers. So that has significantly brought down the cost, as well as allowed more legitimate people to enter the system. And then the third area that we look at, which might be most relevant for the discussion today, is taking a look at where we can address the many, many intermediaries involved in sending money from point A to point B internationally, and saying, where can we apply leverage to reduce costs and delays in the system. So 70% of our delays in delivery really exist or occur in the recipient network. So when you're trying to send money from the United States to the Philippines, you run your compliance process in the United States, but then you have delays on your recipient side in like with BDO Bank or whatever it might be, because they run their own compliance system. So where we can apply technologies to really integrate directly with national payment systems, that has a huge benefit for our customers. And so we're looking at taking that 5-day delay down as low as we can, because that makes a huge difference to recipients. So when you're talking about global remittances, 70% of those recipients are using those funds for necessities, right? So we're not talking about like vacations, we're talking about medical fees, we're talking about school fees, rent, groceries, and so timing really matters. And so we were able to bring our delivery rate to over 90% delivered within an hour or less. And so that makes a huge difference to working people who are, especially working class folks that are getting their paycheck on day one, and they really would love for it to be delivered to their mom or their wife on the same day.
Great. And so, Michael, last but not least, you've worked, some really important and fascinating jobs, both public and private sector, and you've always focused on the impact of technology and kind of the plumbing that underpins payment systems and money itself. How do you view this moment in time? What's exciting to you about new technologies?
Yeah, I think, most relevant to this was the former acting director of FinCEN, which is the US Financial Intelligence Unit, and then also was general counsel at a cryptography company building configurable private computation. And I think what's most exciting is sort of the convergence of the mathematical optimizations of cryptography, but also the computational speed that is now far more democratized, that we all have a massive computer most of us in our pockets in some form, that allows basically what Simon is describing to happen. We don't need switchboard operators to connect financial intermediaries and financial transactions at every step. That means more speed, just like we don't have to wait for the switchboard operator to pull a plug out and put it in another. But it also means, from a security and from a privacy standpoint, we no longer necessarily have to call the switchboard operator, say, my name's Daniel Gorfine, here's my social security number, here's my date of birth. This person out there is writing all this down, checking an OFAC list, checking another sanctions list, other high-risk things, and writing it all down and putting it on a piece of paper that we hope shreds at the end of the day or takes care of. And instead, we could have an exclusion proof, which is zero knowledge, basically where a transaction is sent, it just immediately checks without sending your information to the switchboard operator and just says Daniel is not on the 5 block lists that you set up, nobody actually really cares what your social security number is or your date of birth. It's somewhere if it was needed. It's not sent around to 20 different places, and this transaction can go through seamlessly, also while putting you at less risk.
Can I follow up with you on that? I mean, I think people hear these terms, these privacy-enhancing technologies. How real is this? How close are we to being able to scale this for real-world purpose?
Yeah, it's a good question. It's close. It's very, very close. I mean, I think the math of the zero-knowledge cryptography is there. I mean, we have Zcash, for instance, and other even wrappers that we were building that would take any Ethereum address, an asset, and could wrap it to make it as private as Monero, but is absolutely verifiable as USDC is today, or any digital dollar, basically. But the math is there that the speed of transaction could happen. And certainly you could be at a grocery store at this stage, go in there, buy a bottle of beer, and they say, are you over 21? Instead of saying, yes, here's my date of birth, my eye color, and my home address to whoever you are, it would just verify that you were over the threshold of 21 and move on.
I would just say, please, Daniel, the problem is maybe not as much on the technology, because I agree with Michael, it's very close, both in terms of the scaling of these chains as well as the technology. The problem we have is we don't have a global policy framework around how and when there needs to be this limited disclosure of these sort of privacy technologies to solve various sort of regulatory requirements, right? And because of that, it's just sort of being put into the no-fly list, right? It's like if you're using those kind of technologies, then you must, the assumption is that you're up to no good, right? And so somehow I think we do need to evolve the global policy debate to say there is value in this technology, but it's only in the context of when we sort of can agree as to when there needs to be appropriate disclosure, both for law enforcement, but also for compliance reasons. And the technology can absolutely do that, but there's just no agreement on how that
I think it's hard for policymakers and regulators to wrap their heads around the fact that a technology that's being used for pure anonymity and causes issues in that sense could actually be the solution in finding like the right balance for future systems. I mean, since we're on this topic, Noach, I'm going to look at you. Is this something that you guys are exploring as well in terms of privacy enhancing technologies? Is that part of the conversation?
Look, you're talking to me today after we experienced the hardest day of our lives. And just a couple of weeks ago, we're not talking years or decades, a couple of weeks ago, part of the funding that was used for that horrific attack on our civilian communities just a couple of weeks ago was digital money coming from these platforms. So, we're Israelis, we're very into technology. We're very technology oriented, but I agree that it's a global effort. We see it happening these days. Actually, these days, there's a task force created yesterday between 12 intelligence bodies in 12 countries, from United States, Europe, and others, and Israel, of course, to fight this terror funding. There was a statement by the UK that many joined on the OECD initiative for transparency. It relates more to taxation, but we see it as a good opportunity to address also other things. And I think we are open to technologies, but we need to understand the risks. And as I said, we see this as a great opportunity, and we're not going to miss this opportunity. But in order to enjoy the benefits of this opportunity, you have to address the risks. So until we know in a very certain way that we're addressing those risks, I think we'll have a hard time. We'll have a hard time accepting it. And the other things I have to say, I know some of you are executives in your companies. I think what we saw from the United States in the last week of holding companies accountable for their actions, I think that's another thing that we see very favorably. So let's see if the companies really believe in these systems, to protect them from that, from the authorities on that matter. So if we start seeing those signs, I think we'll be more open to it. But our risk is very clear.
I want to come back to pain points and kind of real-world friction that we're trying to solve for. And Simon, I might come back to you to kind of go a level deeper as well. I mean, you have a background in FX markets, but from a consumer perspective, what are the friction points we're trying to use technology to solve for? Can it enhance transparency? Do you see opportunities to increase speed? And can it improve markets, FX markets, which are really important to the work that you all do?
Yeah, so I think all of the above, right? So I think in some of the cases that I touched upon that we're largely ahead of now, technology could massively increase some of the like threshold access points because there is this digital onboarding, right? And that I think is pretty clearly available to everyone now. Everyone knows how to get into a wallet and off a wallet. There's people that could be included further. But I think to your point on FX, there's a huge part of what we're trying to deliver is more speed, instant real-time payments, right? And I think that there's multiple layers of barriers to real-time payments. Some of them are, it's really important to disaggregate them and say how many of them are imposed by governments and agnostic to the technology. That friction is there, it needs to be there, and we need to use technology to find ways to meet the government's objectives so that we can get faster. Because the problem isn't, just to talk for a little bit about the background, we could do a real-time payment anywhere, anytime, right? There's already pooled correspondent banking accounts in, all over the world. The issue is not that the money isn't there. The issue is that the forecasting may not be there to have the right pools in the right place at the right time. The correspondent bank may not want to take the credit risk on you, or the correspondent bank may not want to take the compliance risk. So we have to use technology to address those underlying problems. And on the FX side, some of the credit issues and access issues that arise occur with rolling time zones, frankly. It's just the bank, our banks close in the United States at whatever time on Friday, and we have a forecast for how many transactions we're going to have coming in through our pipes over the weekend. We have a forecast. Sometimes it's wrong because sometimes something happens, the currency moves in the aftermarket trading or whatever it is, and you get more orders than you anticipate, more transactions than you anticipate on a Saturday or a Sunday. Now the State Bank of India has to make a choice about whether it's going to disperse funds for you when you may have $1 million sitting in that account, but you have orders for $2 million in disbursement. And so where we have access to real-time payment networks, where we have access to national banking systems directly, we don't get caught in those rolling closures. We can have real-time disbursement. Our forecasting doesn't need to be as accurate. It can be the transaction itself that drives the settlement. So that settlement closure, that closure of the settlement delays can have massive benefits for consumers getting their funds more quickly and accessibly. So that's really a huge area of focus for us. And then wherever we can use real-time payment networks within the banking system to get that 24/7 cycle, that again has those same benefits. So what we take a look at really very closely is how do we optimize now and how do we plan for the optimization later? Because obviously in the United States, I don't think the Federal Reserve has approved anyone yet that's a non-bank participant under the final rules that came out last year. And in our distribution networks, there's still quite a few hurdles to that, although it's getting closer and closer. And one of the things that we would love to see is more international alignment on what are the qualification standards for those national payment system integrations for non-bank participants. It could have huge benefits for the type of users that we serve that are trying to send and receive small dollar remittances for necessities around the world. And just to take a step back, to, I guess, show my bleeding heart for a second, the global volume of remittances from the developed world to the developing world is the single largest net transfer of wealth that exists in the world. And it far eclipses the volume of international development aid, foreign direct investment. It is the single most powerful tool that is crowdsourced for global development. So decreasing the friction in that, increasing the speed of it, decreasing the cost of it, improving the accessibility of that is one of the best things we can do for global poverty in the world.
So I'm going to ask each of the participants to weigh in on this as well. I mean, Noach, maybe I'll start with you and then we'll work down the line. But when you think about pain points that CBDC may solve, potential stablecoins, digital assets, what are the pain points that you're focused on? Is it retail? Is it wholesale?
I think, as we just heard, one of our biggest issues, Israel is a country with needs of a lot of investments, a lot. We're talking about a country that doubles itself in every 15, 20 years with our growth rate. And we struggle with those money transfers. We struggle, we see it, we hear it. I hear it here in the United States from many investors want to invest in Israel that struggle with the current banking system. So we see that as something essential that we have to achieve. As I said, we're looking at the opportunities. Other things, as I said, the great opportunity in Israel, it's even greater than the United States, because here people know about it, people understand it, the system works, you have more use of these kinds of abilities. In Israel, we're very far behind. We're very ahead in the technology, but in the use in Israel, we're very behind because of our current banking system. And there's our antitrust authority just issued out a couple of months ago a report on how the current banking system is using claims to prevent terror financing and crime in order to prevent fintech companies from entering the market to compete. So I think we have, and we see it as a part of, not only in Israel, but many countries now struggle with the cost of living and inflation and things like that. This could have a real impact on cost of living in Israel. And I think that's the benefits we see. We're addressing the risk, but we can't let the risk prevent us from achieving the opportunities. So I think we're looking about lowering costs. We already see the current banking system using some blockchain technology, but it's not the same. We want the fintech companies in the competition, and again, it will hire investments in Israel and reduce costs and create growth and develop technology, new technology, not only for Israel, but for the entire world.
Tim, let me come back to you on same question. With the work that you're doing with global central banks, what frictions are they trying to solve for? Are you hearing more on the retail side? Are you hearing it's more about wholesale application?
Just to sort of step back, I think I recognize there is this fundamental competition going on between the innovation that Seema referred to, with citizens desperately looking for cheaper, faster mechanisms, and central banks trying to bring a level of sort of thoughtful control, right? And you've got citizens that are going to private money solutions to give themselves the solutions they're looking for, that oftentimes maybe don't have the right set of regulatory oversight. So we're in this space where if central banks don't move fast enough, citizens will move faster to private money solutions with all the risks that creates relative to the singleness of money and the trust in the single sort of issuing entity, right? So I think we have to recognize we're in this competition. Just to kind of go back to, I think, what Seema was saying, one of the, from an enterprise standpoint, the huge amounts of money that are locked in various payment channels in the current financial system is huge. And so being able to bring money to more real-time movement increases the velocity of money, dramatically reduces the cost, so that the velocity of money plus the increased time, reduced time to settlement, there are definitely savings there for institutions. On the customer side, there's dramatic savings if you simply are just moving money from one digital wallet to another. The problem that a lot of consumers have is they may have some stablecoin sitting in a digital wallet, but then it's like, well, what do I do with it? I don't have any way to actually use it. I think if we see more adoption of private money in digital wallets, you will see more e-commerce solutions emerging in countries that take advantage of the money that is sitting in those wallets. So you will see more e-commerce providers saying, I will give you the option to use money in your Web3 wallet on my e-commerce site so that you can take advantage of those funds.
Can I ask you, what rails do you see underpinning that system? Are these going to be open public blockchains? I mean, I heard reference to, the banks have blockchains, but these are permissioned blockchains. You're describing a very different world. Can we delve into that a little bit?
Well, you're exactly right. And this is some of this competition where you see consumers moving to stablecoin systems that are based on permissionless blockchains, right? There are absolutely net new novel risks in those systems, right? And we do not yet have global standards that I think we absolutely need to sort of set how do we govern these permissionless systems? And what is the agreement on security, sort of a corporate governance, but governance over the acceptable distribution, the resilience, the stability of these permissionless systems. We do need that, right? But consumers are migrating to these solutions because it's giving them a solution here and now, right? And so the challenge for central banks and governments is to try and catch up and to agree to develop a global framework on how we set those standards so that we can see a transition and an eventual reconciliation. If we don't, we will see consumers migrating to solutions that are increasingly apart from where central banks want them to be and believe them to be. And then it becomes sort of a compliance nightmare where you're trying to ban those kind of solutions, and yet consumers are trying to do it sort of,
And I think you've kind of nailed the premise of this conference, right? Which is that these rails can transact all types of instruments. They could be CBDCs, it could be stablecoins, could be cryptocurrencies, it could be other types of tokenized assets. But those standards need to apply to these new rails, these new systems across the board, right? Regardless of the asset that's being transacted. So, Michael, let me come back to you, and we've talked a little bit about wallets, and I will go do a little bit of a deep dive into self-hosted wallets, which I don't know that folks really have wrapped their heads around, like the implications of things like self-hosted wallets. I mean, if we have tokens, which are digital bearer instruments, it allows me to send from my wallet to your wallet, but it's something that you could manage. How does that fit in a world where we worry about financial crime, terrorist financing, and does this kind of tie in as well to the privacy enhancing technologies that we're talking about?
Yeah.
You notice I asked like 5-part questions.
Yeah, thank you. Thank you.
The problem.
So one of those I'll be able to hit, I think.
Pick your favorite.
No, I think it's a really important question in part because like even just thinking about what is a wallet, it's a lot of different things, and I actually spent a lot of time in the last administration with Secretary Mnuchin discussing what is a wallet. Like it means a lot of different things to a lot of different people, and I think part of it is that, for better or worse, we brought people into Web3 and crypto using relatively financial concepts and terms because it's an immediate pain point, as we've all discussed, and it gets people in, and it's brought in like a tremendous amount of brain power of both economists and developers, engineers, and straight cryptographers that have made some incredible advances. But a wallet in itself is really a key management structure. So, and it goes back to earlier cryptography, but it's really, I almost think of it more as like a 1Password or a keeper. It's a password management to access data that's on a public ledger that's private and kept secure. So from a consumer protection standpoint, there's a lot of risk in that if you lose your master password, you lose it for real, because that's what makes it so cryptographically secure.
It's like losing your physical wallet.
It's really like losing your physical, well, it's not even that, it's really like losing your physical wallet and the keys to your car and the keys to your house. Mm-hmm. Because it may not just be money, it might be actually, this is how I access an NFT that lets me get into a room. Or a conversation. So it truly is a password. And so it is not just money. But I think it's also really important in all the sort of de-risking conversations that we've had, that this is also a way, banks, there was just a settlement for one major bank that for like 6 years was just outright blocking anybody that had an Armenian name. And I think they paid, I don't know, hundreds of millions of dollars or something. They just determined that was a risk, and that was it. And so if you're just, someone that escaped an Armenian tragedy and came here, you can't get a bank account. Or, you had one and suddenly you can't pay your mortgage because someone has made that decision. There's a resilience to that that allows you, or if you're in Ukraine and suddenly have been invaded and you have to get out and your bank is now occupied. You know, even early OFAC was actually based on protecting foreign assets as the Nazis were going into other countries like Denmark and occupying them, so that OFAC actually said, freeze the assets in the US so that the Nazis can't repatriate that back. We want people to have their own money. And I think on some level, this is a modern version of you should be able to custody your own assets. There have to be risk management, as we've all discussed. But I think, as Simon said in the very beginning, the more people you bring into the legitimate financial system, the tide goes out and it's easier to spot the terrorist financing, because right now a remittance in many ways is noise that you can't tell, is that actually somebody sending funds they shouldn't be, or they're actually just, they've been debanked because they don't have certain static documentary evidence, which now there's a lot of other activity-based risk indicators that we can use. And I think that's part of the recalibration that some of the technology advances allow us to be much more granular around a composable digital asset, whether it's a CBDC or a stable coin or anything else, is that you can now say, you know what, buying groceries is not the same as buying a condo in Miami. We actually don't need 3,000 data points and 50 years of history. If I talk to someone who just came here from England and doesn't have a credit history in the US, but can't get a loan that's needed, well, we can calibrate that in a much more granular way based on thresholds, because the money's programmable, and then a remittance that's $50 really can genuinely be treated in a risk-based way that is different than a condo in Miami.
So Simon, maybe I'll come back to you, and I'll only give you a two-part question. I mean, I don't know if you have a response on anything around digital wallets and de-risking, but the other thing I would ask you is, as a remittance provider, you know, what would need to be true about a future CBDC design to make it compelling? Because you're already using technology to solve a lot of the problems identified. What would need to be true about that design?
Yeah, I think I have so many views on so much of what's been said.
I saw you nodding pretty vehemently in agreement.
Yeah, I'm trying to think about what I'm going to answer your question. What would need to be true about CBDCs before it's really meaningful for our customer? I mean, the first thing is merchants have to accept it. Merchants have to accept it. So a lot of conversations around tokenized payments or digital payments say that they will be, you know, they are significantly less expensive. And what we found for our customers, and we actually have experimented with using some crypto to move funds. What we found is for our customers, it's actually not cheaper, because they have to convert it from fiat into crypto to use it, and then they have to take it from crypto back down into fiat to use it, you know, on the recipient side, right? And so until that friction is eliminated, until people are carrying crypto in large amounts or other forms of digital payments, or currency rather, in a wallet, and then their recipient can actually use that currency at the local bodega, at their school, to pay fees, to pay rent to their landlord, the net cost is actually higher, because that conversion adds a step. And just the simple math, and I am not capable of overly complex things, so I boil everything down to a simple, you know, framework I can understand. The more steps you have, the more cost you're going to have, because everybody needs to get paid.
Yeah. And so, Noah, let me, Tim, did you have something?
Well, I was just going to, I mean, in this age of the empowered consumer, the one thing that has to be true, really, for private money and public money solutions, is a level of trust, right? And there is some distrust in private money solutions, but it's just better than the alternative. But this is true for central banks as well, is the citizenry has got some range of level of trust in the central bank based on the existing fiat that they're offered and how much it inflates, how much it can be trusted. And so simply by tokenizing that, you're still operating in this regime of the level of trust that the citizen has with the central bank. Now, just because it's a tokenized version of fiat, you may actually then have to compound additional considerations like, well, how private is my data? Is the central bank, the government, going to use this in ways that are adverse to my interests, right? So you've got additional trust weights. But just simply to say, I mean, evaluating the level of trust you have with your citizenry is kind of a key starting point, right, relative to how successful we're actually going to be with anything we launch, regardless of the level of, but there has to be utility too, but almost regardless of that.
Absolutely. One thing I want to come back, Noah, something that was raised earlier is who has direct access to payment systems, to central bank payment systems. And we've, there's a bit of a push globally, it seems, for non-banks, for regulated non-banks to have that access as well as banks. How are you all thinking about that? Is it something that you're opening up to say that specific regulated non-bank payments companies can gain access? Or is that something that you're keeping kind of to the banks themselves?
So first of all, you're going to have here tomorrow a representative of the central bank in Israel, and he's going to give you a different answer than me.
Excellent.
Because they look at things a little different, as we said. Before I answer your question, I want to address another thing that was said here. You talked about a competition between the private and the central banks. I think there's also a competition between countries. It's not only, it's what central bank, or let's say more trustworthy central bank, issues out the first digital currency. I think that's going to be a very big issue going forward. So putting that aside and addressing the question, of course, our objective as the Ministry of Finance that we want to help the competition grow. We're looking at favorably. The central bank sees things different. I think our regulatory framework that when we do decide on what is the risk level that transfers the company or the platform from competition regulation to stable regulation, I think when we establish that, it will be easier. But for now, we're a little divided in our answers.
All right, I'm being told I have to get us back on track time-wise, but I'd be remiss if I didn't do my famous or infamous lightning round. So some of you know I'm doing this, some of you don't, but here's what's going to happen. I'm going to make a declarative statement, and I'm going to give you, Michael, I'm going to give everybody, 2 song titles to either note your agreement or disagreement with my statement. I'm going to go down the line, so unfortunately, you're first to go. So my first statement here is most of the world's largest democracies will have issued a CBDC by 2030. Don't Stop Believing or California Dreaming?
California Dreaming.
I would say Don't Stop Believing.
You know the lawyers by their responses.
Yeah.
Don't Stop Believing.
All right, Noah?
Well, I have a problem because then they're going to say, Minister of Economics from Israel, like,
all right, we'll
said that by 2030 we're going to...
I'll give you a pass, but I'm going to make you answer the last one. So the last question, global cross-border payments will be near real time, and the average cost of transactions will be less than the target global sustainable goal of 3% by the year 2030. Rocket Man or Fade to Black?
Oh, Rocket Man.
I think Fade to Black.
Oh, okay.
Wow. Rocket Man, all the way.
Rocket Man, of course.
All right, excellent.
You should fire me if that's not my answer. You should
Join
write
me
to
in
our
thanking
CEO
our
and
panel.
have me fired.
Okay, we're being ushered off.
I'm going first.
I just got the hook.
Okay, thank you so much. What a way to end. I love that model, Daniel. I have never seen that before, and now I'm going to adopt it. All right, it is coffee break time, a quick 15-minute coffee break. We come back at 11:15 for Cecilia Skingsley, head of the BIS Innovation Hub, keynote speech, and then in conversation with the economist Alice Fullwood. So fuel up, come back in 15 minutes. Thanks, everyone.
Ladies and gentlemen, please to return to your seats. The next session is about to begin. Ladies and gentlemen, please do take your seats. The event will begin in just a few seconds. Please take your seats. Thank you. Ladies and gentlemen, please welcome back to the stage Jennifer Lassiter, Executive Director of the Digital Dollar Project.
Hi, everyone. Thank you. Oh, thank you. Thank you so much. Welcome back. Thank you. That was a very prompt seating and quiet. I don't think it's for me. I actually think it's for our next speaker, who's delivering our first keynote speech for the day, and I'm very honored to be able to introduce her to you all. Cecilia Skingsley, head of the BIS Innovation Hub at the Bank of International Settlements and member of BIS's Executive Committee. As someone who doesn't need introduction, please allow me to provide a little bit of biography for your consideration. Previous to her role at BIS, Ms. Skingsley held the position of First Deputy Governor of the Riksbank, Sweden's central bank. In this position, she chaired the BIS Committee on Payments and Market Infrastructure's Future of Payments Working Group. She was the governor of the Riksbank's alternate on the General Council of the European Central Bank and a member of the Advisory Technical Committee of the European Systemic Risk Board. Ms. Skingsley was deputy governor of the Riksbank from May 2013 to November 2019. But prior to that position, she held various roles, including head of FX and fixed income research and chief economist at Swedbank. She was a financial journalist, head of financial markets section at Dagens Industri, and a macro analyst at ABN AMRO Bank. Ms. Skingsley holds a degree in economics and political science from Stockholm University. She received a financial analyst degree from SSE Executive Education at Stockholm School of Economics and studied journalism at Pappas School of Journalism in Stockholm. Following Ms. Skingsley's keynote address, Alice Fullwood will join the stage for a facilitated discussion. Alice is The Economist's Wall Street correspondent covering a range of topics about banking and the financial system in America. She's also co-host of Money Talks, The Economist podcast on the economy, business, and the world of finance. Please join me in welcoming Ms. Skingsley to the stage. Thank you.
Thank you very much for that very kind introduction, Jennifer. And thank you very much, Atlantic Council and the Digital Dollar Project. I'm just going to rebuild the structure here. I'm very agile, so that comes with the job. Okay, here we go. So it's a great honor to be here, speak at this fantastic conference about the subject of innovation and the possibilities that central bank digital currencies can provide. Thanks to Josh Lipsky for sending me the invitation, and hello everybody that participates online. So I hope to contribute to this discussion along two dimensions. First, I'd like to tell you why I thoroughly believe that the public sector must focus on innovation. And second, coming more to the topic of the conference, I'd like to lay out some of my thoughts around what this concept central bank digital currencies can and cannot do, and your task, or our all tasks, to developing international standards for them. Now, I'm a great fan of history, but I also know that we can really only call a moment historic in hindsight. But still, I'm taking the risk of saying I think we're going through and really an inflection point in history, one of these moments where the way we think about certain topics are changing in fundamental ways. Technological progress increases humankind's appetite for better goods and services, and in the example of money and payments, this means the appetite for transactions available 24/7 to settle instantly and be generally more available and efficient domestically, but also, importantly, across borders. And it's critical to get the right infrastructures in place to facilitate that. I think it's also fair to say that technological change is so fast and foundational that it alters some core concepts on how we think of the financial system. So here I think about the very notion of money as a social and institutional construct. We accept money, paper money, or in our accounts today because we expect that other people will accept it tomorrow as well. And this is a trust that hasn't come by itself. It's based on the institutional arrangements that have evolved over generations and have central banks working at the core of it. Sometimes you can hear claims, sometimes from within the tech industry, sometimes from without, that they can replace this framework of trust and functionality with algorithms and encryption. I think it's fair to say that the practical results have been mostly unconvincing so far, in the sense that all of us almost still prefer fiat money to pay for our shopping and our bills. But I think it's also fair that we need to pay attention. There are many technological ideas out there that have the power and the willpower, that there is a lot of potential. And two, if this is left unchecked, these technologies may develop into services used in our societies in a way that may not have the public interest as the first priority. I think very much of money as a public good. It's really sit there, up there, with the military defense to protect us and the law and order also to protect us in a society. It's a clever solution to make our need to make economic value portable. And traditionally, across the world, through a long history of hard-earned lessons, the responsibility has been assigned to central banks to make sure that the money that is being offered meets criteria such being a stable store of value and being an efficient medium of exchange. And central banks are, you could say, monopolists in the provision of money as a public good. I think about it as a starting point because it's really the starting point of an ecosystem. I think it should stay like that, but it's important that central banks, together with the private sector, think about how do we make sure it works and it meets the needs of the future, in the sense that we're all going in a more digitalized way. And it's just not a time to be complacent. There is a lot of heated debate around these questions. I think it makes sense, and I welcome the discussion, because it raises very fundamental questions on how we think about, on one hand, the state and the private sector. But the acceleration of the digitalization of our society is both good and bad. It brings new possibilities, but it also brings reasons for concern. And saying that I like history, I like to paraphrase what the French politician Georges Clemenceau once said about war and generals, which is that money is too important to be left a matter only to central bankers. So when it comes to rebuilding the current, but also possibly designing a future financial system, we will have to grapple with many complicated questions. It's about protecting people's privacy, choice, financial inclusion, stability, innovation, and also geopolitics, just to name a few. I don't pretend to have all the answers, but I'm absolutely convinced that we need to have the debate to reach some deliberate answers. I think central banks should be a part of that discussion as the ultimate trustees of the monetary system. Investigate, explore what the money of the future will look like. And also convinced that the current infrastructures in the financial system need to be upgraded to handle all these new kinds of demands that we see around us. Public policy objectives, such as protecting what we call the singleness of money, financial inclusion again, and efficiency again, resilience, they need to be met. And that said, I acknowledge the fact that different countries with different currencies approach this in a different way. The starting point you have in a particular country and the pace of transition vary, and also the ambitions vary from the industry and from the central bank and from the legislators. And that's fine. We are different as human beings. Our societies are different. We approach things in a different way. And the fact that we see different pace in different parts of the world makes a lot of sense. Just to give you one example, some countries trust the private sector to deliver greatly on what I would call more public policy objectives, but others, on the other hand, they have very different approaches and take a much more hands-on approach. Let's go into the CBDC world then, but before I do that, let me say a few words about cash. The role that cash plays in our society is also being disrupted by technology, both from incumbents and new players. And my firm belief is that I think cash should continue to play a role. People should have the option to use it if they want. Coming from Sweden, one of the, I would say, most cashless societies in the world, I see a very clear writing on the wall. Cash usage is rapidly going down, and the network effects that used to be very favorable for cash nowadays goes against it. Sometimes you can hear the scenario of a cashless society that there's some sort of conspiracy led by banks and credit card companies forcing people out of cash. But I think the reality is actually more boring. We just see a behavior shift towards digitalization and dematerialization. And speaking from my own experience, once you have stopped using cash, you really don't go back because the convenience of digital payments is so powerful. But it's not the same, again, it's in every country, and there are many social, economic, and development dynamics around it. But the trend is clear. It's going roughly in the same direction everywhere. So I would say that policymakers need to think very carefully about what they want to do. This is one of those situations where you have to think quite for a long time. A lot of work requires. Think about the structure that reflects societal preferences and work over time. Ensuring access to and protecting the right to use cash is a policy decision and requires specific action. And in rapid our evolution into a more digital society, taking those decisions, protecting societal preferences doesn't happen by itself. It takes work from our elected politicians. And that brings me to CBDCs, the main topic of this conference. CBDC refers to money issued in a digital form by the central bank for use amongst either financial institutions only, that's what we typically call wholesale, or available for public, such as household and companies, and then we call it retail. So I'll talk a bit about the retail CBDC in a domestic context, and then I'll expand the thoughts around the wholesale CBDC and what that could mean. Again, there is a lot of discussion around this, and there is a lot of opinions. So let me take just a few minutes to discuss some common statements when it comes to retail CBDC for domestic purposes. It is a solution looking for a problem. Why should there be such thing in the first place? Things are just fine. And I can often hear people in the financial sector making us this argument. Now let's stop here for a while and think about, is there any industry, except perhaps the financial industry, that would get away with that kind of statement? Think about the pharmaceutical industry saying, nope, that's it, no more research. This is good as it is. We don't need any new drugs. You will have to go with the ones that we have. Or the car industry saying, no, this is it, no more safety improvements and no more climate improvements. And I would also claim that things are not fantastic when it comes to payments. They are often opaque, they're slow, and they're expensive. And I would claim that innovation, and I think about a retail CBDC as not only having the access, but I think about it as a possible new infrastructure. It takes us to new places and could open up possibilities that is not obvious when you first venture down that avenue. Another example from history that I like, from where I come in Sweden, there is a phone company called Ericsson. They've been around for, I think, more than 100 years. And in 1989, they were trying to develop something called wireless headsets before, we were all dependent on headsets with cord. And they invented a technology that we now all know called Bluetooth. I think I have a picture of that. Yes, that's the examples. They were not trying to stream wirelessly from a tablet to a TV like we do now, or have any fancy wireless speakers around the house, or as this example, in a car. They were not thinking about wearables as we do. I have one here, power meters for bikes, or the Internet of Things. All these things became possible after the basic technology of Bluetooth was developed. And someone back in 1980s could have said, What's the problem with wires? It works really well. And Bluetooth, I'm afraid, may not ever have been invented. So similarly, if we dismiss CBDCs as a structure and a service because we don't think that they address any immediate needs, I think we might be forgoing opportunities to improve the precious public good, which is money, and we could miss opportunities to provide better and cheaper services to people. The next thing I wish to discuss, and this is an accusation often hurled at CBDCs, that this is a threat against privacy and an instrument for social controls. So technology, we know, can be used for good, but also misused. And many people, I think, are rightly worried about how much privacy we're losing in our societies nowadays because of technology, and how much our lives are already being monitored through our phones. So I think that sense of vulnerability certainly influenced the debate about privacy in financial innovations. But let me remind you that privacy is not something that we have that comes by chance. There is a legal framework around these things as well. And our banks, they know exactly what we spend and everything, where and how. But this information is protected by robust legal frameworks in most countries. So I think about these mechanisms, and they should be preserved. And if those countries decide to launch a retail CBDC, should follow the same framework. But it's not enough to just talk about or even legislate about it. We need to have the right sort of technologies as well. And at the BIS Innovation Hub, which I lead, we are trying to walk the talk, and we are experimenting with privacy-enhancing technologies. We have a project called Polaris, which is looking into this, and we will later in the week present our conclusions from another project called Tourbillon, which proposes new privacy solutions for retail CBDC. Let me also point out that offering a CBDC for those countries who choose to do that, it should be seen as an offer. It provides more alternative, and those of us who trained economics, we know that more choices enhance welfare. Should not be something that should be offered, it should be forced on individuals, but more as a possibility. If you're super happy with using cash, if you're super happy with using your cards, you don't have to do anything. You can just carry on using those things. And privacy is a social and legal construct which correlates with the developments and the strength of democratic institutions of each country. So this is not just a question about the central bank. This is something much bigger, and it should actually be a much broader debate, I think, about the privacy in our societies than only about money. A third statement is that CBDC is a risk to financial stability, that they could facilitate bank runs and disintermediate the financial system. And here, I would say, in terms of the risk of digital bank runs, the train has really already left the station, even without CBDCs. We are already living in a world where digital runs can happen. And I think the correct question to ask is, could a CBDC make the problem worse? And here, I would say central banks have come together, many of the big ones, and said, with the right, they have the access to the right sort of tools, and they can make countermeasures if this is a problem. But I'm not taking this question lightly. It is a big question, and there is a vast literature around it. Now, hopefully dispel some, I would say, misperceptions. Let me take you to the global stage. We've already heard this morning about the cross-border payments. There are room for improvements. I don't think there is an imminent role for retail CBDCs in the cross-border space. That's probably very far away into the future. But definitely there is interesting work going on around wholesale CBDC. But innovation is also about trying to improve the existing systems. We don't only need to look into CBDCs. So let me just very quickly tell you a little bit about Nexus. So there are about 65 and growing number of fast payment systems in the world, but they only work in the domestic space. You can't do a cross-border, cross-currency transaction in the fast payment systems. Now, in Asia, where we heard before, a lot of things is happening very quickly. Some bilateral corridors, so making fast payments, cross-border, cross-currency available, is already there. But if you scale this up to all 60+ and growing fast payment system in the world, you will get a maze of almost 2,000 bilateral connections. So the Project Nexus is the answer to this problem. And we already have countries in Asia that is very committed in building this. And we hope to see other countries joining in the next couple of years to follow, so we can get this going. Say a little bit then, coming back to the wholesale CBDC. So they would serve a similar role to preserves in the current system, but they could have added functionalities that could address many of the frictions that we see today. And there is quite a lot of work that is happening in that space. We've done some experiments. We can see that we could have faster settlements and less risks. So this is something that is worth exploring further going forward. And one thing that we've also heard is about the possibilities of tokenization, about tokenizing assets. And if we want to go down that road, which many are interested in, including the BIS, we need a system built on the trust of central bank money that could work as a settlement asset. And there you would probably need, we think, what we call a wholesale CBDC that would be used as a vehicle for settlements. And if you look at the latest annual economic report from the Bank for International Settlement that was published in June, we sort of published our thoughts, what we call the structure of a unified ledger that could be a common platform where assets and payment methods could come together and settle in central bank money. This is a vision, but the Innovation Hub is exploring projects that will experiment further with this concept. When I come to this part of the speech, a lot of people sort of zoom out and say, oh gosh, CBDCs, retail, wholesale, tokenization, science fiction, blue sky stuff. So let me tell you something that is happening not too few miles away from here, but we're actually doing a real, building a real structure around tokenization together with the World Bank, and this is the first time I can talk about this in the public space. So we work together with the World Bank and with the Swiss National Bank, run by the Swiss Center and the BIS Innovation Hub, simplifying the process for making development money available for emerging and developing economies through international financial institutions. This is a structure called promissory notes, and it's quite an arcane structure as it is today. It's paper-based, and there are piles of papers sitting in vaults across central banks, the World Bank, and receiving institutions across the world. So here we are collaborating and see, can we actually get the tokenization methodology to work in a reality? It's not going to revolutionize the world, ladies and gentlemen, but by trying these things and make it work in a real-life setting, I think we will make a lot of progress. So in the last bit of this speech at this conference, I know that we need to think about the regulations and the international standards. And what we need to do, sorry, can I go back one? What we need to do is to look at the three broad categories that we need to work together on. First, we have the legal and regulatory standards already existing, and these are the principles for financial market infrastructures and the multiple recommendations on financial integrity that are developed by, for example, the Basel Committee on Banking Supervision and also the Financial Action Task Force. And these are the sort of the committees that align the rails across the world so it works in a more seamless fashion. The second category here relates to payment-specific technologies and operational standards. It's about messaging formats and communications protocols. And finally, the cross-cutting technology standards that is about general application that goes beyond just digital currencies. And here we are talking about everything that is how the public sector sort of presents itself to us citizens in the digital sphere. And here I'm thinking about how to protect our resilience, security, but also how we can identify ourselves in a safe and efficient way. And these bits are super crucial if we're going to get a much better improved financial services for the end users. So a lot of work is done in this area. One of the critical things to ask is, do you need to put these standards implemented early to get things going? Or will that become difficult because you need to change them later? And to what extent do they need to adapt it so they can also facilitate countries who choose not to do any CBDCs? So in different ways, these questions are already being addressed, but I'm also hopeful that this conference could add further light on the way CBDCs could improve in terms of the international standards. So I hope I have convinced you that central banks needs to be parting in the discussion around central bank digital currencies and how to make it better, but they are not the only ones. We need to have a much broader discussion. There is no one solution to rule all solutions. I think different countries have different homeworks to do, but the many issues rhyme, so collaboration is useful. And this is one of the key objectives of the BIS Innovation Hub, in a structured way, bring central banks together, but also private sector, explore and do it in a transparent way. I said I like history, so let me bring one last bit of that. And Joseph Schumpeter, he sometimes defined history in a bit negative way, because he said, quote, "History is a record of effects that vast majority of which nobody intended to produce." And that's not very nice, I think. Technology is something that doesn't slow down for anyone. I think digitalization affects us all, and I don't think we should end up in a position of just having to live with the effects. I think we should be ambitious, and it's our really collective responsibility to make sure technology ultimately serve economically meaningful activities and ultimately everyone living on this planet. So I thank you very much for your attention.
And I'll take the seat here.
All right, okay.
Okay, hello everyone. Thank you so much. Thank you to Cecilia for, I'm sure I echo everyone's sentiments when saying thank you so much for your remarks. Usually central bankers get a bad rep of being slightly dull speakers, but there's nothing like a couple of military analogies to really grip the room and grab everyone's attention. I'm Alice Ford. I write for The Economist, as Jen said earlier. So you started your remarks by saying that you thought that, although you couldn't call the moment historic, that you thought that we were at an inflection point in history. And if I reflect on the sort of debate that people have had about CBDCs over the past sort of 2 or 3 years, I remember a couple of years ago, the sentiment seemed to be very much that central banks were reacting to a couple of sort of threats to their potential sovereignty. So everyone was sort of very animated about Libra, that project. Crypto as well in 2021 seemed to be sort of a potential sort of alternative monetary system. Both of those projects are either non-existent or have suffered some pretty significant blows over the past couple of years. So why is it that you think there is this urgency for CBDCs now?
Well, thank you for pointing out these events. I think about them as a sort of wake-up call that there are so much going on in the tech space that the idea that central banks can just sit on their hands and and not participate in the discussion on how these things should evolve. That doesn't work anymore. But that is not necessarily the same thing to say that we need to rush things. I think many countries are sort of exploring this at a good pace. I am very pleased to see that many countries are, thinking what is money and how do we want this to work. Okay, if we want cash really to work, maybe we need to put in legislation. That's something my own country did, making sure that there is a sort of not many, a particular group of, just 45,000 I think it is, should have more than 45 kilometers to the nearest ATM. And that might sound a bit detailed, but I think legislators should sort of walk the talk and say, okay, if cash is important for people, we need to put the right legislation in place. But at the same time, investigate into, okay, if these opportunities are there with the technology, can we actually, be ambitious and see if we can put the system to a new equilibrium? And the first picture I had was not a coincidence. It was a try to illustrate infrastructure. And if you go back in history, often the private sector is first. You can think about that when it comes to canals in the UK and railways. But after a while, the public sector steps in and sort out the foundation so that the private sector can innovate on top of that. And that's how we build our societies across history. And when it comes to money, it takes a bit of time because you want to get things right. And that is not going to be sort of up and down because FTX goes up or down or something else goes up and down. We're here for the long run.
Yes, exactly. Okay, and in the development of retail CBDCs, say that they're, as you described, this sort of new technological platform that other people can build on top of. We have seen several central banks sort of launch, in sort of smaller countries, launch their retail CBDCs, and then a very advanced pilot in China. And it doesn't seem like they've necessarily been this sort of big bang, everyone adopts and it sort of changes how everything works. Do you think it's possible to make a CBDC that is sort of useful enough that people mass adopt it without sort of running into some of the risks that you talked about with things like destabilizing the financial system?
Now, thank you. You nailed it exactly. It's hard to know what we want, really. We don't want to have too much uptake because we don't want to have the banking system, grumbling about that or any kind of troubles coming down that road. But when there's not much of an uptake, then that is being perceived as something that is going against CBDCs. I think it makes a lot of sense to run these pilots. I think I'm not concerned about the fact that the uptake can be low. Things takes time. And I think the value of CBDC sits in the offer, the fact that you can access it. And then there's obviously a sort of, you have to come down to the real basic question, is it worth for the society to offer this? And I think that depends a lot on where the country is in its own development and its own political preferences. And I agree with those who say that an advanced economy with a high level of financial inclusion, they can be quite complacent, but not forever. Because I think ultimately the trust that we have in the monetary system, in the fiat monetary system, is that we can go from the commercial bank money into central bank money at the flip of a switch. And if we decide to, if we are in a society where cash is no longer working and the central bank by law choose not to offer a CBDC, we have in essence a privatized supply of money and payments in that society. You may be able to do that, but that's also quite a big decision in the same way as it is a big decision to actually offer retail CBDC.
And we also talked a bit, or you talked a bit in your remarks about cross-border CBDCs. And again, this feels like something that has sort of shifted a bit over the last couple of years, there's been a lot more interest in building these sort of wholesale cross-border projects. There have been a couple of sort of successful ones like Project Mandala that seem to have sort of moved the needle in terms of how effective cross-border payments could be. Could you just talk about sort of the motivations for doing those kinds of projects and you know, how significant you think they could become?
Yes, absolutely. So I think the Libra initiative wasn't fantastic from a sort of business perspective, but I think it was very helpful in the sense that it created an attention around how do we actually want the cross-border payment services to work. And I think there was a general agreement, definitely on the political side, that now this is not good enough. And I think personally I think it's a failure every time an honest, hardworking person think that they had to use Bitcoin for making a cross-border payment. I would much rather see that he or she could use, you know, have a nice menu of choices, but paying in the fiat money space. Others have different opinions, but I think the fiat money should be there to deliver that sort of services. Okay, so that said, the G20 agenda around improving cross-border payments is a long list of possible improvements. A lot of this is already sort of happening. But the job of the work of the BIS Innovation Hub is to say, okay, can we, through technology, build better structures together? And there's quite a lot of interest in some central banks to see, can we use the wholesale CBDC concept to facilitate, especially settlements, because this is just for the ecosystem. And one of the pain points we have is all these legal checks against AML and CFT, which I think is super important, but it also creates the various frictions and delays that we all are aware of. And the Mandala project is to see, can we sort of, through the smart contract technology, build into the transactions all these checkups kind of automatically. And then we could get the transactions done in a much faster way. So we try to work, and I know I've spoken to some of you here at the conference, there is a lot of projects going on. And I don't expect you to kind of be on top of everything of that. And it's not that we're building a big jigsaw, but think about it more as the Swedish smorgasbord, which is a buffet where some of these projects are going to work really well together, and we build on top of that, the findings, and others are separate things. But we're starting to see the possibility of making the sort of first tests in a year or two. So things are moving forward.
And I guess on that sort of smorgasbord of projects, you know, how do you, especially with the cross-border ones, where you know, maybe a small group of countries now is testing out a project, and there's a different project going on with another group of countries, you know, ultimately those projects being interoperable and working together is sort of kind of critical. And if they make different technological choices or even ideological choices, you could end up with all these different silos. So how do you prevent that world being the one that develops?
Well, I have to say that's a little bit beyond my pay grade, in the sense that we want to demonstrate the art of the possible. And we are happy to advise groups of central banks who want to sort of rally around different ways to move forward. So that if we take Nexus, for example, which has nothing to do with CBDCs, it's about improving the current systems we see in the world on fast payment systems, again, making it possible to go between them, cross-border, cross-currency. And we're happy to stay on as advisors, but ultimately it's about the political will in those countries. So that goes for Nexus and the same for Enbridge. We're there to advise, and we report our progress in a transparent way. And I really like to enforce the importance of it being transparent, so everybody else can sort of look in and see what's happening. What's ultimately going to happen, it's hard to say, because it's, again, it's a question of political willpower. We know that not all countries in the world is happy to make transactions with everybody else. So we won't have a completely frictionless global payment system involving all countries. But if we can make improvements from where we are, I think, yeah, then we've done a good job.
And I guess, maybe all of these sort of projects are proof of concept, as you sort of say, that the technology can work and can exist. And if I again sort of reflect, a couple of years ago, everyone was at the sort of research stage in the Atlantic Council sort of tracker, and now it seems like almost everyone is at the sort of project pilot stage. When do you think we might see sort of the map light up with implementation stages?
Well, again, as I said, we can demonstrate the art of the possible. What's ultimately going to kind of see the light of day is going to be decision makers on a sort of central bank, but certainly political levels in many countries. But without saying too much, I think we will be able to see sort of the first, at least test transactions in some of these projects we're doing in, let's say, 2-3 years from now. But then if that is meaning that we'll take it into fully operational and scaling, that's too early to say.
Yeah, that's probably fair. Thank you. And I guess just one point on how you think all of this interacts with sort of private sector offerings. You mentioned that you thought it was a sort of failure if people have to use Bitcoin, but at the same time, some of the projects are borrowing things like automated market makers from decentralized finance and from sort of those other kinds of sort of private sector development of technology. Do you think ultimately a lot of the sort of public projects will interoperate with crypto, or how will that sort of boundary between the public and private sector evolve?
So we have nothing against trying out the technologies that the crypto world has created. I find it hard to see that crypto as such will sort of work through the public rails. I think some countries make the choice to regulate and supervise crypto in a sense that it may be possible in the future, but I think ultimately that countries are hesitant in sort of accepting something else as payment vehicles than fiat money. Again, I think it's about protecting what the public sector think it's the key offer from the state. And as I said in my talk, I think the inner and outer defense is sort of key offers from a state. And I think the third thing is making sure there is a version of money so people can transact in a safe and efficient way. And I don't think many countries, because now we're on a country or state level, so it's sort of above central banks, is willing to let that go into private hands.
All right. And on the project that you announced that you could talk about now with the World Bank to sort of tokenize aid and get rid of the promissory note paper system that is apparently still used. So basically, I just want you to tell me more details about this.
Okay.
How is it going to work? What will the efficiency gains be from putting it into place?
Yeah, so here is the thing. When you start a project, you don't really exactly know how it's going to work. And this is really, it might sound trivial, but that's a bit scary when you come from the world where I come from, which is the central bank. Central banks are used to be sort of in full control when they run a project. And the beauty with setting up the BIS Innovation Hub is to identify a problem and say, okay, there is too much frictions going on in a particular area. Let's see what sort of technological solutions we can apply to that. And then the team sort of go into that together with one or two sort of private vendors who knows things that we don't have in-house. And see, okay, how can we actually get this to work? And you don't exactly know what's going to come out sort of 6 to 12 months later. And sometimes it works and sometimes it doesn't. But you have to try. And I think the try with this particular project is to make sure that you get rid of the paper-based structure that you have in both the sending country and the receiving country, because there are very few people involved and there are very few transactions. So the sort of knowledge that sits in these institutions can be difficult to sort of hand over from person to person. So if you can automate this through this kind of platform, I think it would be safer. Will you save a lot of money? Will it revolutionize the world? No, probably not. But I think it's a very tangible way to actually put the technology to work and sort of build to order to an area where you shouldn't have paper anymore. But we'll see. We've just started that particular project.
And I think we have probably time for one more last question. So, you know, we're at Lansdowne now, and if we sort of reflect on how the sort of debate has changed over the past couple of years, you know, there's been more progress towards putting retail CBDCs into reality. There's been sort of greater discussion of these sort of cross-border wholesale tokens. In Lansdowne in a few years' time, if the Atlantic Council is kind enough to host it again, where do you think we'll be in terms of the tenor of the debate then?
So I think many more countries will have discussed and probably legislated around the protection of cash. I think that makes a lot of sense. I think the public sector is there to serve members of their societies, and if the societal preference is to use cash, I think you need to have a legislation that reflects that. So that's number one. I think hopefully we will have fast payments systems moving kind of, not the system, but the payments moving across. And I think we will see tokenized assets being able to move quicker and with much more choice from the consumer side. And I hope we have been able to build in many of these very tedious controls that we want to have, because we want to fight money laundering and the finance of terrorism. But we really want it to work for everybody else that are honest, hardworking people. And yeah, basically, they deserve a much better system than the current one.
All right. Well, thank you so much, Cecilia. That's a great note to end on. Thank you to the Atlantic Council and to the Digital Dollar Project for having myself and Cecilia on stage. And yeah, I think we're breaking for lunch now.
Yeah,
so
all right.
Thank you so much.
Thank you.
Ladies and gentlemen, I'm afraid we're not breaking for lunch. There's one more very exciting session, so please stay in the room. Ladies and gentlemen, thank you for your patience. Please welcome to the stage the moderator of the next session, Ananya Kumar, Associate Director for Digital Currency at the Geoeconomic Center of the Atlantic Council.
All right, thank you everyone for joining us today. I have the very difficult task to keep you here until lunch, but I think our conversation will make up for the food that is waiting for you on the other side. Thank you and good afternoon. A special thank you before I get started for our great events team and AV team who've made all of this possible, without which we would not have chairs or mics or anything for our program today. So please join me in giving them a hand. I'm Ananya Kumar. I'm the Associate Director at the Atlantic Council. I lead our Future of Money work, which includes this tracker, but also includes thinking beyond CBDCs into what a future system of money is going to look like. Through our work over the last few years, but also through the working paper that was released yesterday, we've seen the rapid development of digital currency projects around the world. What has become very evident to us over the last year is that future systems, regardless of what they look like, and you've seen a lot of views here about what they will look like today already, but whatever they look like, they're going to need to speak to each other. To me, that is what interoperability means. But today in our panel, we're going to get into whether or not my panelists agree with me on that. We're going to get into some of the technical and legal issues that arise when they work on their projects. We're going to look at some of the challenges that arise, but also some of the opportunities that they're looking at, looking into the future. So it is my pleasure to introduce an esteemed slate of panelists today. Federico Greenberg from the IMF, he's a senior economist here, and he'll be representing the IMF. Tony McLaughlin, who's the head of emerging payments and business development at Citibank. Tom Jacques, who's a chief innovation officer at SWIFT. Jennifer O'Rourke, who's the executive director of innovation strategy at DTCC. And virtually joining us from Boston is Jordan Bleischer, who is the senior advisor to the Undersecretary of Domestic Finance at the US Department of Treasury. Thank you all for being a part of this today. And because I gave my definition of interoperability, I want to turn to Jennifer first for her definition of interoperability and why DTCC is interested in this issue.
Yeah, thank you. So when we think about interoperability, what we're talking about from our point of view is the sharing and the coordination of disparate data across multiple participants, right? So I think that that's pretty easy to conceptualize. Where this gets important quite quickly is how we're seeing interoperability and the connective tissue between these distinct, disparate systems, how we're seeing that interoperability develop. And right now today, when we look to the projects that have already been moved into significant degrees of research and experimentation or are currently on a path to production, what we're seeing across the globe are smaller DLT deployments at subscale that have isolated liquidity pools and therefore are finding themselves creating a fragmented marketplace because of some of the technology choices of proprietary DLTs that have been taken in earlier days and are being taken today. This disparate marketplace is going to challenge our ability for a harmonized global solution, but the answer to that is going to be interoperability. So for that reason, I'm very excited to participate in this conversation today.
Thank you. I'm going to turn to Jordan, who's on screens behind us that our audience can see. I'm interested from a public policy perspective, Jordan, what is the need for interoperability and how do you define it?
Right, so thank you, Ananya. When we think about interoperability at the most basic level, really what we're thinking about is the ability to make something happen in one system through another system. So in the context of payments, interoperability exists when I can initiate a payment at my institution and funds are credited to you at your institution. When we think about security settlement, you can think of interoperability as the ability to coordinate a transfer in the ownership of securities, usually recorded on a securities ledger, with the transfer of money typically recorded on a payments ledger. When we think about why interoperability matters, I think it can be helpful to compare interoperability with the alternatives. So one alternative would be a world of proliferating silos that can't speak to each other. This would be a world of high transaction costs and limited gains from trade. A second alternative on the other end of the spectrum would be a world of highly concentrated walled gardens. And this could develop into a world of monopoly rents, limited competition, and general stagnation. And so when we think about interoperability and why it matters, we think of it as kind of being a middle path between these extremes. I think for domestic payments, we often take interoperability for granted, but it's important to acknowledge that in domestic payments, interoperability is an achievement that's rooted, among other things, in central bank money and central bank payment systems. And when we think about fast payment systems, one of the benefits is to reinforce interoperability in domestic payments by allowing customers of different institutions to transfer value to each other. Looking forward, of course, we're considering the emergence of new forms of digital money and payments, and the impact on interoperability remains to be seen. So on the one hand, CBDCs, tokenized deposits, stable coins could provide new ways of transferring value across payments networks, bolstering interoperability. But on the other hand, the rise of new forms of privately issued money and payments could also lead to the extremes I mentioned earlier, either a proliferation of silos or heavily concentrated walled gardens. Thinking about cross-border payments, there we tend to take interoperability much less for granted. Quite the contrary, cross-border payments are often slow, costly, opaque, and these frictions are particularly significant for emerging and developing market economies. As you well know, there are a number of proposals for how to address frictions in cross-border payments. Some would involve interlinking fast payment systems bilaterally, regionally, multilaterally. There are also proposals to create new multi-currency platforms using technologies like tokenization and DLT. And here I would just point out that many of the frictions in cross-border payments ultimately stem from some combination of legal, regulatory, or other policy issues. And while technology can help, it may not be a silver bullet where these sorts of issues are at play. Finally, just very briefly, on multi-asset settlement, as I suggested at the very beginning, security settlement involves coordinating the transfer of securities, usually on one ledger, with money usually on another. And for this reason, it's worth exploring whether there are efficiency gains from new technologies that could support better coordination between these distinct ledgers. Alternatively, and more far-reaching, would be proposals that involve putting money and securities onto a single unified ledger. And while potentially very transformative, sort of much like the common platforms for cross-border payments, unified ledger proposals may also raise complicated legal, regulatory, and policy questions.
Thank you, Jordan. We're going to get into some of the issues that you raised there, unified ledger versus cross bridges across ledgers. Cross-border payments have been evoked, so it's only appropriate that I turn to Tom for his definition of interoperability and why he sees SWIFT work so much on this issue.
Well, thanks for having me. I love when we talk about cross-border payments and the opportunity to kind of get the message out. And from SWIFT's point of view, interoperability is kind of the heart of what we do. We turned 50 years old this year, and we started because domestic payment systems couldn't talk to each other. And so to standardize that messaging and to put the flows in place was critical, for moving value and really driving economic value around the globe. And that's true today. And as we look forward into the creation of new digital assets, whether that's a CBDC and a digital form of the currency or tokenized bank deposits or other types of assets, what we see is we need to actually focus on interoperability, because we're not just going to walk in one day and kind of flip the switch and everybody's going to be on a shiny new platform. I think we counted 60 plus real-time payment systems and projects going on in the world today, right? And they're all going to be at different stages and different times. So you need the interoperability from our point of view for a number of reasons. One of the most important ones is we need interoperability and connectivity to existing payment rails. And so if you're creating a new network and new digital asset and you don't have access to existing payment rails and no way to connect to what's there already, then you're going to build a digital island. And you won't drive adoption, and you'll create even more fragmentation. And then we'll be sitting here 5 years from now and saying, well, we did your digital assets, we just didn't focus on interoperability first, and now we have all these great functionality in pockets or walled gardens, as was just said, but they don't talk to each other. So we've basically just created the same problems or worse with new technology. And I don't think anybody wants that. So it's really kind of the heart of what we do and major focus for the work that we're doing in CBDCs and other digital assets.
Thank you, Tom. And often when I think about interoperability, what helps me is to be able to think about it in two ways, horizontally and vertically. So the thing that you just said, which is that systems need to operate with current systems that already exist, but also the new ones that are going to come up over time need to be interoperable across each other. So something that helps me think about this issue. Federico, I want to turn to you for a domestic perspective on interoperability. You interact with member countries who are part of the IMF. What are some of the macro-financial concerns that you're seeing come up and that your organization is interested in looking at?
Thank you, Ania, and thanks for having me here. So of course we have 190 countries in our membership, so we hear a lot of different issues, a lot of special contexts and struggles. But I'd say that it's a common theme across all countries that we see new technologies and new business models that drive basically the creation of new forms of money, new forms of payment. And that opens the door, as the other panelists were saying, open the possibility for new efficiencies, more competition, more access, reaching to some niches of the population or corporates that are maybe underserved. And that's great, and everyone gets excited about it. But of course, that has to be balanced against the financial stability risks that new forms of money may create. And that goes from operational and cyber specifically, that can, of course, create systemic disruptions, but also more traditional types of risk, like banking disintermediation, right? So we all want to preserve the ability of the financial system to continue create credit for the economy and lend to corporates. And that creates, of course, trade-offs that have to be managed very carefully. One easy example is our CBDCs, right? If we were to create a CBDC that is amazing, has all the features that we'd like, and everyone wants to use it, well, that would crowd out bank deposits, right? And may make banks' life a bit harder and their role in the economy a bit more limited. At the same time, you don't want to create a CBDC that no one uses, because that is basically, why, right? So central banks would spend taxpayer resources and would have reputational risks down the line. That also applies to, excuse me, private forms of money, e-money, and stable coins. Making those interoperable domestically also can create risks that have to be managed. And that's where regulation comes in, and standards and appropriate supervision. I know you asked about domestic, but I cannot avoid, we have an international at the beginning of our name. Of course, across borders, it's a major issue for us. Reaping the benefits of new forms of money, new solutions for better integration of countries is critical, but at the same time, avoiding creating excessive volatility of flows and new forms of spillovers. Contagion is obviously very important as well, and that's something that our membership cares a lot about.
Thank you. I'm going to move on to some of the projects that some of you are involved in, and how you're thinking of interoperability and how what the challenges are to it has evolved. So I'm going to turn to you, Tony. If you can brief us a little bit about the Regulated Liabilities Network and the proofs of concepts that were released in 2022 and 2023. How has your thinking of interoperability changed through doing those projects?
Yeah, thank you. So the concept of regulated liability network is really an investigation into the application of distributed ledger technology to regulated financial services. And if I just pause there for a second, it's entirely not obvious that DLT is a good technology for the regulated space, because we have to remember that DLT was created as the antithesis of regulated financial services and not in order to augment it. So the first thing that you have to do if you want to apply DLT to the regulated space is you've got to put a number of fundamental blockchain constructs into the garbage. We don't want non-sovereign currency units. We don't want commodity forms of money. We don't want proof of work. We don't want anonymity. We don't want tokenomics. We don't want economic systems which are outside of the regulatory perimeter. So if you ditch all that stuff, what's left? And there is a kernel of stuff which is left, because the way you get to that is to ask yourself, what does Ethereum do better than the traditional financial sector? And that's where you find some really intriguing possibilities. Number one, Ethereum is 24/7. Now that I wouldn't say is a unique feature of a blockchain. You can do that on a different technology, but it's true that Ethereum's running 24/7 and almost nothing in traditional financial services is. The second thing is deeper and more interesting, which is that Ethereum is multi-asset. And the truth is that the financial system that we've built up over decades is fundamentally siloed. So let's just take a microscope and look at the US. You've got Fedwire for cash, which only knows central bank dollars. Fedwire for securities, which only knows treasuries. DTCC knows investment grade bonds and other securities. So we have built up separate islands, and every financial institution is its own data island and its own individual record-keeping platform. So what DLT suggests to us is, what if we move away from that paradigm and have a place where these assets can meet, these multiple assets can meet and be settled within the context of a financial market infrastructure, an FMI. And that's essentially what Regulated Liability Network is investigating, is can we have a new financial market infrastructure? And again, let's not gloss over that point, because people do lots of hand-waving about blockchain and claim that it achieves atomic settlement, but blockchains don't achieve any form of settlement. Settlement is a legal construct. A blockchain might evidence settlement within a legal construct, within a legal framework, but it doesn't achieve legal settlement. You need an FMI. You need a legal framework. So can we have a new financial market infrastructure that's running some kind of DLT or shared ledger, and in that DLT or shared ledger, the different financial assets can be settled 24/7 in real time with absolute cryptographic certainty of who owns what? That's Regulated Liability Network. We've done proof of concept here in the US. The results were published on the 6th of July. There's a very active community around it in the UK where we will be examining retail use cases. And frankly, what it is it's trying to move beyond CBDC.
Yeah.
CBDC is a monoline focus on one aspect of the sovereign currency system, which is the central bank money. We think that there's a broader opportunity to upgrade the whole of the sovereign currency system by having infrastructures where commercial bank money, central bank money, e-money, regulated stablecoins, and other assets can meet and be exchanged within a given legal structure. That's RLN.
Thank you, Tony. I think it's very interesting because when I talk to central banks, a few years ago, the conversations we were having were whether or not they should use DLT. And I think we've progressed past that bit of conversation to be talking about what are the aspects of DLT that are going to be useful to my product and my objectives, and what are not, and how do we discard the aspects that we don't want and build upon the aspects that are better than existing systems. Right. So that's a very good, I think, learning for us to take as we go beyond this conversation as well. Jennifer, I want to give you some time to talk a little bit about your security settlement pilot as well as testnet.
Yeah, thank you. So we are here today at a conference that is co-hosted by the Digital Dollar Project, and I'm incredibly proud to say that about a year ago now, I think it's been, we completed the first DDP pilot, DTCC, and the Digital Dollar Project did, where we were exploring DVP as a use case for security settlement with a central bank digital currency. This was an incredibly successful experiment where we were able to create a technology solution with a multi-network approach that was able to then show what the trade-offs would be with this particular approach and some of the architectural decisions that we made. And the reason why that's so important is because there are so many open issues around these architectural decisions right now. And that's really what we're talking about on this panel right now, is how do we connect networks that have been built up with different architectural approaches in mind. So for our pilot, we were looking at 2 single asset networks, DTCC representing the future of a tokenized security in one network, and then a synthetic central bank digital currency network that represented a future USD CBDC. And we were able to successfully settle that DVP use case in a variety of different scenarios. What that led us to really appreciate from a DTCC point of view is that although we will support whatever architecture that we find to be the predominant one within the market and that our clients are using, or we will support a multitude of those architectures, period. But what we are finding right now is that a pragmatic approach to this architecture is going to recognize that the toothpaste is out of the tube. And there already are single asset networks that exist today, and DTCC's job as financial market infrastructure or an FMI is to support connecting those networks together. So that's the work that we have done in our Digital Dollar Project security settlement pilot, and that is the work that we're continuing to do with our testnet, which is essentially a sandbox environment that we currently have up and running for Hyperledger Bezu, but we have a roadmap that will expand to additional protocols, additional networks, and we will then be able to test out the use cases that our clients are prioritizing and focused on, and to figure out how we continue connecting each distinct network to support these specific use cases.
Thank you. And I know Tobias Adrian, who's giving the keynote, in a little bit we'll be talking about IMF's approaches as well, but I just want you to give a preview of the XE platform for our audience. A little bit, Federico, if you can.
That work, of course, I mean, we are not in the business of building anything or running or operating systems. But that work that we put in the public basically was our effort to start thinking conceptually of how an FMI, as Tony said and Jennifer said, an FMI that would be multi-currency, potentially multi-asset as well. How would that work and what benefits it could bring? I think that's blue sky thinking, right? Yeah. Because we, on purpose, remove a lot of the frictions and hard things that exist in the real world. I'm sure we'll talk about the legal and regulatory issues more.
Yeah.
But I think one of the main messages is if we start building, I mean, conceptually, right? If we let bridges and interlinking systems to proliferate, that's going to create a lot of inefficiencies. It's going to create a lot of cost for even smaller players because it's just more costly to manage more interconnections. It's going to create operational risks and increase the attack surface of bridges and systems. And it makes a lot of sense conceptually to have all the information and allow for automation that Ethereum and programmability can deliver to live on one FMI. Of course, it's very hard to think in the real world, right? We may, and hopefully, we'll end up in a second or third best world in which some countries may have different platforms, different solutions, or different assets will be traded in different platforms or different solutions. But I think that what we should aim for realistically is to help the market and the countries to converge in solutions that are compatible, that have basic functionalities, basic rules, that are all compliant with the standards that the different standard setter bodies require. And then allow for these platforms and solutions to talk to each other at the basic level. So have a limited number of interconnections and have the opportunity to reap the benefits of platforms and new technologies.
Thank you. I think what we're seeing here as we talk through all of these projects is a bifurcation of interoperability models, right? There's one understanding of interoperability, which is that there's going to be a common platform of some sort. It looks different across the different models that we've looked at that everyone is going to operate on and build upon. And then there's an understanding of interoperability that's different from that, which is that people are going to be working across different platforms. And how we build bridges across those platforms is what interoperability is about. Tom, I want to turn to you about your thoughts across those two models of interoperability.
I mean, I think it's too early to tell, right?
Yeah.
And so, you know, we've been working at SWIFT with Tony and the group of banks, not only because it's a really clever idea, but it's really a compelling view of the future, right? And what could be. We don't know how it's going to play out. But we've kind of set the stage to run the POC. So even from kind of early white papers, you know, in the US, UK, we've been working with Tony and the banks and others on this area. And that might turn into, you know, the technology that drives the unified ledger.
Yeah.
You know, we'd love to work with the IMF. We'd love to work with BIS. We think these are really compelling, you know, if we end up with, you know, in that scenario with a unified ledger. You know, and that probably is going to be powered by an FMI, unless we decide to change how, you know, settlement works and the definition and legal constructs, which nobody's talking about, so probably won't happen. Today we have over 230 market infrastructures that are connected to SWIFT. So it's kind of what we do, right? So we'd love to be involved in that. As you said, there's also other options. And so at the beginning of this year, it's been a pretty busy year in CBDC innovation and exploration. In the beginning of the year, we published a paper and built a beta for a CBDC sandbox, which is based on the interlinking model, so pretty closely aligned with what BIS called Model 2 and does call Model 2. And in that interlinking was the idea that we'd be technology agnostic in terms of new network, the technology would be driving the new network, whether that was a blockchain or DLT based or more traditional centralized technology. And then we connect that back into existing payment rails. We rolled that out to and talked to a number of our clients in the community, central banks and commercial banks. We got really good feedback and encouragements, and we actually built a beta. And we've run the beta through the kind of the first phase. Two things that came out of that. One is encouragement and some additional use cases that our members would like to look at, including payments tied to trade, DVP, and even some FX use cases, which we think are really interesting, in addition to the interlinking with CBDCs. And we have central banks that are actually planning and will publicly announce results from the testing that they're doing on our sandbox using this interlinking solution. So the HKMA will publish results, I think probably early part of next year, and the Bank of Kazakhstan as well, right? So we talk about kind of global reach and kind of exploring what could be. We don't know which one's going to work, so we want to be involved in all of these things. We want to help the industry and the community figure out the right way to do it. And we want to drive the interoperability that we think is going to be required to make these new networks and these new FMIs successful and avoid kind of future fragmentation.
Thank you. I do want to move beyond the theoretical now and focus a little bit on the choices that central banks and commercial enterprises face today. When we had our chat about this panel prep, we talked quite a bit about who do they go to and who do they go with when it comes to interoperability solutions. Jen, I'm going to turn to you first about trying to explain this conversation to a commercial bank or a central bank that's coming to you.
Yeah. So this is a really important part of the conversation because right now, banks or any market participant really can't afford to invest in multiple competing solutions. It's an incredible amount of technology debt to run down one type of solution, let's say on one protocol, and then watch the market move to another one after 2 or 3 years and build your internal expertise, take on the technology debt of bringing that new protocol into your organization, thinking about how your clients, your members are going to connect with it, and oscillating between the changes that will be coming with solution decisions as this technology and our market's use of it evolves. That is a significant burden to take on. And so through some very painful lessons, the market is watching, and we have seen some things that did not work out well in the last year or so. And we've also seen some successful implementations that, again, to call back to the first point that I made, have unintentionally created this fragmented marketplace, fragmented liquidity pools, proprietary DLTs. So how do we think about an organization actually making these hard decisions when they have P&L costs up front, and then they understand that this is not a stagnant decision. This will evolve, this will change. And the reality is that no one has a crystal ball here. We don't know what the solution landscape's going to look like over the next few years, and certainly in the next 5 to 10. So again, what we need to be thinking about is, where are we at right now? And where we're at right now is the marketplace has already created distinct networks that right now are predominantly single asset networks. And we've got to figure out how we can connect those together. And as these market participants are making their choices, another component, in addition to the technological and financial-based ones that I just shared with you, another component is how they're actually prioritizing that. And they're going to make their decision, or a component criteria, is going to prioritize what are their local needs right now. And so when we think about more aspirational, globally harmonized solutions, these are very important. And if that horse starts to pull ahead, like I said before, DTCC is going to support that type of architecture. But right now what we're seeing in terms of implementation, whether it's experimentation or path to production, is we're seeing localized solutions that are creating this fragmented marketplace that, as a result, are positioning us to think about bridging to support interoperability, as opposed to creating a more visionary, and granted, incredibly efficient, but much more visionary and unfortunately less pragmatic with the hand of cards we're currently dealt with right now. So.
Thank you, Jennifer. We're going to turn to something that we've alluded a few times, and one of the themes of this conference is developing international standards. We've talked a lot about legal and regulatory pathways to interoperability. Tony, I want to turn to you on your thoughts on legal harmonization for models going forward.
Yeah, absolutely. Again, I think referring back to my previous comments, the fundamental overlay needs to be an FMI. Because the problem that we're trying to solve in DLT is legal finality of settlement. And that's something specific, which is best achieved within an FMI. And also drilling into, again, the question of what is DLT actually good for? What it's, just get by an analogy, imagine that you're trying to organize a dinner party with 10 people. Is it easier to organize that dinner party through email or through WhatsApp? It's easier to organize through WhatsApp, but why? Because everyone knows the current state. And in today's financial system, everyone doesn't know the current state. Because in the world, there are 20,000 institutions sending messages to each other essentially through secure email. So what we really want to get to is a place where banks and other financial, banks and non-banks can transact with each other and settle with each other with the state being unequivocal and unambiguous within a legal framework provided by an FMI. So the multi-currency FMI already exists. It's called CLS, Continuous Linked Settlement. It's not impossible for international organizations to get together to build that. But CLS is also a cautionary tale because the stimulus for CLS was the collapse of Bankhaus Herstatt in 1974, and CLS was created in the early 2000s. So hopefully we can get consensus about building new settlement venues faster than we built CLS. And this is another, I think, key point, which is the technology is often leading in this conversation. The mousetrap is often leading. What really should be leading is a consensus about what kind of settlement venues we want to build. And that consensus needs to form as a public-private consensus. And then we can go on and build something new. And my last comment, I know we're running out of time, is my view is rebuilding existing silos with DLTs and then connecting them together is pointless. So DLT, the promise of DLT is about building more powerful, more general purpose settlement venues than we have today.
Thank you, Tony. I'm going to turn to Jordan really quickly for his thoughts on steps that are needed on the regulatory policy side to enable interoperability.
Yeah, so I'll just make two brief points. The first is I agree with much of what's already been suggested, that when we think about new ways of achieving interoperability, whether it's through the linkage model or the common platform model, many of the most difficult challenges are regulatory, legal, policy sorts of questions, and technology can help with these, but is unlikely to be a silver bullet by itself. The second point is that when we work on these issues, we're not starting from scratch. The concept of an FMI has come up repeatedly in this conversation. Fortunately, we already have the principles for financial market infrastructure. When it comes to other issues, areas where there are regulatory gaps or new standards that have to be developed, we have existing institutions that we can leverage to make progress. And these would include the G7, the G20, the Financial Stability Board, CPMI, FATF. And so surely there's much that needs to be done, but we do have venues in place that we can use to advance some of this work.
Thank you, Jordan. And I've asked the panel in our prep session to end the session with a question that they all want you to think about, or next step in their own thought process as they think about interoperability. So I'm going to start with Federico, who's right next to me. Go ahead.
So I think, something to bring up, given our role in policymaking, I think it's, and it has not come up, I think it's very important to avoid the digital divide across countries. There are new technologies that are very promising, exciting, maybe challenging to set up from a legal or regulatory standpoint that will require a lot of political capital to be adopted and to be aligned. But we need to strive to make this work for the countries that are excluded or have more costly access to cross-border systems. And that's not a minor task, right? So that's one of our roles. And the other point, I think it's important to design things that would lead to short-term solutions that can help us fight against fragmentation, but at the same time, keep on looking at the future and see whether there are more promising and more ambitious solutions that we may not yet see exactly how they're going to play out, but it's very worthwhile exploring that with a lot of effort.
Tony.
I think a good question is, what would need to be true to enable regulated institutions to use public permissionless blockchains? At the moment, they don't pass what's known as third-party risk management. Just a very concrete example quickly is anything on Ethereum you've got to pay gas for. The gas gets paid to validators. A regulated firm cannot pay gas fees to sanctioned entities. So the public permissionless blockchains are out at the moment. What would need to be true in order to enable regulated institutions to occupy that space and use those networks?
Tom.
It's always difficult to follow Tony asking like interesting questions, but I'll try. The question I would ask would be, as we look at these new constructs, forget about the technology, forget about DLT, forget about kind of how we're going to build it. We can build it. I'm one of those people that are convinced that engineers are going to solve the most complex problems in the world that we're facing today. When we look at these solutions, how are we actually creating value? And how can we verify that it's better, faster, cheaper, safer, more transparent than what we have today? We're not just deploying new technology. to kind of solve the same problem that's already been solved and probably introduce additional new risk on top of that. So we always got to think about how valuable how is it really going to fit in, how is it going to work, and we need to be specific with use cases. So ask questions about use cases, be specific, because without that, we're just going to have lots of conversations for forever.
Jennifer.
Yes. The industry needs to take a collaborative approach to addressing some of the significant open issues that we still have around access, standards, and interoperability. We need to do this, and we need to do this sooner rather than later, because there already are organizations and governments that are moving forward quickly with a very significant amount of velocity around creating their own solutions without having these conversations. And although I don't think that that will destabilize the work that we're doing or any monetary policy considerations, we do need to consider that if we are silent or if we don't have a stronger voice in this conversation, then we may be positioned such that we are reverse engineering into solutions that have already been created and markets that have already been accessed, as opposed to dictating a best practice that could really move the ball forward on the field. So that collaborative conversation needs to happen now, and there are lots of organizations that are doing it. Again, events like this conference, the work that RLN is doing. I can speak towards my organization and some of the work that we've done with our clients and consortiums, and I know SWIFT is doing the same, and IMF as well. And so we need to make sure that those collaborative conversations continue to take a priority.
Thank you. And Jordan, you get the last question.
Thank you. I'll just pick up on the theme that you identified, Ananya, of the two different models for interoperability. One, the interlinkage model, and the second being the common platform model. And for me, a couple of the questions that I often wonder about are, one, trying to get as clear as I can about the costs and benefits of these two approaches. But second, and maybe more importantly, thinking about what's the right way forward. Is the right way to sort of push forward on both fronts and let a thousand flowers bloom? Or do we somehow need to have a more deliberate, coordinated path forward?
Thank you. And thank you to all of you for joining us today. I'm just going to introduce Jennifer Lassiter, who's going to dismiss us all for lunch, but also announce programming for the FinTech Hub. Thank you.
Thank you. I hate to be the one standing between lunch, so just a couple quick logistical comments before we leave. Lunch will be hosted in the Riverside Hearth Restaurant, which is just right across the way as you go out the doors and turn left. But before we break, I wanted to share a few details about the FinTech Hub, which is open now and tomorrow afternoon for those of you joining in person. It's held in the Lansdowne Ballroom C, which is directly behind this room. The FinTech Hub enables attendees to gain hands-on experience with the technical infrastructure driving the modernization of money, and will showcase 15 prominent companies. Representing solutions and use cases across the digital asset ecosystem, these companies are here to demonstrate how their products are today solving for critical global areas of interest. And these reflect the themes of our conference, of course: privacy, cybersecurity, financial inclusion, cross-border transferability, scalability, and identity. The FinTech Hub is an educational model supported by the Digital Dollar Project participant community, and this community is dedicated to elevating private sector-led solutions and collaborations, promoting education around technology, and facilitating connections among key stakeholders to experiment with real-world use cases, thereby fostering improved data-driven, very important, data-driven decision-making. You can find a schedule for the FinTech Hub side stage by scanning the QR codes that you see in any of the placards around this room. We will return to this main stage at 2:15 to discuss financial innovation, tokenization, new rails, and automation, and to hear a keynote speech from Tobias Adrian of the IMF. Concurrently, we will also have the United Nations Internet Governance Forum workshop taking place in the Sarnoff room. Again, if you're interested in attending the workshop or need more details on this afternoon's agenda, just scan the QR codes and the placards behind you. Please enjoy lunch and networking. We'll see you at 2:15. Thank you.
side to side, let's tell my travel come alive. I can't wait, the sun is shining, lift the sails and follow my own tide, yeah. There's a screaming in there, not telling me to leave for a while. So for the first time I trust him, right on now I'm gonna ride my own line, oh. I wanna escape and restart all. I wanna escape and restart all. I wanna escape too. Away into the wild, I know my hay mouth up inside. Can't wait to bury the ruins of my mistakes, to only keep it the truth, yeah. There's a treasure out there, just everyone should just have to choose, yeah. Here it is, a wisdom I must say, is that of my freedom of mind. Was born and restart all. I wanna escape and restart all. I wanna escape too.
Ladies and gentlemen, please take your seats. The next session is about to begin. Ladies and gentlemen, we hope you enjoyed your lunch. Please do take your seats as we will be beginning the next session very shortly. Please take your seats. Thank you. Ladies and gentlemen, we are going to begin momentarily, and that means really in the next few seconds, so please take your seats. Thank you. Ladies and gentlemen, please welcome back to the stage Jennifer Lasseter, Executive Director of the Digital Dollar Project.
Thank you. Thank you, everyone. I hope you enjoyed lunch. Thank you for coming back for this afternoon's sessions. I'm particularly excited about this next one. We will start this afternoon's discussion on financial innovation, not just tokenization, new rails, and automation, right, which is in the title of this panel, but the process it takes to achieve a global scale of innovation or change. This morning, we talked about technology and where we could go. Right now, we'll start the conversation of how we get there. Ladies and gentlemen, your moderator, the distinguished Carol House.
So much. Hey everybody, I'm sure you're all extremely excited about this amazing and distinguished group of panelists that I have here with me and talking about some of the, really dissecting the real issues around innovation and what these technologies look like and how we can achieve that change that Jen just spoke about. So far we've talked about domestic and international interoperability. We've talked about what money is going to look like in the future in 2030 and technological transformation, but now we need to get into some of the specifics around these innovations that have arisen to address issues that we see in the current payment system around the 5 key themes of this conference. Privacy, cybersecurity and resilience, financial inclusion, cross-border transferability, and competition and innovation. So in this age of technical innovation that offers so much promise related to all of those themes, the reality is that we haven't really seen that promise fully manifest yet. It's not been fully realized. It's faced challenges with implementation and presented peril in some long understood and observed areas and some kind of new ones as well. So ultimately, we really need to dissect the specifics of these innovations that potentially hold the promise for creating new rails and infrastructure, supporting both financial and non-financial activity at the same time, and that envision to really be the building blocks of the future of digital economies and smart cities. So let's get down to it and talk about what's really going on and why we're here. So first, let me introduce my amazing panelists. So first, next to me, you have David Treat, the Senior Managing Director at Accenture, who has a lot of really great insights that I can't wait for you all to hear about the intersection of things like identity as well as the future of money. Sheila Warren, of course, the CEO of the Crypto Council for Innovation, also a long history of the World Economic Forum, and has been a really great voice for what responsible innovation needs to look like in the crypto ecosystem. Of course, Vala Vakili, an institution over at Visa. So he is the SVP and Head of Insights and Innovation at Visa. Can't wait to hear his insights coming from one of the original fintechs in the space. And then, of course, everyone knows Miguel Diaz, Head of the Toronto Center at the BIS Innovation Hub, and who's been driving a lot of the incredible work with many of the central banks that are here today. So first, I'm going to open this up to all of you, and I'll start, David, we'll start with you and go down the line. So just a little bit of level setting on like why we're here talking about this. Given your unique vantage points, we have the fintech industry, we have financial services, advocacy, NGO representing many of the central banks and working with them. It would be helpful for the audience to hear your views on why we're talking about this, of like these innovations, why the new rails and automation, and like why we're talking about how we need to achieve this strategic change. So basically, I'll start with you, David, if you can start, and we'll go down the line to introduce the discussion with some of your views.
Excellent, thanks, Carol. I'm going to get some eye rolls from this. Like, let's go, just the basics. I keep reminding myself of the basics of where we are, that really in 75 years of a digital world that has been emerging, of the electronic transmission world that preceded that, and the physical letters that that preceded that for centuries. Tony actually set it up quite well, on the previous panel, and along with the other panelists, of we have only lived in a message-based business model forever. Right? And that is the fundamental thing that has changed, is that for the first time ever, we can have a provably unique object in the digital context, meaning more than 3 feet away from my person, that can be provably owned by me, provably transferred to Sheila with certainty, instantly, in an incredibly effective manner. We haven't had that. And so if we focus on, well, what business model does that change? right? I had a client. They're not in this room, but they might be listening. I had a client who, who characterized, look, the financial services world is a data reconciliation business that does a bit of banking, and so I thought it was a great quote. The promise now of if we just stay focused on this notion of a provably unique object in the digital world, that provable ownership, that ability to transfer with ease and certainty, we focus on the business model change that comes from it. What we're trying to do is not focus on the qualities or characteristics of the existing solutions that have been thought of, but actually pivoting the conversation to what requirements do we have for exchanging value at a distance further than 3 feet from our person. What requirements do we have? Because the technology is wildly configurable to suit now, and that's the interesting part of the conversation: is what are those requirements? How does it need to work? Who needs to be the operator, administrator, compliance, risk, audit, all of the pieces that wrap around it. I think we get too hung up in evaluating what's happening only in the context of the current solutions or only in the context of the current system.
Sheila, I know you have some thoughts about thinking outside of the current system and what we can do to help consumers. What are your thoughts about why we're here talking about these innovations and the how to achieve this strategic change?
So many thoughts, Carol. I think that we are seeing a time when a lot of our colonial demons are coming home to roost. The roosters are coming home. And I don't think we can have an honest conversation about financial systems without acknowledging the legacy of colonialism, of trauma, that exists at the individual, community, and country level in the systems. And the reality is that our current system works really well for a lot of people. It works not at all for a lot of people, and it works well enough for the majority of people. And I don't think our standards should be well enough. And I think what we're seeing in terms of the revolution that is coming, and I use that word deliberately, that could wind up being political upheaval, look anywhere, right? Or it could wind up being as simple as the recognition that the mechanisms Dave's describing, digital objects, which exist, allow us to imagine a system of value transfer and value exchange that is much more authentically focused on what consumers actually need and want. And I think that fundamental premise is what you're seeing start to expand throughout a variety. It manifests in multiple different ways, in myriad ways. It can manifest in permission systems that exist in existing operating models. It can manifest as brand new systems I am not even qualified or capable of imagining that are going to be ushered in by this new underlying architecture. But all of it comes, I think, from the fundamental recognition that we set up a system, it runs the way it runs, it doesn't work for everybody, and the everybody is getting to be a bigger and more vocal and more powerful group that needs to be heard and acknowledged, and this is one mechanism for doing that.
Vala, I know you have some thoughts. Visa has been driving innovation for decades and on meeting needs that hadn't been met previously. What are your thoughts about why we're here talking about the process and about the specific innovations that are needed for money?
Yeah, so my thoughts are a little bit different. They're a little broader about where we are in the innovation curve right now and what benefits and challenges that brings. So if you look at where we are in the broad scope of digitization, more and more people have access to digital technologies, and it is seeped into the sectors and industries that it was not part of when it was birthed, right? It's not just Silicon Valley anymore. It's every sector, it's every industry, it's government, it's education, it's healthcare, it's widespread. Because more and more of life is mediated by digital technologies, we rely on it to do things it was not designed to do. The internet was not designed to identify who we are. It wasn't designed to move money. It wasn't designed to enable value exchange. It was designed for communications and messaging. So there are some basic holes in the design of the internet in what we use digital technologies to do. Everybody is using them to do new things. It's not possible to have a company, industry, or national strategy that is not digital. And so it's being called on to solve questions around identity, solve questions around money movement, solve questions around value exchange that were not part of the original design. And that's, I think, why you're seeing all the innovation that we're seeing today. That's what makes me excited about what's coming tomorrow, is that these are going to be hard questions to solve, and they're going to need to be solved in many different places. And I think we're just at the beginning of solving those.
I love an implicit callback to that cartoon from the 90s on like, no one knows if you're a dog on the internet. So fantastic, really appreciate those insights. Miguel, can you finish kicking us off with this discussion? Why are we here?
I'll take you from the specific to the general and in increasing generality, but let me start with this. I think it's fundamental to discuss that we're living in an exponential evolution of technology era, right? And this implies that the digital realm is touching our everyday lives ever more. And when we thought about financial exclusion in the past, we could thought that it was bad because people would not get access to financial services. But if we think in financial exclusion right now, we can actually keep people out of society. So that is something that modern societies would not want to see. Now, given this situation, we have to see what our financial market infrastructures look like today in terms of the capabilities of processing transactions, in terms of the capability of producing different business cases and functionalities on a production scale that can serve this very big demand that is coming due to this digitalization process. And we can realize immediately that we need new financial market infrastructure. So Tony mentioned it in the last panel, and I think he's right on spot, that we need to rethink how things work in the back end. Now, tokenization is just one way of doing that. And I think it is relevant to study that possibility and to study that realm. But we also need to be aware that building a completely new financial ecosystem based on completely new protocols and systems, it's quite challenging. And it might be the case that we can enhance current financial market infrastructures with new functionalities that are consistent with what the people require for this new digital age. And then just work on top of those, introducing certain compatibilities of the traditional systems with these new functionalities and capabilities. And this is a little bit what we are trying to do at the Innovation Hub. So we of course try to understand tokens, we try to understand what is going on with DLT, which are the actual benefits of this technology, even if they are not that clear to some people like myself. But we also try to explore other technologies. We try to explore how to expand the backend, how to expand the functionalities of existing infrastructures, always considering that moving statu quo from the financial sector, from where we are now to a new system is extremely challenging, and not due to technical restrictions, but due to policy and to politics that move things behind. So we need to take into consideration that when we think about producing this supply to fulfill the demand for the new digital economy.
That tees up a really thoughtful discussion that I think that this panel can have about dispelling myths and misunderstandings. So having discussed what innovators and disruptors are trying to do, let's level set on what actually this technology is, what it means, and dispel some of those myths and misunderstandings we hear across policymakers. So I'm going to start with David and Sheila. So David first. I know you have some feelings about phrases like money is already digital. And can you unpack for us what tokenization really is, why it's different? What does this unlock for us? What does tokenization do uniquely or differently?
Yeah, it is one. How many people face that question, or have to still answer that question of like money is already digital? Yeah, all right. So I see a number of hands. It's one of my least favorite phrases to hear or need to respond to. I don't mind the question, but because it limits the conversation, right? We live in an increasingly digital world, and when we put our human needs at the center of it, we need solutions to be able to help us bring our identity, money, and objects and assets with us from digital experience to experience. We can't do that today. Today, we are constrained to a username and password individual relationship with each service provider in our life, and lo and behold, identity, money, and objects, every business transaction, I would love to hear if somebody can think of one that doesn't, involves identity and money. Most of them also involve an asset or a service, in the digital world. We are innovating against these tracks independently. I will go from here to another conference that's entirely focused on digital identity and verifiable credentials, and it's all based on the same underlying technology of a provably unique object in the digital world. And so we've had a huge focus at Accenture and with our partners over the past year in particular of bringing these innovation waves together to actually put the actual human, whether it's an individual human or groups of humans in a corporation, their needs together to say, look, I need to be able to bring my identity, money, and objects with me from experience to experience across firewalls to get the services and products that I need. I need universal wallet infrastructure to be able to hold that. In the physical world, I have a leather wallet that has a standard card size for things that fit in it. That wallet contains my car key, my building access, my financial credit worthiness on my Visa card. It's got my central bank liabilities in the form of physical cash. I'm the point of integration of all of the various services that I need, and yet I'm not enabled to have anything close to a great experience in the digital environment where I can traverse those experiences. And so when someone says money's already digital, it's limiting the conversation to realize that actually we need to focus on what, we have a digital world. If I pivot the question around, I think the better question is, in the digital world and experiences that we're existing, how could we better enable humans and groups of humans to work with the combination of identity, money, and objects, and lo and behold, the tokenization, that notion of a provably unique object applies as much to my college degree, my car title, my my library card, and those will all be different systems. They'll different architectural choices, and I need something to be that point of integration to then actually be able to innovate a whole new wave of products and services.
Huge implications for the infrastructure, regulatory regimes for financial, and not, man, we've got a lot more to do than just Linden dollars and World of Warcraft gold, I guess. Sheila, your thoughts, you're seeing really interesting use cases related to tokenization. What are your views about the uniqueness of what gets unlocked and what's probably needed to enable that across the systemic level?
Well, I want to piggyback a bit on something that Dave said, which is what he's describing is actually quite radical in its reimagining of how we think about our systems. Right? Putting a user, having a self-hosted, not unhosted, I hate that word, a self-hosted wallet at the center of the architecture is a radical design change. But what it unlocks is extraordinarily powerful, and it is actually how we like to pretend we function today, right? And how an analog world we kind of sort of function-ish, maybe not really, I don't know, right? It doesn't really make any sense. And so I also think there's a demographic shift happening here. So my other pet peeve, which isn't really answering your question, the new buzzword, right? Everyone's like, tokenization of real world assets, that's the thing. If you're doing that, it's great. If you're not doing that, it's terrible. What is a real world asset anymore? My view on that is very different from my 10-year-old's, let me tell you. What she thinks of as a real world asset that has value to her, that she wants to take from experience to experience, is very different from my wallet or my phone or whatever it is that I might actually think of as a real world, my house, whatever it is, right? And we are moving into a world where that transitioning between our online and offline realities, we may not like this as parents, let me tell you, I don't like it as a parent, but it is happening. It's happening at a pace that is ever accelerating. And so the idea that we need to be thinking about designing the experience around that self-hosting conceptually is just, it has to be the sort of starting point of the conversation. And it's really hard, I think, for people to get their heads around what that means because it is, in fact, so radical. And I think you said it so professionally and calmly, but it is a very radical idea. So what do we need to get there? Well, I think it's to Miguel's point. A lot of limitations are not technical. The technology exists, and it's operating in certain parts of the internet today. Operating is kind of, I'll use that word very loosely, right? Well, not well, depends on who you ask. It's really going to involve, I think, reimagining our policy environments, reimagining our business relations, how we're defining customer-business relationships, how we're defining peer-to-peer, who is a peer, in what context, what are we exchanging and when and how, what parameters do we have to have around that. And I think we should get there slowly. This is not change that should happen overnight. But I do think this change is inevitable. I firmly believe that. And I think the sooner that we start having the conversations in this way, with this as a sort of starting point and the foundation, the better off our policy and regulatory environment is going to be around accommodation of this rather than sort of resisting, this sort of, like I say, demographic inevitability.
Yeah, I appreciate you two helping to set the stage for the discussion about like the changes for the future of e-commerce, but then also I'm sure every regulator in the room is thinking like, wow, the regulatory perimeter looks very different potentially in this future ecosystem.
Can I pile on just one thing?
Sure, and then I'll, yeah.
Just super quick, but one of my other pet peeve questions that often
Oh,
follows.
I'm glad that I'm hitting all your pet
peeves. And Sheila touched on it, is this notion of like, well, people aren't going to want to self-custody. Like, I totally disagree. I just watched my wife, she's a doctor, she changed hospital systems. She spent a day and a half going through filing cabinets, emails, trying to find all the credentials to recertify herself. Those credentials were issued once, they were issued 20 years ago. They were asking who is the internship director at the University of Pennsylvania back in 2002. They're gone. Like they're not, they retired, and that one of them died. Like we are desperately seeking ways to hold on to the data that's important to us for the context of our lives. I had the same thing with a contractor last weekend. They asked me what paint color the basement was because we had to repaint the wall. I didn't know.
Like that color.
Yeah, it's like go match it. No, but the notion of I can have a digital twin of my house in token form to which I can aggregate all the data around that paint color was this, and I can now start to really accumulate the interesting information about my life that forms a new platform for products and services. And if you offer to someone a convenient, usable way to collect their identity, money, and objects in a place, we're now in a totally different world that I think we're all craving, actually.
Yeah.
Yeah.
And also to curate it, right? And I'll be quick, just to curate that, because I think what is also impressive, the amount of data we generate is mind-blowing. It is mind-blowing, right? And not of it, you don't care about all of that data, you care about some of it, and you care about some of it a lot. And the ability to kind of curate that and to say, these are the things, like I can quickly parse, I can quickly find it, I know where it is mine. It is I don't have to go through 17,000 layers of, whether it's file cabinets or online junk is even worse, trying to find a photo sometimes, oh my God, it's impossible. And so I think that I agree with you completely. The idea that people would not, almost immediately you can think of examples like Dave just did here on stage, where of course I would want that. Of course I want that ability, that experience. That is exactly what I've been praying for. We can do it today, we just don't.
Yeah, I get that user convenience and choice, and there's probably a lot of options and different considerations that users will think about in self-custodying money versus credentials versus other objects, like just like in the physical world, right? So I'm curious then on another piece of these false dichotomies, forms of money and payment. I think that this leads in well from the tokenization discussion. So we hear sometimes that there's this dichotomy of it's an either or. This has been discussed earlier today as well, but I'm curious what your thoughts are about your views not only on this false dichotomy of like we've got to pick one or the other, but maybe dig in deeper to specific ways that these different forms interplay with each other. So whether it's CBDCs, whether it's tokenized assets or the infrastructure like identity that supports it, what are your thoughts about the specific roles that private money and public money can play with each other, and how you're seeing use or integration between older and newer rails? Bala, can I start with you?
Sure. Thank you, by the way, David, for reinforcing the absence of identity protocols on the internet and why we're here today. I think these come down to different languages, fundamentally. And the challenge is that, and it's reflected in the room that we see today, is that all of our starting points come with specific languages around how we talk about the problem. If you're in the public sector, maybe in the central bank side, you might be talking about common ledgers. If you're, from our standpoint, payment network, you might be talking about interoperability. What we're both actually talking about is that people and businesses want to transact more easily in different environments. And it's hard to overcome the language barriers between sectors when we're accustomed to one way of working between the private sector and the public sector. Typically, the people in private sector organizations who work with public sector institutions are in one part of the business. They're not really tied to product development. They're not really driving the future roadmap and innovation. And that's what I think that's what this event and events like this, as well as all the collaborations that we're involved with in central banks worldwide, help break down, is really connecting one way of looking at the world, one way of talking about outcomes to another, and then rooting them in real world examples and case studies. So we have done pilots with central banks in Singapore and Hong Kong, Brazil, trying to bridge that gap between what states are looking for, what the private sector is looking for, and not really get hung up on what the technology is or what the specific solution is or what the, what our starting points are, but really trying to root it in what we're trying to accomplish. I think a great example is a project we did last year in Brazil, working together with Microsoft, Consensus, and a startup called AgriToken to look at the needs of farmers in high inflation environments who want to access broader liquidity markets. And what the assets that they have are really their crops. But there's no way to represent the value of their crops outside of their local market and economy. So in this case, tokenization is actually interesting. Tokenization, you can tokenize the crop contracts, you can bring it on chain, you can expose it to a broader pool of investors, you can open up liquidity. And the starting point is not, well, let's go look and see where we can push tokenization into rural agricultural communities. The starting point is really what are these farmers trying to do, what sorts of conditions do they see themselves in, and it blends access to liquidity, which might be something that is more private sector-ish, with challenge in high inflation environments, so it's something that might be more of a public sector concern, and enables us to work across barriers and really learn what we each value. And that's, I think, really the only way to get past some of these dichotomies.
Thank you. Miguel, some of your thoughts about these false dichotomies?
So to talk about dichotomies, I think it's important to go back to the basics on what type of asset is doing for the final individual. So if you go to the fully decentralized solutions, this is just a way of substituting or giving trust to individuals when they don't trust the traditional providers, say this a central bank or the financial institutions and so on. But then there are many other implementations in which these token-based solutions are just like a database. And the actual trust structure that needs to underlie this type of technologies is exactly the same as the one that we have now. So think about stable coins and compare a stable coin with an e-money issuer or with a bank. So basically they're taking deposits from the public denominated in M1, which is the prudentially regulated form of money, and they are providing a different representation of exactly the same with a slightly different technology. But in the end, it's not a bearer instrument. You need to have but you need to have a database to validate whether this thing has been double spent or not, and so on. So in the end, the liability and the financial trust that you need for these things to actually work and provide the service to societies boils down to the same elements. So when you think about digital M0 in the shape of a CBDC, and you think about what central banks have been doing since the 70s when computers entered the central banks, we already had digital money, sorry about this element, but we did have digital M0, and we have digital M1. And what we're switching here is that we're modifying one type of database for a new type of database, but the underlying need for trust is still there. One significant change is a fully decentralized solution, and that can provide trust when there is no trust. So think about countries in which you don't have trusted institutions to issue money. Well, it might make sense to rely on that trust on the algorithms and the cryptography, but when you have a trusted entity that can manage a ledger safely, and in which society trusts, it is kind of an overkill to go all the way and use the cryptographic elements to issue this element. So, of course, cryptographic elements and asymmetric cryptography are fundamental for everything to work, but not necessarily in the way of providing the issuance of trust. So we need to think again in terms of what each different type of asset provides to the public. And I think there's a space for every type of asset. So there's a space for virtual assets that are fully decentralized for those individuals that do not trust in anyone. There is a space for digital M1 in the shape of tokens or in the shape of traditional digital M1. And there is also space for digital M0 in the shape of CBDCs, as well as it has been in the past through the provision of digital M0 through RTGSs managed by the central bank. So if you see it from the final financial service or the basic financial service that is being provided, there is not so much new under the sun. And many of the benefits that can be achieved through tokenized solutions can also be achieved through enhancement of the financial market infrastructures that are operated by trusted central entities.
I love this perspective, highlighting that like design choices, ultimately there's positives and negatives, and it really depends very much on how you implement it. There's a variety of options that, depending on how you design it, can bring this. This hits at the final false dichotomy that I'm curious if we could maybe dive a bit into the how here. So it's around these absolutist narratives on innovation. Like on one side, feeling that proponents feel that innovation is good and should be pursued and permitted at all costs with no restrictions or boundaries, threatening the danger of technologies developing with no North Star or guidance or protections for consumers. And then on the other extremist side, we have innovation viewed as exclusively predatory and should be suppressed in favor of long-term incumbents and slow processes that refuse to acknowledge long-term challenges and issues. Most people and policymakers understand that there's a nuance in the middle, but those extreme views are represented in some places inside of the digital currency ecosystem. So on some of the features, because you mentioned decentralization as an example feature, I'll throw it to all of you to pick one of the kind of unique features that are discussed in a lot of these innovations, whether it's decentralization, tokenization, or automation. If you could apply one of those, whichever you like, to one of the key themes that we have, so whether it's cybersecurity and resilience, privacy, inclusion, cross-border transferability, or competition, what concerns you the most related to that innovation? Let's talk about the challenges, and then also what you think needs to be done to achieve systemic change to address the challenges related to those features. Let's give some concrete, like tangible sort of ideas to the how on this point. David, I'll start with you, and then I'll go to Miguel next.
You set a big table there. I'll start. Maybe start with the concept of, in the setup of your question, we do ourselves an enormous disservice in most innovation waves with the language we use. It is woefully inadequate. It is not. I thought your points were spot on, Miguel, but I get a rash when I hear someone tee it up as centralized or decentralized. That misses the point. There are three tiers. I won't get in. This will not be a technical conversation. But there's the wallet interface. There's the user experience. There's there is the ledger construct, and there's the network and the node operators. We should be having a much more elegant, detailed conversation around what are the characteristics of who we want to operate that node network. Lots of choices. It could be a defined group. It could be a defined regulated group. It could be an undefined group. At the next layer, who's providing the wallet infrastructure within which these tokens sit, and what are the characteristics of the services and the security and the privacy constructs that can be imbued into the wallet layer? And then what's the whole notion of what type of ledger? We need to have much more sophisticated conversations that are not binary. It's not permissioned or permissionless. Yeah. It's what are the needs of the system that I'm trying to modernize, with a deep understanding of the multi-stakeholder group, of that, including those that are not participating in our digital world at all. And then this technology is wildly configurable across those architectural levels. It's not binary. So I wish I could offer. I wish we could come up collectively with a new set of language to use. I think we do it implicitly in these conversations, and I think there's a really fantastic conversation that comes out of sessions and meetings like this. But let's not make it binary. The architecture is much more configurable than that. Let's center it around individual needs of individuals or corporations or business ecosystems, in their entirety. And then I'm just a massive proponent of there needs to be an open source foundation to this. The ability to not have umpteen different groups innovating independently, competitively, creating the same thing. There's a foundation layer to this technology space, particularly when we're talking about money as a public good, that should have a collaborative, open source, from a security perspective, and we could, if anyone wants to pull aside and talk about that, I could do that. Jim's here, he could do that. There's a huge advantage to an open source foundation, open standards layer, and then let's define the zone of competition that sits atop that for amazing products and services that that Visa or others would provide. We just need to do a better job, on both fronts. Collaborate where we should be collaborating, not using binary language, and really focusing the areas of competition where it's healthy and valuable.
Miguel, what are your thoughts about an area for concern based on these innovations and the way to achieve the systemic change?
So one thing I loved about this comment is focus on the functionality that is necessary and then optimize for the technology and not the other way around. And I think in many fora, we're doing it the other way around. So we start with a DLT and then we try to figure out how this thing could match a potential use case, as opposed to thinking, how can I make life easier for individuals? And then back engineer the technology that is more efficient in getting that result. That said, I wanted to touch on decentralization, because I think it was quite powerful. So when we see this exponential evolution of technologies and we saw the fintechs coming, that implied contestability in the markets for the existing financial institutions, and that was quite powerful. And banks started to produce new things and new services. But the decentralization revolution, it's absolutely beautiful because it generated contestability for the whole market. And the whole market implies financial institutions, but also authorities. And I think that is quite powerful, because if there is one element that is difficult to change, it's exactly the regulatory regimes and so on. But when you have this alternative option that is fully decentralized, that cannot be regulated unless everyone gets together and puts global frameworks, we need to see these decentralization movements as a floor that provides a basic functionality, so that the regulated entities would need to go above that level so that people could join in, like in a waterbed effect. So it sets the basis for the new evolution of new rules, of new services on the financial sector. So I think that was quite powerful from the decentralized movement. That said, again, I think we need to refocus our discussions on functionality and not necessarily on technology, but we need to be aware that different technologies have different implications and very positive impacts.
I appreciate the comment on it can be easy to write policy. When I was in policy at FinSec, I can write policy all day, but if it's not practically implementable or enforceable, what good is that? And it points to the need and the benefits of public-private partnerships and the fact that regulations don't work if they're not implemented with industry partners. So thank you. Bala, would love your thoughts about some of the concerns related to some of these specific innovations, whether decentralization, tokenization, automation.
Yeah, so I think what they all have in common is that most of the use cases are unknown and will be new and unexpected. And I think as a group of practitioners, we focus a lot on the known, by definition, because we're trying to transition how things are to how we think things should be. But that's typically not how innovation works. When all of us got a camera on our phone, we turned the camera on ourselves and took selfies, right? When all of us got maps on our phones, we turned our cars into taxis and our homes into hotels. We do things that are not expected when we get new technologies at scale. And the challenge, I think, for us, for industry and for policymakers, is to be attuned to the unexpected, be instrumented for the unexpected, be open to the unexpected, including that our starting positions might differ from our ending positions. There's been a lot of talk today about, whether or not certain actors are capable of changing and evolving and innovating. And to some degree, the answer implicitly is no at the beginning. But new technologies bring unexpected outcomes. And I think we should be more open-minded, a little bit more humble, and have more openness to the wonder that we will see as these technologies unfold.
Sheila, I would love your thoughts, not just on specific concern, but maybe I know that you feel very strongly about where the US sits internationally. And so if you're okay with that comment about the challenge for the specific innovations tied into your thoughts about driving systemic international change, including with the US, based on your thoughts of where we and other nations sit. Would love your thoughts.
Oh boy, in 3 minutes, where to begin? You know, I think, I'll start by just jumping off of Vala's absolutely perfect comment, which I wish we could have closed on. It's very hard to follow that. I think that we all lived here on the stage, and many in the audience, through the heady days of 16 to 17, right, where blockchain was very clearly a hammer going in search of a nail. You know, everything needed to be blockchainified and all of that, and thank goodness we're past that. I do think that period led to some experimentation that was very interesting, that will yield results that I think the world wasn't quite ready for yet. Similar to, I call it like the pets.com era, right, in some ways. That will all come to roost. I think that the reason we've seen so much more innovation in the global south, particularly in parts of ASEAN, is not only did you have a more digitally ready population, younger demographic, that had mobile devices longer, connectivity was not the issue that it is in certain parts of the United States or other places, and you know, because of the reliance on phones. For all those reasons, I think you saw more innovation, but I also think there were just more problems that were suited to this potential solution, right? I think we have to think about scale very differently. I think one thing that sets us back in the US is we have a concept of how a successful business operates, what it looks like, and what the size of it is. We worry a lot about monopolies here, which is not as big of a concern in other parts of the world. It is to some extent, but not the same way that it is in the United States. And I think a lot of this is thinking about scale very differently. Thinking about micro communities is something I talk about a lot. So it may be that the agri-token that you all launched, we did one in India, and that solution would not actually make sense in other states in India, let alone other countries. It just wouldn't make sense because of the environment in which that token was launched, in which that made sense in the context. So taking the baseline of these foundational technologies and saying what we need to be doing is thinking about how do we increase the aperture of innovation to allow innovators to solve problems relevant to them and their communities in ways that might scale in the traditional model, but might be more extensible or might have elements, right, that underlie them that can taken from place to place. The configurability of all of this is something I think is complicated in the US regulatory environment, and ironically, it's actually easier to affect that in parts of the global south that have both tighter and looser regulations, right? Tighter in some ways and looser in some ways, but that really kind of lean into this idea that to be successful, you can just solve an immediate problem in a small localized way, and that is fine.
I think that transitions well. Miguel, if you'd close us out, what are some specific concrete actions or steps that you would propose that jurisdictions, there are so many represented here, that they take related to addressing these innovations, the challenges that they present? What are some concrete measures you would propose?
So I think when you see the innovation environment around the world, you see many quite interesting things, like you have automated market makers, you have embedding of regulation in smart contracts, you have all these very nice bells and whistles, you have Nexus to connect faster payment systems. But when you go back and think what is the infrastructure and what is the ecosystem on which those very beautiful bells and whistles will stand, you see that most of the jurisdictions do not have that basic element. And there is a lot of innovation that is necessary on those basic fundamental building blocks for the digital financial ecosystem to evolve. Touching a little bit on David's point, I think there is a lot or a big opportunity for the world to go into this open source environment, to build these building blocks that can allow different jurisdictions on different levels of development to actually put together the basis on top of which lots of innovation can be built. So I do think that there are some public rails that are necessary in order to foster innovation, in order to foster the private sector to join in and to put all these creative juices to flow. But it is fundamental to work on the building blocks and to provide these building blocks to as many countries as possible. And for that, the open source perspective is quite fundamental, I think.
Specific, nuanced approaches with experimentation, engagement with populations to develop the requirements for technical engineers, creating momentum in innovation, because we're not quite sure what all the right challenges and implementations are that work together. Thank you all so much. If you'll join me in thanking my amazing panel for this great discussion. Thank you.
Ladies and gentlemen, please welcome back to the stage Josh Lipsky, Senior Director of the Geoeconomic Center at the Atlantic Council.
Oh, walk-on music is very exciting. Hi, good afternoon, everyone. It is my pleasure to introduce our second keynote of the day, Tobias Adrian, Financial Counselor and Director of the Monetary and Capital Markets Department at the IMF. Now, prior to joining the IMF, Tobias was Senior Vice President at the Federal Reserve Bank of New York and Associate Director of the Research and Statistics Group. He has taught at Princeton and NYU. He's a member of the editorial boards of the International Journal of Central Banking and the Annual Review of Financial Economics, and he is considered one of the world's leading experts on macro-pru financial stability risk, and we are honored to have him with us. But I wanted to close this introduction on a personal note. When I worked at the IMF back in 2017 and 2018 and 2019, it was Tobias and it was his colleagues like Tommaso Mancini and others who led the work on CBDC before many even understood the significance of these developments. They pushed internally for more technical assistance, fun speak for helping countries develop their own capacity in this area, and they said this is an emerging field. We at the IMF have to be ready, and they pushed the institution to do more so they could be ready in the years ahead because they saw the demand signal. So his vision, his leadership, and his technical expertise, the combination is extraordinarily rare, and again, we're honored to have him with us. After his keynote presentation, he will join Alison Versprill for a keynote fireside chat conversation. Alison is a crypto regulation reporter at Bloomberg, previously covered IRS, Treasury, and Congress. But first, Tobias, the floor is yours.
Let me start by thanking the organizers for inviting me to this wonderful event, both the Atlantic Council and the Digital Dollar Project. It's really a pleasure to be here a little bit away from Washington, D.C. Josh told me that this was very deliberate so that people would come here and actually spend the day. And that's exactly what I did. I sat in the audience this morning and listened to the previous panel and the previous keynote and really benefited from listening to the discussion and learning. So let me talk about both CBDCs and multilateral payment platforms. And it's going to tie very closely to many of the themes of the earlier panels and again, Cecilia's remarks earlier this morning. So what is the IMF doing in this space? And I would characterize it as doing really two things at the moment. So one is very much focused on CBDC. And it is about support to our membership. So we have 190 countries, and the agencies in those countries that are our members are essentially the central banks, the regulators, and the finance ministries in each of those countries. And an important part of what the IMF is doing is to provide technical assistance to those institutions to help build capacity. So we are working very closely with standard setters in order to help the membership. We have recently been focused on CBDC, so many countries have come to us to ask for help to think through policy questions about CBDC. This is very complementary to, I think, what the BIS is doing, which is more focused on the technological development and actually running projects, which is something we cannot do, we're not set up to do. We are providing more like policy advice and helping countries sort of like take the right decisions going forward. The second thing we're doing is to think about policy frameworks going forward, so develop policies going forward. This again is done within the international context on the cross-border payment side, in particular within the Financial Stability Board's Cross-Border Payments Initiative, where different institutions have collaborated to think about sort of like the future of payment systems. And here the IMF comes in as we have this sort of like role as a guardian of the international monetary system, right? So that is covering payments as well. So let me start with CBDC and then move to cross-border. So in terms of CBDC, there are many countries around the world that are exploring CBDC, and even if they haven't decided to go ahead with CBDC, they're sort of like either doing experiments or doing policy development. Again, this is done in close collaboration with the BIS, the IMF, and the World Bank as well. So last month, we put out a handbook, or rather the first 5 chapters of a handbook on CBDC, and we're planning to put out a total of 20 chapters. And here we are listing sort of like the 20 chapters that we are planning to put out over the next 2 years that are really about the policy framework of central banks around CBDC and the kind of decision process around CBDC. So helping countries, our member countries, to take the right decision going forward. You know, that in turn ties into our work on cross-border payments. So here we have been working, you know, to really upgrade, to think about how to think about the evolution of the global payment system as one of the key pillars of the international monetary system. So, you know, the international monetary system has the global payment system, but also capital controls, exchange rate arrangements, and then the global financial safety net, which are, you know, central bank swap lines and IMF lending. So those are the 4 pillars. So cross-border payments are an important pillar of the international monetary system, and that is sort of like the motivation, the secondary motivation of the IMF, besides the technical assistance to think about global payments. So, you know, tying back to the discussions from earlier, when you think about cross-border payments, there are, you know, 2 big pillars. So one is about clearing, the second one is about settlement, and there are evolutions in both of these pillars that are very important. The foundation for clearing is messaging. And so on messaging, we do have sort of like a very global, very multilateral messaging system that is pretty much used by every country and every financial institution around the world. The hurdles in clearing are oftentimes related to business process, legal challenges, and AML, CFT challenges. So we do see around the world that there's still a lack of trust, of oversight. So basically, in order to do cross-border payments, right, you have to trust that the institutions on the other side of those cross-border payments have all the processes in place to make sure that the payments that you are conducting are, you know, sound and legal. And so that is sort of like one big block of cost drivers. And, you know, technology can help, but it goes beyond technology, right? So it is, you know, technology can help, but, you know, processes, legal systems, and regulatory approaches are very important here. On the settlement side, right, so this is actually making sure that payments actually get settled. There are the actual movements of funds, there are the foreign exchange components, and you know, the contracts that have to be honored. And this is where common infrastructures can help. So in settlement, we still see a lot of fragmentation of liquidity. There's quite a bit of difference across different countries. You know, assets, so there are payments and then there are assets that have settlement systems, and there's certainly a need to improve on both of these fronts. So I think in clearing, there are many attempts for sort of like incremental fixes. So for example, to get to better overlaps in terms of operating hours when you think about the global economy, to improve standardization, and of course interlinking fast payment systems is to a first order improving clearing. Once you go from clearing to settlement, this is where platforms really become very key. And again, that's a point that was raised already earlier today. You do, at this point in time, you do need sort of like financial market infrastructures in order to get from clearing to settlement. So when you look around the world and you look at sort of like what works well and what works less well, so among advanced economies, high value payments, so wholesale payments work extremely well for both clearing and settlement, right? So, settlement is in the trillions of dollars every day. In the wholesale market, among advanced economies, it's very seamless. There are infrastructures that are super efficient, that have been operating for decades. But once you go to low-value payment systems, or you go outside of the advanced economies to low-income countries and emerging markets, you're getting more and more frictions, right? And so I think a lot of the motivation of the international community, we had already mentioned the G20, the BIS, the IMF, the World Bank, et cetera, is really to go to those low-value payments and those low-income countries and emerging markets to where there is a room for first-order improvement. Why are we here together? Clearly there are very rapid changes in cross-border payments, and many countries are facing macro-critical threats from payments. And this, again, is where we have done a lot of work at the IMF, to understand sort of like the vulnerabilities of countries relative to losing or the potential of losing monetary sovereignty due to cross-border payments that are outside of sort of like the regular banking systems. The way we think about that is that there's the very, very big picture international monetary system. I already talked about that. So this has a payment system component, but also these exchange capital controls, and then the global financial safety net component. Then from a country perspective, there's the monetary and financial stability. So each country has to make sure that they have monetary sovereignty and both monetary and financial stability. And so the payment system is the foundation for both monetary and financial stability. And then many countries are very much motivated by financial inclusion aspects as well. In advanced economies, of course, financial inclusion is very broad, but in many emerging markets and developing economies, financial inclusion is relatively low, and there are big opportunities through enhancements in payments to increase financial inclusion and foster lending and capital market and economic activity more broadly. So I think technology is providing opportunities to move ahead with these objectives, so a more inclusive international monetary system, a more stable monetary system, but there are also many risks, right? And so the goal of the fund and other international financial institutions is to really use those technologies for policy purposes, i.e., employ all the greatness of encryption and programmability and tokenization in order to achieve policy objectives. And I think that is where the interesting work is going on at the moment. So the risks that we are seeing more concretely is that we could end up in a fragmented world, not just politically, but also in a fragmented world in terms of the underlying pipes of payments, which ultimately underline capital market activity and broader economic activity. We could end up in a world where we have connected entities to some degree, but some entities and some countries that are excluded. And as a global and multilateral institution, we are sort of aiming to provide a basic connectivity, a basic set of rules and governance that is truly multilateral and inclusive. So I think that is the ambition, is to aim for innovation that is compatible with policy goals and that is inclusive relative to the broad membership of, say, the IMF. So let me, oversimplifying a little bit, compare and contrast two models of payment connectivity that are being debated at the moment. The one is the interlinking of fast payment systems, and Cecilia explained quite a bit of that already. And that, is extremely powerful, as she explained, right? So you can have sort of like a central hub where these payment systems are being interlinked, and it can, in principle, provide a broad interconnectivity around the world. But of course, to get to the settlement stage, common platforms are likely needed. And so the way we look at the world is that there's not one solution that solves all problems. So we really think that a multi-pronged approach is the right approach, where you have a variety of possibilities of doing cross-border payments. So the platform model is connected to each of the networks. Money is moved through the platform, it's end-to-end, and it's backed by escrowed money. In particular, what we have in mind are sort of like tokenized versions of central bank money. Forms would offer settlement services on a trusted, integrated, scalable, and widely accessible environment. We are working alongside BIS Innovation Hub. So in particular, the BIS proposed this concept of unified ledgers, which is very much aligned with the second model. The BIS Innovation Hub is working on interlinking the fast payment system, but it's also working on many bridges, which are platforms for cross-border clearing and settlement. The World Bank has various projects, particularly on interlinking. I mentioned already the FSB, together with the CPMI, led work on these cross-border payments platforms. And then, of course, there are all the private sector initiatives that we already heard about. So I want to talk about one particular version of these proposals, which is what we were thinking about, which we call the XC platform. And it is really aiming at using new technologies in order to enhance cross-border payments in a fully policy-oriented way. So there are three layers. There's a settlement layer, so actually making sure that payments get end-to-end from entity to entity across borders. There's a programming layer, i.e., while money in and of itself is not programmable, you can have programmable features that are built into platforms or that can link into platforms. And then importantly, there's the information management, right? So what we are having in mind is that on the platform you have anonymity, But to get on the platform, you have very high bars in terms of AML CFT requirements, identity, etc. So the information management in turn is closely tied to the AML CFT and governance concerns. And in many ways, the settlement and programming is more advanced than this governance work. And this is where the technical assistance becomes so important, i.e. building capacity in all countries to upgrade identity, AML, CFT, and financial integrity more generally. So, again, it's the legal challenges to governance that are really, really important, and where capacity building is so important. To finish off, let me just point out that money has always been a partnership between the private sector and the public sector. When money was purely private, it didn't work all that well. So central banks were created as a backstop for commercial bank liabilities. But when you think about financial systems today, 90 or 95% of monetary liabilities are private sector liabilities, right? They are the deposits of banks. So how to calibrate the interaction between the public and the private sector is extremely important here. There are examples where central banks built systems that were not adopted or used by the private sector. So having a very strong focus on what is the role in the private sector, what's the role in the public sector, is first order for cross-border payments. Though it might vary across countries, right? So there are very different cultural differences across countries, different histories, different institutional setups. So it's something we put a lot of care in, and we do a lot of outreach to understand what the right balance is. So with that, let me turn to the next part.
Hi, my name is Allison Versperell. I cover crypto regulation for Bloomberg News. Thanks for joining us for this later in the afternoon panel. So during your discussion, you talked a lot about multilateral platforms potentially being a way to improve cross-border payments. When you're thinking about that, I mean, what has been sort of the biggest challenge? I think we see projects here and there kind of addressing these in smaller pockets with countries, but in terms of getting all of your members, 190 members on board, what are the challenges that you're running into?
So that's an excellent question. So let me first point out that the fund is not so like a very operational institution. Right. It's really more about governance. So when I talked about the platforms, this is really policy development. Right. But it's up to our membership and the private sector to actually build such things. Right. Again, the BIS Innovation Hub plays an important role in actually working on the technology side to build some versions of those platforms. Our ambition would be to have platforms that are truly multilateral. So for example, messaging is done in a fully inclusive way around the world. I think as a multilateral institution, our ambition would be to have settlement also be truly multilateral. So the challenges are about the governance, right? It is about making sure that countries come together and agree on the standards related to integrity, identity, information sharing across borders that makes everybody at ease to settle on the platform together. And I think there is, of course, a regulatory body, which is the CPMI, which plays a very important role in terms of developing regulations around these platforms. And we are playing an important role in terms of helping countries implement those regulations. But we think that there's really an opportunity to have a more ambitious approach to cross-border payments that is linked to such platforms.
And how difficult does that sort of standard setting policy making become when you have, already different countries maybe moving at different paces, some kind of lagging behind? How do you get to some sort of global rules?
Yeah, so it's a slow process. So I think this morning on the panel, somebody said that to get CLS started, which is a payments platform for wholesale payments for a subset of countries, it took many, many years. So ideally, we would move more quickly, but these international financial institutions, such as the IMF, I think can be helpful in terms of getting to consensus about how we should be going as a global community to upgrade global payments.
And in terms of leveraging new technologies, what are you seeing really being used at this point, or where do you see kind of the long-term timeline on how some of these technologies can be used?
Yeah, so I think in the shorter term, the interlinking of fast payment systems is a very achievable and very important step, and I think that's a significant improvement. But it's not in and of itself sort of like using new technologies, right? So the power of encryption and programmability and tokenization. So those are the three technological improvements that we are seeing. So in our view, getting two cross-border payment systems that are incorporating all three, so tokenization, encryption, and programmability, that would be the more longer-run goal.
And I wanted to go over some of the projects we've seen already to try to improve cross-border payments. We have the mBridge project, which is China, Thailand, Hong Kong, and the UAE. Then there's Project Dunbar, which is Australia, Malaysia, Singapore, South Africa. You talked a little bit about some of the risks and fragmentation. Do you think when you have these projects that just involve kind of, some subsets of countries, does that increase the danger of maybe having more fragmented global payment system, or what can we learn from those projects and take forward?
The projects are very important in terms of understanding what works, and they started off as technological projects, but I think over time we have understood that the governance is so important. The legal frameworks, the institutional capacity across countries are extremely first order. Business processes are extremely important. So I think the global community has really benefited from seeing those projects being rolled out, and there are more and more of these projects that are starting. Still, I do hope that we can get to a more ambitious, more multilateral approach at some point that can benefit countries more broadly, which is really the mission of the IMF, is really to have this broad multilateral approach. Given the level of fragmentation, the geopolitical fragmentation that we have seen around the world, that is certainly difficult, but I do think there's an opportunity to actually come together and to agree on improving cross-border payments as foundation of financial systems, banking systems more broadly. So I think it's, while it is ambitious, I think it's possible, and it is very important for the world.
And when you're also thinking about the global payment system and some of maybe these different projects or countries moving forward, how do you ensure that different systems aren't being set up to evade maybe AML KYC requirements or sanctions or things like that? How do you think about that?
Yeah, so globally there are mechanisms to enforce AML CFT. So FATF certifications are particularly important here. Within our FSAPs, our financial sector assessment programs, we also have an AML CFT component where we are assessing the institutional capacity of countries. And we are providing technical assistance to help countries build the capacity to do AML CFT around the world. It is difficult and it is challenging. When I moved to the IMF 7 years ago, and I'm reflecting sort of on what I've learned, it's really, the institutional capacity is so crucial for economic activity, for economic development. And, technology can help, but it doesn't solve institutional weakness of legal systems, of enforcement, etc. So it is hard work, but multilateral institutions such as the IMF or FATF or the FSB really are there to help countries implement AML CFT requirements, broader financial integrity requirements, and to assess how far they are and where they have to go. Of course, that is complemented by enforcement mechanisms through law enforcement and courts around the world. There are no silver bullets, unfortunately. But I do think an infrastructure can be the basis for providing stronger incentives for countries to sort of upgrade identity, KYC, AML, CFT, in order to get to higher standards of financial integrity.
And to this question, I mean, during your presentation, you mentioned that a lot of this will have to involve both the public sector and the private sector. Can you maybe elaborate on the role you envision the private sector playing in all of this?
Yeah, absolutely. So, the financial system is run by the private sector, and the public sector is providing backstops, is providing oversight, and is providing regulations. But ultimately, we need to create a financial sector that helps economic activity, that improves economic efficiency, financial inclusion. And so it's the interplay between policies and regulations and private sector initiatives that are going to lead to success, right? So, these are processes that evolve over time. And I think when you look in cross-border payment space at platforms that are very successful, these tend to be public-private partnerships that have come to governance mechanisms and regulatory oversight that has worked for the benefits of countries for payments purposes, which again is the basis for capital markets and economic activity.
And what happens, I mean, if there are countries that decide they're not going to maybe invest in exploring these new technologies or moving forward in this way, I mean, what happens? I mean, what is your prediction on those that fall behind?
So, payments are multi-pronged, right? I mean, if I want to pay you for some service or so, I can do that in many different ways today, right? And I don't think we want to think of cross-border payments as having one solution that solves all problems. I think there will always be a multitude of approaches, and different countries will make different choices, right? So, we don't want to think about one thing that works for everybody. So it is multi-pronged. The incentive of participating in platforms are network effects, right? It is that the more countries and the more institutions participate, the higher efficiency can be achieved. And that's a very, very powerful economic force. Now, it does require that you fulfill these requirements to be participating on the platform. And that requires that you have the legal, institutional, and regulatory frameworks to participate. And I think some countries may not need that. Some institutions may not need that. But being part of the platform or the platforms in principle provides incentives to improve the institutional environment.
And I guess to switch gears a little bit here, I know you started with CBDCs. I guess I will switch and end with CBDCs. Let's talk about CBDCs versus stablecoins. And I've heard some chatter of, well, if you just regulate stablecoins, then that can kind of have the advantages of having a CBDC, especially the U.S. right now seems there's some political headwinds on the CBDC front. Can you talk a little bit about that? I mean, do those serve essentially the same function? What are kind of the benefits, the risks of either one of those?
Yeah. So, I think there are two important dimensions to stablecoins. So the first one is about technology. So do you use DLT and encryption for payments? In principle, you can use those without stablecoins or CBDC, right? So a number of countries are moving towards exploring tokenization of commercial bank deposits. And I think, again, this morning we heard some discussion around that. So, new technologies could in principle be used by banks as well as by, say, stablecoin providers and potentially by central banks. There are many hurdles, many regulatory and legal hurdles at the moment to do so, but there's certainly a push by countries to understand how to do that. The second aspect to stablecoins is that they have some features either more like money market funds or more like narrow banks. So the money market fund version of stablecoins holds its assets in marketable securities such as treasury bills or so, while the narrow banking version would hold it in either commercial bank deposits or in central bank reserves. So the question for countries is whether they allow stablecoin providers to actually hold reserves in central bank money, which many countries don't allow at the moment, but are exploring, and whether stablecoins that are more like money market funds, i.e., where the stability of the liability is not guaranteed because the asset is fluctuating, whether that is considered to be a stablecoin. So I think, what is the reserve is one question, and what's the technology in terms of having more of a tokenized and wallet-based payment system as opposed to an account-based payment system. So those are, I think, the two economic questions. Countries are exploring, phasing in CBDC as well as tokenized deposits as well as stablecoins, so that you can think of that as upgrading not just one of those things, but so like the entire ecosystem of the financial system where countries are coming out could be very different across jurisdictions. Again, we see our role at the IMF not so much as telling countries what the right pathway forward is, but to help them make the right choices and take the right decisions in terms of thinking through trade-offs and making policy choices.
Well, in terms of countries that are moving forward with CBDC, are there common threads on the ones that are kind of moving fastest, or what are the use cases that are cropping up?
Yeah, so I think when you think of the CBDCs that are already in existence, 3 of those are in the Caribbean. And the use case is very much motivated by the catastrophe risk of hurricanes, right? Where it's extremely difficult to get cash across the hundreds of islands. And so having electronic money that can be used for transactions, but also potentially for payments, for transfer payments, is extremely powerful. I think this is why we have seen quite a bit of movement in the Caribbean there. I think the second important use case is, again, what Cecilia was talking about earlier today, which is about the disappearance of cash, right? As we're moving to a digital world, cash usage is disappearing, and countries would like to have some ability for individuals or corporations to actually hold central bank liabilities. Even if 95% of monetary liabilities are private sector liabilities, i.e. deposits, as a central bank, you would like to be able to issue liabilities that people can hold in principle. And if there's no more cash, no more physical cash, there's a strong case for some form of CBDC. Though, countries could take another approach here, right, which is to allow banks to issue tokenized forms of money, but to have a very strong backing by central banks, so to exchange tokenized private money against tokenized central bank money in wholesale CBDCs. So I don't think we will necessarily see retail CBDC everywhere, but we may see more motivation to wholesale CBDC, perhaps combined with tokenization of deposits. Though again, that is, from a legal perspective, that is possible in some countries, but in other countries, it's actually extremely challenging to tokenize deposits. So again, there's a lot of difference across legal and regulatory frameworks across different countries. So I would think that we will see some movement in this direction, but it's not going to be the same across the world. And I think the third use case for CBDC is financial inclusion. So, in advanced economies, the financial sector assets relative to GDP can be, 300, 400, 500% or so. In many low-income countries and emerging markets, it's like 20 or 30 or 50%. So the potential for financial inclusion is tremendous, and extending payment systems is a first step towards credit and other financial services. And we have seen in some countries tremendous inclusion benefits through broader access to payment systems.
And I also wanted to talk, one of the things you mentioned in your speech was the CBDC handbook. And in that, I thought there was an interesting point about, one of the potential risks being larger and more volatile gross capital flows. Can you speak a little bit to that and how countries should be thinking about that as they're designing CBDCs?
Yeah, so it goes back to sort of like my main theme, which is about institutional fragility, right? So, the vast majority of countries does have some form of capital controls, right? And that is a way to make sure that capital isn't leaving the country, and to make sure that monetary sovereignty is still staying in the country. So digital form of money from an individual perspective might be very rational, right? So you might want to hold your savings in foreign currency, and that could be that much easier in a digital form. But of course, from the point of view of the government, it does undermine your ability to conduct monetary policy. In our assessment for some emerging markets, that is of macro-critical magnitude. So dollarization has always been a challenge for emerging markets, but it can be more of a challenge in digital age. So, this is again where sort of like policy objectives and individual objectives might not be fully aligned, but where policy frameworks are extremely important. So as we're thinking about upgrading cross-border payments, we also have to think about the role of capital controls in the world, which given institutional weaknesses in countries, is an important element to make sure that macroeconomic stability can be managed.
Well, and it looks like with that we are running up on the end of our time here. I'm sure these are going to be topics that we're discussing for years to come, so I'm sure there will be plenty to learn from you in the future, but thank you for joining me.
Thank you.
Tobias, Allison, thank you so much. Wide-ranging conversation and multi-platform CBDC. I'm glad we got into this topic, and when we get into the workshops tomorrow, we're going to dig into this more, not just about what's being done at the IMF and the BIS and others, but what could be done in the years ahead and how private sector and public sector can collaborate. So we're going to go into our final coffee break now. When we come out at 4:15, please come back at 4:15. We have our closing session featuring PayPal, Linux, Stellar Development Foundation, and the World Bank. We just featured the IMF, so contractually we have to have the World Bank on stage. We know how that goes. And Michael Greenwald of AWS will moderate. So please come back 4:15. At the end of that closing session, we'll give special instructions about our Keynote Gala Dinner, which is in another venue very nearby, featuring distinguished speakers, including former Speaker of the House, Paul Ryan. So we'll see you back at 4:15. Check out the FinTech Hub, open now. There's a presentation from TRM and Guidehouse on risk and security. Thanks, everybody.
get that light, so now we build it in a fire. When I get those lights, this time we bring the music higher. When I get that light, so now we build it in a fire. When I get those lights, this time we bring the music higher.
Ladies and gentlemen, please return to your seats for the final sessions. We're about to begin. Thank you. Ladies and gentlemen, the final sessions of today are about to begin. Please come into the room. Please return to your seats. Thank you very much. Ladies and gentlemen, please welcome for the penultimate time today to the stage Jennifer Lasseter, the Executive Director of the Digital Dollar Project.
Thank you, everyone. Thank you. Again, I'm so excited for this final panel discussion today. Thank you for returning from the coffee break. This is a really great primer as we lead into our discussions at dinner tonight. So this last panel, last but certainly not least, this discussion today, From Concept to Reality, Building Digital Assets at Speed, addresses the heart of this moment. Meeting people where they are at, often today that is unfortunately in times of crisis or limited access, and working to reestablish trust in institutional systems. As Josh mentioned in his opening remarks this morning, finding ways to work together to deliver that future safely and effectively should be our mission. And the executives that are going to join us on this stage for this discussion are doing exactly that. So ladies and gentlemen, your esteemed moderator, Michael Greenwald.
Jennifer, and thank you so much to Josh and the Atlantic Council, Digital Dollar Project, Michael Greenwald, Global Lead for Digital Assets at AWS and Financial Innovation. It's such a pleasure to be here with really this rock star panel, and aren't these the best chairs you've ever seen at a conference? I must say, we're doing something very well here today. So I want to just introduce the panel. We have Richard Nash, Vice President, Head of Global Government Relations at PayPal, Jim Zemlin, Executive Director of the Linux Foundation, Danelle Dixon, Executive Director and CEO, Stellar Development Foundation, and Haras Natarajan, Practice Manager, Financial Inclusion and Infrastructure, Competitiveness and Innovation. I think you won the best title. That covers everything we have for the panel. But I want to kick it off, and Danelle, I want to turn to you first regarding how will the evolution of payments come to include digital assets such as CBDCs, stablecoins, and decentralized finance? What does that coexisting space look like?
Yeah, I think it's great that it's, thank you for the question. Thank you all for being here. It's already happening. And what I think the larger part of your question is how will it get to the mainstream piece? We're already seeing companies and organizations like the UN leverage the digital asset space to be able to make payments and to make payments with aid into different countries. The only way that it really gets there, frankly, in my opinion, is if we see legislation around stablecoins and what stablecoins should be and creating standards around that so everybody's more comfortable. We saw PayPal recently get into the stablecoin spot. There are not a lot of other players want to, but they're fearful, particularly banks. Want to come into it, but they're fearful of what's happening in the United States. So really to make this work, we need to be able to have legislation around here that creates standards. We already see that happening in Europe, but we need to see it more globally. I think the US needs to take a lead in that. We're hoping. I don't know, some of you might have read the McHenry statements today that it could happen by the end of the year. That would be awesome if we could get that done, because I think that actually creates the foundation to be able to make it happen. The tech stack is there. People are leveraging it. We have 1 billion transactions on the Stellar network that happen every single month. And like 60% of those are payments and international payments. So it's happening already, but to happen at scale, we need to see that happen.
So speaking of scale, I mean, Richard, just speaking to you, same question. How do you see that coexisting framework really take place, take hold? And I mean, just given your vantage point at PayPal and seeing so many transactions take place a day, what do you see as that moving forward?
As coexistence of regulatory frameworks? Or?
Yeah.
Wow. I don't quite know where to start sometimes with that question. I think the, as Danelle was saying, look, I think there are lots of drivers as to what's going on in the system, right? Drivers from a regulatory standpoint, from providers driving, using digital assets for, we've seen wholesale CBDCs, we've seen back-end payment systems for banks, intrabank payments. We're seeing users demand and inquire more and more about how to use digital assets for payments is obviously where our expertise is. And obviously, we've seen digital currencies in other forms spring up and be absorbed into the system. Our goal is trying to figure out how we bring, as a payments company, all of these things together and make payments more efficient, cheaper, more effective, more accessible to people. And so we come at it from that perspective, which is sort of true to our track record with payments over the years. In terms of coexistence of how regulation then comes about, I think you sort of need to break that down a bit further, right? Because we've got regulation today that looks at different aspects of financial services. And even if I then take payments as a concept, obviously we're subject to payments regulation across the world, and it comes from different places. And then I think what you're going to see on top of that is sort of more attention to who gets to play in the different spaces, to Danielle's point. And then also a lot of this is going to be impacted by other drivers, right? Economic drivers, concerns about broader economic issues and how innovation needs to fit within that. Some of the risks that have materialized in certain spaces and reaction to that. And then who's seeking to play, I think, is another really interesting aspect that's going to drive a lot of that. But yes, we do see coexistence of the different assets. I think in terms of how from a regulatory standpoint things fit together, I think that's a huge question and one that we could probably spend a lot more time digging into.
Yeah, Harish, I want to bring you in. I mean, regarding coexisting of those three buckets of digital assets or existing individually in a regulatory framework, just what have you seen coming from the World Bank and looking globally?
Thank you. No, I think if you look at payments innovation over the last several decades, I think there's been this quest to decouple payment services, first from the banking business. The e-money and other developments kind of achieved that. Then came the attempt to de-link the payment services from the provider of the account. That's where the open banking and tokenization, card tokenization comes in. And the third one, which is the quest which is underway now, which is about even removing the need for the account provider. Of course, this has to collide with customer expectations, behaviors, and so on, as well as the public policy objectives with, which my colleague from the IMF alluded to during the previous panel. So I think how all these three kind of come together, how things balance out, I think is what will shape. One would expect a coexistence for sure. I think there is also this desire for speed. There's also this desire to look at financial services not as a distinct activity, but something which is embedded into economic activity. So that will call for different forms of money, different forms of assets, different ways in things are exchanged. So I think it is this intersection between customer needs, technological advances, and the public policy objectives. And it is, I think, incumbent on all the stakeholders to help and shape it responsibly.
So, Jim, I want to turn to you regarding open source infrastructure and building on the coexisting question we just discussed. What's the case for open source infrastructure? Maybe just leveling that for everyone here,
Sure.
And then let's build on it together.
Yeah, I mean, there's the obvious advantages to open source around transparency, trust. I would argue there's a security advantage to open source, the sort of idea that many eyes make all bugs shallow and reduce the amount of vulnerabilities in a public code base. And I think the last and most misunderstood part, particularly in this area, is just the efficiency of it. A long time ago, the tech sector kind of went all in on open source. In fact, you all use open source every single day. You probably don't even know it. 80 to 90% of the code in all technology products and services these days, anything modern, is open source. If you don't believe me, just who's got an iPhone here that can just play with me on this one? Take out your iPhone, go to Settings, and then go to General, little General section, scroll all the way down to Legal and Regulatory. And then at the very top there's a Legal Notices. Now these are the license notifications for all the open source software in an iPhone, which many people consider the most closed ecosystem around. And just start scrolling. I'm going to keep going here. It just keeps going and going and just keep going. Any of you out there, please join me in on this one.
I promise you, we didn't discuss the show and tell. It's all coming natural.
The point is that, the efficiency that comes from using reusable public building blocks that are transparent and trusted is something that is a part of tech. And what I witness in a lot of digital public infrastructure, unfortunately, is being behind what the tech industry already knew, which is that if we all collectively use a common upstream code base, we can all customize it, that final 10% of the code, to our local jurisdiction, to our local regulations. Now we have to, that's the code artifact. There's a standard setting. These are interoperability artifacts. The secure asset transfer protocol is an example of that the IETF's working on for digital asset. And then there's the policy framework on top of that. These are all compatible, but they're a nuanced conversation. I think that Dave said that. But just to give you the even most concrete example of why open source is so efficient, in particular in this area, is to give an old example from one of the most hyper-competitive closed software companies in the world, Oracle. So Larry Ellison has no love lost for his competitors and decided that they wanted to have their own version of Linux. And this is the largest software company in the world. The way they created this Linux distribution, this Linux operating system, is they took Red Hat Enterprise Linux, which is all open source, cut the word Red Hat, pasted the word Oracle, and recompiled. And so they just got to market immediately, and they added value where they could, which is in support, in compatibility testing for their own products, and they focused just on that value. That's what I would recommend this sector also do.
So let's build on that. What does open source infrastructure mean for digital assets, and then more broadly, future of money?
I mean, open source is, whether it's distributed ledger technology like Hyperledger projects, Besu, Fabric, which are being used already in proof of concepts in Norway and India and for other CBDC efforts. So you kind of have to, you can't be turtles all the way down, right? You kind of have to build your way up. On the retail side, we have an open wallet initiative, which is a reference architecture for something Dave described earlier today, which is that wallet that brings together, your identity, currency, your objects. There are open source identity systems. These, again, the digital artifacts. So all of this is where the innovation happens organically and hyper efficiently. I think in a regulatory framework, one of the things that's important is also place regulatory burden on those who can shoulder it the most. It's important to understand how tech flows. Developers create under a free and open license the code, the artifacts that are used to run all this stuff. Downstream, a government, a service provider, they offer a commercial service to customers, they indemnify their customers, and they're the ones on the, nobody calls me for support, they call these folks for support. It's very important to understand how that works so you're not throwing the baby out with the bathwater on the innovation front.
So speaking of support, Danelle, how does open source infrastructure interplay with what Stellar is doing day to day?
Stellar is an open source decentralized blockchain network. Not only is the network itself open source, but any kinds of tools that are leveraged that certainly are built within our community and our ecosystem, we're also open source. We just recently built an open source tool, and it was open source 2 months ago, that is about bulk uploading of bulk payments, so that you can upload thousands of payments at one time, and then you can have that be interplay with a wallet that's Stellar enabled, and then you can actually make payments at scale. And the UNHCR, the United Nations High Commission on Refugees, is actually leveraging this tool right now in aid distribution in Ukraine. So over the Stellar network, using a digital asset that's built on top of Stellar, so built on open source code, and then distributed into Ukraine, and then the users who receive the aid within 3 seconds, they literally can download the wallet, they get a text message, download the wallet, receive it. Within 3 minutes, they can have that whole process done. You can then cash out at one of the most traditional financial infrastructure companies in the world. It's a 100-year-old MoneyGram. So the thing that's beautiful about this is you can see how this open source code that is just this network that's out there for anyone to build on and to make better. I'm a big, big believer in open source and the usefulness of it. Can interplay very nicely and interoperate with the most traditional financial infrastructure. And so it's actually being leveraged every day. And the beautiful thing is, like, one of the misconceptions about open source code is that you can't make money from it. Firefox, I was the COO of Mozilla for many years. Firefox is a browser that is built on open source code and contributes to the open source code base all the time, and it is able to make money, and many are able to leverage that to be also to generate revenue. Open source code is out there and available all the time, and is only made better because we have communities like the Stellar community who build on top of it.
So let's just dive deeper for a moment into Ukraine, because Stellar's played a pivotal role in Ukraine, and I think it'd be really helpful to share with us some of the lessons you've learned, what have been some of the takeaways given a conflict zone where digital assets are playing a very big role.
I think it's really important, and this is one of the, and maybe some in the space would disagree with me, but I look at this kinds of technology as just another rail. And so it should be leveraged by aid organizations in the locations that make the most sense for it. And in this scenario, why Ukraine is a perfect location for it is even prior to the war, we were working with President Zelensky and his administration because they wanted to move to a cashless society. They were actually contemplating, we were working on a pilot with them on a CBDC. They've since transformed that into digitizing deposits and bank deposits. And so they're moving to what's called the TPN, a transparent network, privacy network. But from that standpoint, and there's also a lot of folks there who have smartphones. You can actually use the same technology on a feature phone, but who have smartphones and are comfortable leveraging that. So it was the perfect situation for this kind of technology to be used there by the UNHCR. We were able to start working with the UNHCR in February, right after the conflict started, the war started there, and we actually launched by December, so less than a year, they were able to launch this product into market. The learnings that we had is it's really important, particularly from the UNHCR side, that this not be about crypto. And the truth is, this is not about crypto. This is about blockchain technology and the usefulness of the tech stack itself. And so the wallet that they leverage for this particular, for aid distribution is a wallet that you can send and receive assets. This is a stable coin. It's using Circle's USDC asset. So you can receive that asset and then you can send it to the MoneyGram locations, or you can send it to your bank account once you've received it. But it was really important to them that you don't have it then be this space where you go off and buy a bunch of crypto. So we closed down parts of the wallet to make it so that you could only do the send and receive functionality, and that was a really important piece for them. I think that what I loved about this is that not only was the UNHCR able to work so quickly to make this happen on their end, it's using those open source tools that was able to help, that not only were we working with them to make it better, but there were thousands of people contributing to make sure that the code base was secure. And so this is what the beautiful thing about all of this coming together. In the UNHCR situation, it's again coming up on a year, thousands and thousands of recipients they receive on a weekly basis. It's not my story to tell the numbers that they've sent, but it's significant, and they're now expanding into other regions as a result.
So speaking of the innovation, coming out of Ukraine, Richard, what we've witnessed recently is an important executive order in Washington on artificial intelligence. And prior to that, you had an executive order on digital assets. And in both of those executive orders, you had a term that I think we've all circled, responsible innovation. And so as you're looking at, first the digital asset executive order and the artificial intelligence executive order, how are you defining responsible innovation, and what does that mean for you and PayPal moving forward?
Wow, another great question. I think, look, for us, responsible innovation is about how we meet user needs whilst making sure we're protecting the financial system. Simple as that. And I think we've always tried to think about how we're offering more choice and building new services in partnership with others and staying true to that mantra. I think responsible innovation is a responsibility of the whole ecosystem, industry together with regulators and governments and everyone else. And I think within that, you're looking for terms of like accountability, transparency to stick out. And we see that a lot, especially in the recent EO on AI, right? You're looking at how do you identify areas of risk? How do you measure that? How do you quantify? And what do you do about it? And I think that EO in particular was incredibly extensive, well documented, literally. And I think gives a lot of onus on different parts of government to come together and think about what are the goals that we're trying to achieve, whilst mitigating some of that risk. And I think that is an incredibly important thing to look at. I think from our perspective, again, I think it was mentioned earlier about it, that we launched a stable coin earlier this year. And if I think about how we approach discussions with the entity overseeing that product, which is the New York Department of Financial Services, again, you think about the discussions and how extensive they need to be at pinpointing areas that everyone needs to think about, and how extensive and deep those conversations need to go for you to feel comfortable launching, so that we are embracing a flight to quality, a flight to safety.
Yeah.
And I think that is at the heart of what I think of as responsible innovation. And I think, you mentioned the EOs here, and then I look at sort of how that's also done in the European Union with some of its framework legislation on. You mentioned AI. That's an interesting concept there of how they take this concept of risk and say, let's look at different categories of risk and address those accordingly. And in all of these systems, all of these regulatory frameworks, the proof as to whether they are going to work and embrace responsible innovation is whether we can all work appropriately together and not get too conservative without, of course, failing to address risk.
And Harish, I mean, bringing up risk, it seems like we're about to enter the next iteration of finance, of the new risk assessment, and how generative AI can be used and deployed for that risk assessment. When you hear about responsible innovation, what does that mean for the World Bank? What does that mean for folks globally when they're looking at responsible innovation in practice and in implementation?
No, responsible innovation is a very elegant term. We also used it when we were looking at how to frame our thinking around fintech. In 2018, 2019, along with IMF, we created this Bali FinTech agenda, and we use the phrase responsible innovation there. And the way we are looking at it is that it is about fostering the development of innovative technologies, also responsibly harnessing them, and then being clear-eyed about the risks, both the current and the future risks. So I think the future risk also is a point I think which we need to be very careful about. And I think the way it is kind of translating now is at the one hand, you need to look at the same economic function, same regulatory, same regulations, or some would say maybe not same regulations, but more same regulatory outcomes, right? So I think that is one overarching principle, and the way that is being interpreted is to see how the existing standards, how they can be adapted to these new technologies. And I think some things are becoming clearer. One is I think that there's very clearly, in particular for systemically important services and systems, there's a clear need for a regulatory anchor. What that means, I think we have to see, but it clearly needs a regulatory anchor. So this thing about there being nobody behind it, I think that will simply not fly with the regulatory standards. And then also policy objectives like stability, integrity, consumer protection, data protection, privacy, to name a few. I think all of that remains central, and we have to see how to adjust that. And one has to look at the outcomes rather than going by the letter. So I think there's a fair amount of creativity required, and what this means could vary from country to country.
So Danelle, building on responsible innovation, we're here talking about speed. And when we think about how can you create mutually agreed upon regulatory standards where speed is at the heart of where we are moving forward, what do you see as realistic in the short and medium term?
I think it's really important that we think about principles-based legislation versus actually, and certainly not focusing on the tech stack. I think it's mostly the outcomes. I love focusing on outcomes. And so the regulatory speed is, what are the outcomes that you want to deter? And then you think about the products. You do the same thing in AI. Like, so much is like, let's focus on like making sure this technology doesn't get out of control. But again, that's the tech stack. Focus on the products and like what outcomes you're trying to guard against. And if you do that, then you're going to be ahead of the tech as it grows. If you try to focus on well, this is a problem with this tech stack here because, you know, like in DeFi, for example, there's so much focus on DeFi. Decentralized finance still has so much like growth. There's so much opportunity to see what happens. But if you focus on outcomes and challenges that you see for consumers or for businesses, SMEs, or you know, any players that participate, then you can get to the heart of it. And I think that's one of the pieces that way back when I was advocating just for the open web at Mozilla and spending so much time in the European Union and here focusing on let's be careful about regulation, it was because we were trying to regulate pieces instead of the outcome and the challenge.
And I guess as you look at the regulatory perspective and you look globally as Stellar does, what's worked, what hasn't worked, and what are you hoping could work moving forward?
Yeah, I think standards, well I mean again, I think—
Are there certain countries?
Yeah, I think the European Union's focused on what they've done with respect to stablecoins. They're right now in this place where they're going through, it's a larger act, but they're going through the process of sort of digesting and figuring out what it actually means in its implementation. It's the implementation phase. So it's really that they started at the very principled level, which frankly, it doesn't always happen in the European Union. Sometimes they get into the weeds and they didn't. They started up here and now they're going to the implementation phase, which is great. So I think that that's worked there. I think it's also worked in other countries that we've seen, like Singapore, Hong Kong. You've seen a lot more openness to allowing the tech to grow, which, by the way, is what the US did so well with respect to the internet and allowing the internet technology to grow way back in the day. And frankly, we're dealing with the exact same kind of technology today. Open technology that can be looked at and can be viewed, and the code can be reviewed by everyone. And so I think it's really trying to restrain ourselves a bit from getting so afraid, so not letting fear lead us to like these fraudulent things, but getting to the place where we can be like, okay, here's what we want to guard against and let's start there. So I think we need to do better here.
Richard?
Yeah, I totally agree with that. I think I feel so sensitive to some of these issues around the right guardrails and the right risk mitigations. And, you know, again, speaking as a sort of humble industry representative and being respectful of a lot of the central bankers, regulators here, we do care deeply about trust in our services, not just from our customers, but by you and by other stakeholders in the ecosystem, because that's how we're going to succeed. We know that. We deeply, deeply understand that. But I think also, how do you take these guardrail issues and explore them fully, put the right things in place, whilst making sure, to your point, Danelle, not to lose sight of, at the heart of this, why are we doing this? Why does PayPal embrace a number of these services? It's because we want to make payments more efficient. It's because we want to help make them cheaper for people. We want to enable better access for small businesses to a cross-border digital economy that we know is going to benefit them, create jobs at those levels. And so it sounds very daunting, and it is, but how do we put that together without belittling aspects of risk management, which are fundamental to making it all work?
You know, Jim, I want to bring you back in regarding, you know, open source networks. When it comes to policymakers and regulators, and we're speaking about, you know, how they're looking at the regulatory framework and the future framework, what should they be keeping in mind about open source technology and digital assets that they're currently not?
Yeah, I think.
What do they need to be more aware of so that we can get it right?
Yeah, I think there are two things. One, I agree with focusing on the outcome, and the tech is a secondary. I noticed in the IMF book, the list of chapters, the tech was actually chapter 15, and then it went back to the legal and regulation when he showed the outline. I think that's appropriate. I think that there are two things. One, you want to preserve innovation, and that's something that I think is in response to what people want in terms of more efficient payments systems, you know, faster cross-border transfers, things like that. I think the one that, again, I'll come back to is overlooked is please, please don't keep inventing brand new software implementations. Just as you need to come to a policy consensus, it would be greatly advantageous for us to come to a technical consensus as well of an upstream set of components. There will be many of them. It's a nuanced conversation, and understand just how valuable that is to have a global labor force that generally understands this technology, can focus on local needs rather than just rebuilding everything from scratch. Have that nuanced conversation. Understand how technology innovation, again, flows from an open source contributor who contributes an improvement that his company may have found in terms of power efficiency, security, whatever, as is, no warranty upstream, and that flows downstream to a service provider like PayPal or a government service provider. Place regulatory burden on those who are most equipped and able to deal with it. If you understand that flow, that nuanced regulation, I think will be quite good. The US, I think, has done a good job in cybersecurity in this realm. I think the Biden administration has taken a very nuanced approach to this. I think the same thing should happen here.
So Harish, I mean, we're speaking about cross-border payments now. What do you see as certain considerations or examples where cross-border payments and digital assets have been successful? And then where could there be more work to be done?
Well, you're putting me in a tough spot because you're putting me with panelists who have been working on the space and who have some claims, right? So I think it's all experimental, small-scale proof of concept and pilots at this point. There have been some small-scale live programs, but these are very small. So I think a lot of times, I think some of the claims made are kind of need to be seen at scale, right? Whether it will hold up at scale and also during steady state. Because for example, like if you say that transferring a digital asset is costless, that is of course ignoring the cost to on-ramp and the cost to kind of convert it back. And also that also assumes that person can conduct their whole lives using the digital assets, so which is not the reality, right? So I think, so one has to balance what you hear with the reality. But at the same time, there is a significant challenge on cross-border payments. It's a field which has not been critically looked at for a very long time, and the needs have also evolved from just remittances, which has been there for at least 3-4 decades, and that evolved as a very specific business model with the money transfer operators and so on, who build their own proprietary networks. But now there are more types of cross-border payments coming in, so gig workers coming in, small businesses, cross-border e-commerce. So the need is tremendous now. And what I think the digital asset world is showing is how a new network could be created, which could address some of the pain points, what could be some of the technological elements which could be relevant. But having said that, one also has to take into account some of the needs which need to be met by this technology, which is where I think the AML CFT point comes in, also the capital flow measures, which my colleague was mentioning earlier, also trust, privacy, all of that has to come in. And then one also needs to understand that there are long-standing barriers which will not go away just because the new technologies come in. So levels of financial inclusion in a country, the lack of identification, difficulty in opening an account, network connectivity, also access points, all of those are still need to be addressed for the countries to benefit from the digital asset world, right? So one has to look at it holistically, and there are some elements in the technology, and there are some services which I think are worth carefully considering and shaping to meet the objectives.
So Danelle, I mean, when you think about cross-border payments, what are we not aware of that we should be aware of, or what are some anecdotes that you can tell us about that would perhaps enlighten us more about the importance of this space? And then we'll go back to Harish. Danielle first.
So I think one of the most important things is if anybody ever tells you that they're sending any value for free, then they're lying to you. Because in order to make money in this space, which you have providers that are going to, for example, if you think of the on and off ramps, MoneyGram is an on and off ramp in the Stellar network. It's not MoneyGram who owns or controls the agents. The agents are mom and pop stores. They need to make money. They have their doors open and they're able to provide this service because they charge for it. So they are going to have a fee attached to that. So if anybody tells you it's free, then there's something wrong happening on the edge, or they're paying for it out of their hat at the beginning and they're going to charge you in the end. So it's really important. What the World Bank has asked is to be able to bring those fees down from 8 to 10 to 12% down to 2.5%, 3%. That is what you can do, what we see happening today on Stellar, We already see that. So the fact is, it shouldn't be free, but it also doesn't need to cost 8, 10, 12%. And I think that's the important piece of it. So when we're dealing with this and we see it happening, it is the challenges that we see out there with respect to digital assets have everything to do with on and off ramps. So the fact that we've solved this on Stellar with respect to 180 countries leveraging MoneyGram, it's solved, but not completely, because there's human intervention on the edge. So even if you walked into a MoneyGram location and you had a digital wallet that was connected to Stellar and you said, I want to cash out my USDC, the agent would be like, what are you talking about? So it's all about teaching people how to leverage this. If you walk into a MoneyGram location and you just give them the digital number, the same number that you would use as a cash transaction, they'll do it and they don't need to know. Again, this is just another rail. If we think about it any differently, then we create all these challenges and all this fear. If we think about it as any money transfer business, any individual, any company who's working in this space gets to choose what makes the most sense for them in their business on that day, in that moment, to that country, then that's the way that this should be thought of. So it's a nuanced discussion still, but it's all there. We just need to be very thoughtful about how we approach it.
The World Bank was named, so brief response.
Yes, no, thank you. No, I agree with what Danielle said, but just to add a perspective. We maintain remittances prices worldwide database, which has data going over 10 years. Every quarter we collect data. The global average has come down, but at a very slow pace. No? I think currently it stands at 6.2%, which is an average, simple average, not weighted, just simple average. But if you look at the granular information available, there are services which are at 3%, 2.5%, and so on. But the utilization of that is not, one would expect in a rational world that if something is available kind of 4 or 5 percentage points lower, one would go to that, but we are not seeing that happening. And that, I think, shows either challenges in accessing it, or maybe awareness and literacy, or that it is a very niche service. No? And I think more needs to be done on that, and I think that's where the focus is. And of course, there is potential to bring it even further down.
So, Richard, thinking about CBDC design considerations that support financial inclusion, what design elements do you think we should be speaking about? Are there any examples we can turn to right now?
I mean, I think in terms of design principles, I think, look, ease of access, I've heard a couple of the other speakers today talk about this. You know, ease of access is going to be critical, right? That's going to be critical for individuals, but it's also going to be critical for like who gets to play and help distribute those CBDCs. And I think obviously banks are going to have a critical role. I think non-banks have a critical role to play as well. And we've seen that recognized by a number of the sort of legislative underpinnings for CBDCs that are coming through. I think there are other sort of interesting design choices and follow-up discussions that are to be had around sort of identity management and how, given some of the difficulties and cost in the system that are generated by some of those frictions, how we can look at some of those particular parts. I think issues around programmability are fascinating. I'm not going to say that I have a clear view on all those things. I understand some of the issues that come with that. But if we're serious about financial inclusion and financial health, I think issues around programmability can have an important role to play as well.
So lightning round, 5 minutes to go. Jim, I want to kick off with you. We're here in 2050, and we're talking about speed. What are we talking about? What challenges will we be facing then that we hopefully will have corrected now, building on a lot of what you talked about regarding open infrastructure?
2050?
2050.
Oh my God. What were you doing 20 years ago? Like, that's a tough one. I think that, again, the technical challenges will largely be overcome. Like, I think they're pretty much, in many ways, overcome even at this moment. I do think, you know, I work at a job where every day 800,000 developers, a collective $26 billion payroll, are responsible for the open source artifacts, and none of them work for me.
And so there's a sense of humility around creating consensus in these communities that I suspect many of the regulatory and central banking folks here can appreciate. And I hope that in 20 years, the consensus on the needed regulatory frameworks on what citizens' needs are for accessibility, for trustworthiness, for transparency, have been concluded. I'm very, very confident that the technology consensus is much easier to achieve.
So Danelle, 2050, what will speed mean?
Speed is going to, I think we have to focus on the fact that there's going to be the ability for all humans to have access to things like bank accounts without having a bank there. And I think speed is just going to be focused on not just the tech stack, but just the ability to access those tools is going to be so much simpler. From my standpoint, that is the world. That's our mission at the Stellar Development Foundation. We're focused on creating that equitable access. We don't say financial inclusion, because financial inclusion is on the edge, and it's all of the folks that are building on this technology that are going to achieve that. But I think speed there is going to be all about allowing people to have access to these tools, and there's not going to be any bumps in the road. We live in truly a borderless world when it comes to this technology, and I think speed will mean that that will be able to be leveraged completely then.
Harish, from the World Bank's perspective, 2050, how will that be handled? What opportunities, challenges will that present?
Well, in 2050, it will be my avatar talking to your avatar or the metaverse and so on. So I think it's but I think from our objective as an institutional level, of course, we hope by that time the world is rid of extreme poverty, and we are able to live on a livable planet at that point. So that's what we look for.
Okay, and Richard?
I mean, I think all great answers. I think I would just add, look, I think we have the expectation is we'll be all digitally native at that point. And if you're looking from our perspective at payments, what does that mean? It means that people are going to expect to undertake and receive payments without a thought, and in very different ways from how we imagine today. So micropayments, payments for consumption that's done in very different ways. Hence the importance of getting the innovation right and making sure that we're looking at the key aspects of risk.
Danelle, I meant to ask you about the election in Argentina and what Stellar learned and gleaned during that time up to the days where ballots were taken. What did you learn about the dollar and re-dollarization?
Yeah, I mean, I think we have an application called Vibrant that's focused on Argentina. What you can do in the application is take your local currency and then convert it to a digital ARST, and then convert that into a USDC, so that you can actually hold US dollar assets in Argentina to hedge against inflation. And what we saw during the week leading up to the first ballots that went in is 150% increase in the use of that application, because so many people wanted access to the dollar during that time. Right before the second election, which was the final one, so they were 2 weeks apart, we saw even more users come to it. And then of course we saw the outcome of the election being that that there's a consideration of moving to the dollar. So I think that the dollarization and leveraging those digital dollars is already something that a lot of Argentinians do. And it's not just Argentina. We see the same thing happening in Colombia and in other regions in Latin America where there's a challenge with inflation.
So Richard, Jim, Danelle, Harish, thank you so much for this wonderful panel. Thank you.
Ladies and gentlemen, for the final time today, please welcome Jennifer Lassiter, Executive Director of the Digital Dollar Project, and Josh Lipsky, Senior Director of the Geoeconomic Center at the Atlantic Council.
Thanks, everyone. Thank you for joining us today, both to our in-person attendees and our online audience. For everyone who's joined virtually, this has been a very busy day, and we appreciate that you've spent it with us. Thank you so much. For those of you who are here in person, if you can just hold for one moment, we're going to share some further logistics.